are, because we are not only doing IT, we are also touching the business at this point in time. So it's not only about the IT and technology, it's also about business process. I see there is a loss of productivity gain that is going to happen. And I was growing up in industry, it was faster, better, cheaper, and you can get only two. With this AI, you can get faster, better, and economical, all three. And that's a possibility that AI is going to bring. And all this Anthropic and OpenAI, it's going to aid that. So this is how I see this is going to happen.
Arindam, we speak to so many Indian IT companies, and quarter after quarter for the last many, we've been asking them the risk of AI. And they keep saying we have the contextual knowledge, and that is our moat. But do you think with what we're seeing today with Anthropic and OpenAI, the fact that they're getting consultants like McKinsey on board, the McKinsey strategize and agentic AI will execute on the work. So that contextual knowledge, which was seen as a moat for GCCs and which Anand is talking about, is that defensible?
When we look at the impact of AI on GCCs itself, there are a couple of things you need to consider. One of them being the maturity of the enterprise as well as the GCC that is in question here. And secondly, what is it that the GCC does? Because there are GCCs today that are doing a variety of different things than just traditional commoditized stack of activities. And I think that needs to be taken into context when we discuss this question. Now, to your point on contextual knowledge and the defense mechanism around contextual knowledge, we can't look at GCCs in isolation of the enterprise. Now, if Saint-Gobain decides tomorrow that it is going to use agentic as the effective tool to bring efficiency and drive, $1 billion of its bottom line, then by its consequence, the GCC will be impacted in some shape or form. But however, it is highly dependent on enterprise maturity, where they are in the context of AI, how fast are they adopting AI. The way we are looking at it is, I think the GCC world is looking at this as a tremendous opportunity than something that they need to protect themselves against.
So this 2.36 million professionals that GCCs employ today, do you think that headcount goes up, goes down in the next 5 years? Because tomorrow a board can ask, if Meta can do with 10% less, then why can't you?
I think you're going to see it go up first and then subsequently start to go down. The going up is factored in primarily because if you look at the shift in terms of what kind of skills are going to be hired in the next 2 to 3 years, as this becomes more mainstream, significant domain expertise, you need AI experts, you need data engineers, you need people who understand how to run these systems efficiently. So I think that's being incorporated into GCCs. You've got centers of excellence being set up. Once they get in and they start to look at processes and end-to-end views of everything that's running within the company, you can start to see some of what I would call more transactional activities being automated.
So what's the timeline that we're looking at? Because I think the one big worry everyone has is job losses.
Yeah. I would say that you will see play out in the next couple of years.
I see the opportunity for all of us is a product innovation, okay? What we do from here also in India, from a perspective you see AI and new technology, the biggest problem within Europe and within America is talent even today. The technology which was used 30 years back, I can't drive personally. I need, for example, the talents who get trained from the beginning. And I will be very, very honest and bold to say that. And India is a place where you will get talent. And I see this is where I agree with Arindam that it will increase and then will get optimized. Industry will grow. When I started my career, it was first I2K, then E-bubble. Every time it was threatened. But every time it came out very differently and victoriously. I see big opportunity forward, being a technologist.
Gentlemen, it's been a great conversation.
Now, tonight's conversations reflected the ideas, leadership, and innovation shaping India's next phase of growth. A heartfelt thank you to our presenting partners, WeWork India, and co-presenting partner, PhonePe. A special thank you to our distinguished speakers for sharing their insights and experiences, and to our audience for being part of these meaningful conversations.
WeWork India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
The Reserve Bank and its MPC will be announcing its policy when there is much to worry about the fall of the rupee and possible rise in inflation. However, growth looks resilient. As always, the CNBC TV 18 Citizens Monetary Policy Committee is here with me to discuss what the RBI may and should do in its June 5th policy. Let me welcome Chairman of our committee, Pranab Sen, and members Sajid Chinoy, Samiran Chakraborty, Shaumika Ghosh, and Sonal Verma. Sonal and gentlemen, thank you very much indeed for your time. Sajid, may I start with you? Well, inflation is the mandate of the Reserve Bank, and chances are it is going to be...
US President Donald Trump dials Israeli Prime Minister Benjamin Netanyahu, tells him to pull troops back from Lebanon. The US President also flip-flops on Iran negotiations, tells CNBC, I don't care if Iran negotiations are over, but later announces that the talks with Iran are still underway. Meanwhile, Iran's foreign minister emphasizes that achieving a comprehensive truce in Lebanon remains a fundamental requirement for any agreement with the United States. Stocks on Wall Street closed Monday's trading session higher as investors watch developments in US-Iran peace negotiations. Tech shares rise 2.5%, boosting the Nasdaq and S&P 500 to the latest in a series of record closing highs. Meanwhile, markets in Asia-Pacific region trade lower as uncertainty over US-Iran peace talks dents the sentiment. The GIFT Nifty is indicating a gap-down start for the Indian market. Brent crude prices trade near $95 per barrel as ongoing peace talks between US and Iran show little progress, keeping markets cautious about the supply disruption. Meanwhile, gold prices trade below $4,500 per ounce, pressured by stalled peace negotiations between the United States and Iran. India and US begin four-day talks in New Delhi to finalize the details of an interim trade agreement. US delegation is led by the chief negotiator Brendan Lynch, and the Indian team is led by Additional Secretary at Commerce Ministry Darpan Jain. Commerce Minister Piyush Goyal says the broader issues have been finalized, adds that smaller details, commas and full stops are also being negotiated. Hello, good morning. You're tuned into Power Breakfast on CNBC TV 18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Now, in terms of the markets, again, yesterday, what happened for the Nifty was that we closed near the day's lowest point, right? We were seeing a bit of a fall that came in, especially in the second half of the trading session when we started seeing that fall decline. We closed at 382 levels. Around that mark is what we closed at. So fall from what we saw in terms of Friday's trading session as well. And today, what's the indication from the Asian markets? Asian markets have opened up in the red. Most of them at least are trading in the red, right? Taiwan index and Hang Seng are holding on to some bit of a gain. But apart from that, whether you look at the ASX 200, the Nikkei, the Shanghai, all of them are trading in the red. So we're seeing a bit of a mixed opening. While some bit of a green is coming in for Asian markets today, we're not seeing much of that sustain through the day as well. At least for the Indian markets right now, we're watching out for a gap down start. 226 point downtick or 224 point downtick approximately is what the Nifty implied open is indicating for our Indian markets. So we're expecting red again on the screen for the Indian markets. Yesterday we had underperformed the Asian markets. Today seems like that's going to be the case again. So that's the update that we have in terms of the Asian market front, and India expected to open in the red. But on to that West Asia update, right, which is continuing to impact the global markets as well. Now, Iran's chief negotiator Mohammad Ghalibaf has said that and threatened to walk away from talks with the United States and close the Strait of Hormuz completely unless Israel's military incursion into Lebanon territory is ended and the strike against Hezbollah are stopped. Meanwhile, Trump's flip-flop on the status of peace negotiation continues. In an exclusive interview to CNBC, Trump says he doesn't care if negotiations with Iran are over, and he thinks that the talks were starting to get boring. He also said that Iran can continue to lose $500 million a day with the Strait of Hormuz tensions that are going on. But a few hours later, a Truth Social post from President Trump suggested that he held talks with Israeli Prime Minister Benjamin Netanyahu to pull his troops back from Lebanon's capital, and has also spoken with Hezbollah representatives who have agreed to stop shooting at Israeli forces. Following this, US President Trump later again said that talks with Iran were still underway and were happening at a rapid pace. Now, moving on, earlier we spoke to Jeffrey Sachs, professor at Columbia University, on the Iran conflict and the US strategy. Listen in.
We're very close to resolution if the United States will face reality. Basically, this was a war that was supposed to last one day. Israel and the United States thought they would chop off the head of the Iranian regime, put in their own leader, and that would be the end of it. Of course, this was proven wrong within hours of the first strikes on February 28th. Since then, the situation is clear. The United States cannot win militarily.
Okay, that's the word coming in there from Jeffrey Sachs. But the flip-flop from President Trump in terms of the peace talks between US and Iran are continuing. So how is all this actually impacting the commodities market? With Manisha Gupta joining us as always to take us through all of that. Good morning, Manisha.
Morning, Vinny. Thank you for that. Well, yes, as anticipated, we have seen buying come back in case of crude oil prices with the kind of statements that we are hearing in from all sides. So the crude has gained 4% overnight. Let me remind you that the prices fell 19% in the month of May on expectations that the peace talks between US and Iran will progress, but that hasn't happened. In the meanwhile, you also have Iran media now suggesting that Iran is suspending communication with Washington in response to Israel strikes in Lebanon. Iran media also says that Iran and regional allies could be looking at a full closure, not just of Strait of Hormuz, but Bab el-Mandeb Strait as well. And that could be a bigger issue really going forward, not just for crude, but various other commodities as well. And you have seen gains come in overnight for almost all commodities. So while crude was up 4%, we've seen gold and silver decline, obviously, because the money seems to be rotating there. But it is the metal prices which have surged yet again. Copper trading at a 2-week highs, aluminum trading at a 4-year highs, coal prices at 8-week highs, sugar gained up by 2.5%, coffee has seen some buying in the overnight markets as well. So various agriculture and metal prices have seen a surge overnight.
Okay, Manisha, thank you so much for that, for the latest update in the world of commodity. But on that note, we're going to sip into a very short break. Up next, we'll come back and tell you how these overnight cues are going to be impacting our Indian market. Stay tuned in. Thanks for staying tuned into Power Breakfast on CNBC TV 18. Now we have a team of research joining us to set you up for trade, tell you which are the important stocks to watch out for, how the global market cues are going to be impacting our market. And first up, let's go across to Hormuz, who's here to tell us the important cues that we are keeping an eye out on today. Good morning, Hormuz.
Morning, Vinny. And yesterday when I was prepping for this, there was a question that I had in mind, is that considering the developments of the last 2 days, has the market already priced in a potential bad news? Well, the GIFT Nifty is giving me an answer to that this morning with the 250-point downtick. Is nowhere close to being priced in whatsoever. But today being the weekly expiry of the Nifty contracts, you need to keep that in mind as well. And the impact of the fallout of the US-Iran negotiations hitting a deadlock was on the oil prices. At one point, Brent was well over 96 a barrel as well. Now, there has been some cool off from those levels. So bottom line being that there has been no significant reaction to asset classes across the board. Yes, the Dow futures are down this morning, but the US markets did fairly okay yesterday. The bond yields did not rise. Oil prices saw a marginal bump up, but then they too are not near those elevated levels that they were before. So that needs to be taken into account. The only point being that the broader markets need to be watched out for as well. Even yesterday when the Nifty fell, yes, but the broader markets fell even more. So whether that continues in today's session as well, that needs to be monitored. And the only thing being that the bulls would hope that IT was the only supporting factor in yesterday's session. That continues to happen today as well, because of the fact that big tech did very well yesterday in the US, and the software related names also did fairly well in yesterday's trading session. Now for the levels, well, there was a chance of the Nifty testing the May series lows of 23,262. We are very likely to open below those levels as well. So now what happens is we go down to 23,000 being the first level to watch on the downside, and on the upside, well, if there is any, you go on to 23,500 being the first level. For the Nifty Bank, yet another 1,000-point day, it continues to underperform the index. So 53,000 on the downside being the first important level to watch. So the weekly expiry today, not a good looking screen as of now, but the bulls would hope that there is some support at lower levels, and 23,000 at least is defended in today's weekly expiry.
Absolutely hoping for some support there, Hormuz. In the morning, at least right now, what you're saying is right. Not seeing any green across the screen, so we'll wait out for that. But on that note, let's go across to Ria, who's here to tell us which are the important stocks to watch out for in the trading session. Good morning, Ria.
Well, good morning. Starting off with Alchem Labs first, which has launched a QIP worth 2,800 crore rupees with a floor price at 294.13 per share. NHPC will also be in focus as the government has launched an OFS of up to 6% equity in the company, with the floor price being set at rupees 71 per share. And Alchem Labs will also be in focus on the back of a block deal valued at around 950 crore rupees, which is 1.5% of the equity, with the floor price being set at around 5,200 per share for this one. Ola Electric to be in focus as they have launched a QIP worth 500 crores with their floor price being set at 37.74 rupees per share. Keep an eye on Coal India as well, as they have come out with an update for the month of May for their e-auction, with the government reducing their stake from 63.13% to now 61.13%. And lastly, NMDC will be in focus on the back of its update for the month of May, with the total production at 5.31 metric tons versus about 4.43 metric tons on a year-on-year basis, and the total sales declining to around 4.04 metric tons this time around.
Okay, thank you so much for that, Ria. But in the final update, let's go across to Sudarshan, who's here to tell us the important cues in the world of FNO. Sudarshan, we've heard levels from Hormuz, but what are the cues, and anything specific you want to talk to us how we should be prepared for the day today?
Good morning, Wendy. So remember one song, आज मैं आगे ज़माना है पीछे. But the way Indian market is underperforming the global markets, it seems like ज़माना है आगे, आज मैं पीछे. But talking about the cues, it's weekly expiry for Nifty. FIs remain heavily on the sell side. Look at everywhere, index futures, stock futures, short additions, everywhere, wherever they are finding any opportunity, they are adding positions on the short side. And also the global cues have turned the way over the last few days. And yesterday overnight also you have seen the way crude has surged. Brent is now back above around basically $95. But one silver lining, if I can talk about, is put-call ratio. Now it's below 0.70. So normally when it slips below 0.70, there can be a short covering. So if there is any positive news, we might see a huge short covering. So let's see if it happens. But talking about FI flows in the index future, they have sold more than 3,400 crore. In the stock future, the selling was more than 500 crore. Longs, they have reduced positions by almost 5,000 contracts. On the short side, addition was again more than 16,000 contracts after adding almost 32,000 contracts yesterday. Now they have added more than 16,000 contracts. Now what has happened on the option front? So 23,400 put has seen maximum increase in the open interest, and another put option that was active was 23,250. Now GIFT Nifty for you is indicating that we might slip to the level around 23,250, but in all probability, Nifty should hold on to levels around 23,250. If we slip below that, then the door for even 22,500 opens. On the call side, 23,600 and 23,700 were the most active ones. So support for Nifty, 23,250, resistance 23,500. Two stocks are in the band, Keynes Technology and Adani Enterprises. Some of the stocks have been seeing fresh longs and fresh shorts. So MCX was there on the fresh short side. Even Glenmark was there on the fresh short side. NMDC after the earnings has seen fresh longs, and Tech Mahindra from RTPAC was one of the most active ones and has seen fresh longs.
Okay, Sudarshan, thank you so much for that. Hope we go ahead of the globe. Aaj hum aage chale versus the peers, but thanks so much for that. On that note, let's talk about US markets, right? A tech-led rally that happened on Wall Street last night. What we saw was S&P 500 and the Nasdaq closed at record highs, shrugging off new related tensions between the US and Iran. We have CNBC's Julia Bushi, who's here to give us on what happened in terms of the wrap on Wall Street.
Markets were up across the major indexes in Monday trading as tech stocks surge and oil prices rise. The Dow gained 46 points, the S&P 500 was up 20 points, and the tech-heavy Nasdaq added 114 points. AI startup Anthropic confidentially filed for its IPO with the Securities and Exchange Commission Monday. With its announcement today, Anthropic is getting out ahead of rival OpenAI. Anthropic has experienced explosive growth this year. Last week, it closed a funding round with a valuation of $965 billion, which topped OpenAI, which was valued at $852 billion in late March. And shares of MGM Resorts International surged 16% on Monday after IAC, which is being rebranded as People Incorporated, made an $18 billion bid to buy the company. IAC Chairman Barry Diller is on MGM's board and says he'll recuse himself for board actions on the deal. MGM owns properties including the Bellagio and Aria in Las Vegas. Diller's company already owns about 26% of MGM.
Okay, thank you so much for that. Now, staying with the U.S. market, where Mohammad El-Erian, Chief Economic Advisor at Allianz, saying that inflation still remains above the target, adds the question remains on what the Fed does in this volatile environment. Listen in.
Let's not forget we're now in this 63rd consecutive month of inflation above target. So there's been failure on policy.
That they cut rates into.
And there's been failure on communication. But I think we've got to get used to, Joe, Chair Powell has carved out, former Chair Powell has carved out independence as his thing, and we will hear from him repeatedly on this.
Yeah.
But the debate is moving on. And there's a real question mark as to what does the Fed do in this environment, and also how divergent will the Fed become from other central banks. So I think the central banking debate will move on, but Chair Powell has carved out his issue is Fed independence.
Meanwhile, Ruchir Sharma, chairman of Rockefeller International, talks about the foundation of the current market level, says that a high fiscal deficit is artificially driven and driving corporate profits higher. Listen in.
The mirror image of running a very large fiscal deficit is that your corporate savings tend to be very high. So the big difference between the late 90s and now is that we're running a fiscal deficit of 6% of GDP. And that is artificially boosting corporate profits. It's like an income transfer happening between the public and the private sector. The second point that I make here is that history is somewhat wrongly remembered, that now we like to poo-poo the entire dot-com boom. So I looked at what were the earnings actually at that point in time. And then you figure out that the earnings of the tech sector and the earnings now, at least the earnings growth, was quite similar. It just is that because we had the crash later, that everyone remembers that, you know, with all the negative connotations, but actually the earnings growth of the tech sector in that 5-year stretch of that boom was 20% as well. We keep comparing this to 99-2000, right?
Yeah, so where are we in that comparison?
Yeah, so we are nowhere near 99-2000 as far as the valuations are concerned. But the only caveat I have today is that the earnings could also be in a bit of a bubble. And that's because the earnings are being artificially inflated, as I said, because of these three factors, including the government deficit. Back in the late 90s, the government barely ran a deficit.
Okay, on that note, we're going to slip into a very short break. After the break, we'll come back and tell you what's happening in the world of AI. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now on to the India-US trade negotiations. A US delegation led by Chief Negotiator Brendan Lynch is in New Delhi for the talks from 2nd of June to the 4th of June to finalize the interim deal. Both sides will discuss some market access, customs felicitations, as well as investment promotion and a broader comprehensive trade agreement. Union Commerce Minister Piyush Goyal said that most aspects of the first phase of the bilateral trade agreement have been finalized and discussions are now limited to a few minor issues, describing them as commas and full stops. Listen in.
जैसा आप जानते हैं कि अभी यूएस के एम्बेसडर मिस्टर सर्जियो गौर ने भी कहा कि 99% चीज़ें तय हो गई है, छोटी मोटी कॉमास और फुल स्टॉप्स पे चर्चा चल रही है। फाइनलाइज करते वक्त जो वहाँ पे बदलाव आए थे, कानूनी बदलाव आए थे यूएस में, उसको किस प्रकार से फाइनल एग्रीमेंट में रिफ्लेक्ट करना, उसके हिसाब से किस प्रकार से बदलाव होगा, उसको तय करके मुझे पूरा विश्वास है कि यूएसए के साथ भी जल्द से जल्द हम बायलैटरल ट्रेड एग्रीमेंट का पहला ट्रांच खत्म कर देंगे, साइन करेंगे और आगे की चर्चा चालू करेंगे।
Okay, now let's move on and get to the latest update from the world of tech in our special segment AI Pulse. We have Rachna joining us as always to take us through all of that. Good morning.
Well, first up is Anthropic that has confidentially submitted a draft S1 to the SEC, kicking off the process for an initial public offering. Now, this filing comes just days after Anthropic closed a $65 billion Series H round, pushing its valuation to $965 billion. Now, the company is targeting a listing as early as October 2026. With this, it has also surpassed OpenAI and beat the company to file its draft to the SEC. Then Anthropic is also offering the European Union access to its most powerful model yet, Mythos. The model can autonomously identify zero-day vulnerabilities and generate working exploits, which is why access has been restricted to 40 vetted US firms, and that is known as Project Glasswing, as we've told you before. But now the EU cybersecurity agency, ENISA, will now be onboarded. Terms are still being finalized though. Onto the capital markets then. Alphabet is raising $80 billion through stock sales to fund its AI infrastructure build out. This includes a $10 billion private placement with Berkshire Hathaway. Full year capex for the company is guided up to $190 billion now. And speaking of that Berkshire Hathaway investment, it is a part of a broader deployment blitz by new CEO Greg Abel. Berkshire Hathaway spent $16.8 billion across 2 days. Acquiring home builder Tyler Morrison for $8.5 billion and backing Alphabet's stock offering with $10 billion. Now, Buffett said that Abel did it faster and smoother than he ever could have. Then there's Florida, that has become the first US state to sue OpenAI and CEO Sam Altman, alleging ChatGPT-aided mass shooters drove users to suicide and addicted minors. Altman is being sought personally liable this time. NVIDIA's Vera Rubin is now in full production, delivering 5 times the throughput of Blackwell at 10 times the lower the cost per token. Now, this is available across major clouds in H2 2026. This was announced at Computex, which is happening currently in Taiwan, Taipei. Then there's SoftBank CEO Masayoshi Son, who told CNBC the AI revolution is 50 times bigger than the dot-com boom. After SoftBank announced an $87 billion AI infrastructure investment in France, SoftBank has now overtaken Toyota as Japan's most valuable company. That's all from today's AI Pulse, but we'll get you more updates through the day.
Okay, thank you so much for that, Rachna. But with that, we're absolutely out of time on this edition of Power Breakfast. Looking at the Nifty implied open, we're still looking at a red start, a gap down start for the Indian markets, down more than 200 points. But thank you so much for tuning in. Up next, your Vasar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Moti Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi, morning.
Hi, morning.
Morning.
It just feels like, we have these two tracks going on in the market. One is Middle East, and that's doing nothing perhaps. And on the other hand, you've got AI, where the momentum is absolutely intact.
Well, indeed. And it's basically what that has led to is that now Korea, it was Taiwan a few days back. It's now Korea, which has now overtaken India's market capitalization. Both were within 10% range. So it was
close. It was coming.
It was close. So if our underperformance continued and their outperformance continued, it was bound to happen. It's happened, I think.
Well, indeed. I mean, tricky times. So let's hope for a better day today.
No, absolutely. And I think, Reema said that not much has happened. Not much is happening directionally, but, intraday there is a fair bit happening. It's just that by the time markets end, it's kind of all flatlined, right? And I think last night was a session just like that. So, oil's at $95 a barrel and 94.5, 95, right? So, Trump essentially saying that negotiations with Iran are continuing at a rapid pace. And just sort of going in the chronological order in terms of the latest to the oldest. Trump, he also said that Israel and Hezbollah had agreed to dial back attacks on each other. There was a phone call, there's some reportage on the phone call between President Trump and Israel's Prime Minister Benjamin Netanyahu. And, some of the parts of the phone call are pretty explosive, and Trump basically yelling at Netanyahu, saying, "Well, what the hell are you doing?" and all that stuff. So you could read up on it. But basically, Trump announced on Truth Social that I've spoken with both sides, and both sides, that is Israel and Lebanon, have agreed to stop, attacking each other. And this came on the back of reports last night that Iran essentially is going to halt any peace talks with the US because Israel's ceasefire violations in Lebanon were unacceptable. So that is essentially what was reported. That led to this phone call, and then these posts by President Trump saying that, assuring that talks with Iran are continuing, and the situation between Israel and Lebanon is for now resolved. But if you read that Truth Social post, it doesn't look very convincing. It says, well, let's see how long it lasts. I hope it's forever. So, it doesn't inspire too much confidence. But in any case, last night, you had the 10-year, and in response, by the way, to all this, right? So intraday, we saw large moves, and this is what I'm talking about. The 10-year was up 7 basis points to 4.51. Oil jumped to near 98. Almost 98, and the S&P was down about 0.25% or so. But as this entire news flow cycle was going on with the phone call and all of the posts on Truth Social, etc., and saying the world talks are continuing, everything reversed. The 10-year was absolutely flat. Oil prices are higher, but off 98 levels. And of course, equities flipped. So the S&P was down 0.25. It ended up 0.25%. And the Nasdaq was up about 0.42% or so as well. Now a bit about technology. NVIDIA was up 6%. They're launching new AI chip that will be used on Microsoft Windows laptops and desktops. Salesforce was up almost 10%. They're investing $2 billion towards AI data centers, etc. in France through 2030. Anthropic, of course, looks like it's going to beat OpenAI to hit the market, and they've confidentially submitted the draft paperwork for IPO. So it's confidential, so we don't have details for what the filing looks like, what the financials, etc., for Anthropic look like. But it looks like they're going to be to the market. They're going to be in the market listed space earlier than the other one, which is OpenAI. The levels, just to sort of tie in things here. Yesterday was a disappointing session because Friday, there was that MSCI rebalance-led selling, large selling, all of it coming and hitting in the last 45 minutes to 1 hour. Yesterday, of course, at no point it looked like there was even any attempt at a recovery. It was just started and kept sort of, coming lower step by step. And we ended just about 23,300, just under 23,400 or so. So those are levels here. 22,719 is the first support. And 23,262 is the next support level that we are working. The first one is 23,262, which is the near one. That is the first one. And the second support is 22,719. I wrote it support 1, support 2. And of course, the resistance is 23,800 now, with the market sort of, having come off very, very sharply. So let's see if this 1,000-point range that we've been working with holds, or, this is set to break as well, because the last range, which is 23,800 to 24,300 broke. We are now at the lower end of that bigger 1,000-point range, and we'll find out if that goes too. So 200 points lower on the GIFT Nifty is the indicative open at this stage. Nigel has booked a shot of the vault with the F&O positioning and the data as it stands right now. Nigel, take it away.
Well, the GIFT Nifty is suggesting a sharp downtick, and it's going to be rather tricky because today, remember, we have the weekly expiry as well that plays out. So that gap down will be rather interesting to see whether or not the bulls have courage to go ahead and buy in there, or in fact, the bears are going to take control on weekly expiry day. We're in for a very, very exciting trading session, and it'll be a big swing day according to the data points. Let's run you through a few of them. Well, on the rupee, you would have hoped for some stability. You've got that stability. The rupee has actually pulled back to around the 95-odd mark. A few days ago, you would have longed for that. You've got that. And crude oil prices, you would have hoped that from around the $105, $110 per barrel, it comes down to around the mid-90s. That as well has happened. And despite both these two factors happening, still you have the Nifty that's actually broken down a little bit in the last few days, and the structure has got punctured a little bit because of the kind of fall we've seen, particularly in the last few trading session. And yesterday, the Nifty closed below its 50% Fibonacci retracement of the entire April rally of closer on 2,200, 2,300 points or thereabouts. So we have pulled back closer on 50% and ended a little below that. That's a bit of a worry. Hence, any kind of bounce could invite fresh selling pressure. So the structure seems to be a little bit punctured. If we bounce, you'll want us to bounce big time and get past some of those technical levels, which I'll tell you about in just a bit. Yesterday, the institutions were net buyers, close around 1,200 crores of net buying because the DI is bought, but the FIs continue their selling ways. Yesterday as well, close around 4,000 crores is what they sold. And you're hoping for this number actually to cool off because the last few days, it showed some signs. Then on Friday, we got an ugly number because of the MSCI. And yesterday back around 4,000 crores or thereabouts. So you want actually this number to cool off. In terms of index futures, well, the FIs, they are very, very defensive. They have been adding shorts, lock, stock and barrel. Yesterday as well, closer around 17,000 contracts is what they added on the short side. They unwound closer around 5,000 contracts. So that's telling you the swing factor is closer around 22,000 contracts just on index futures, which takes the short positioning from around that 83% odd mark that we saw a few sessions ago. That's moved to that 90% odd mark. And just take a look at the chart. The short contracts have gone up from the FIs table by close to around 70,000 contracts just in the last 4 trading sessions. So the shorts are stacked into the system and they're heavily stacked into the system. So you're looking for some kind of a good news to see some covering. But for now, the bears are feeling they're on top. And the FI positioning on index options as well is fairly defensive. They wrote close to around 70,000 calls even in yesterday's trading session. And because of the aggressive call writing we've seen, the PCR has come down to the lower end of the range. So you'll be banking that around the 0.65 odd, you see some bit of a bounce because that's the lower end of the range. FI shorts in the system, PCR at the lower end of the range, you're hoping for a bounce. And the calls that were written yesterday, 23,550 call, 23,450 call, between them close to around 80 lakh shares getting added there. Which brings us to the levels. On any kind of bounce, you'll see selling pressure that will come in. So the first level you're looking at is the 50 DMA. For me, this is the first level of resistance, 23,700. That's the important mark. On the downside, the reference point is the recent low. Just one final point before we wind down. Remember, the last 2 months have been good in terms of the advances in comparison to the declines. You'll want more of the same, given that crude oil prices have cooled off and the rupee has shown some kind of stability. So you want this to continue. Last 2 months, you've seen number of stocks advancing, outweighing the number of stocks declining, with the GIFT Nifty suggesting a gap down start. Hopefully you see some kind of bounce from there because today is weekly expiry and in the last hour of trade, things will get rather volatile.
Thank you very much for that. That GIFT Nifty level is a bit worrying, 180 points down, and this comes on the back of 4 consecutive days of selling. Seen in the, in terms of the Nifty level, we've been closing lower now for 4 straight sessions in a row. Asia's also bleeding red. The Japanese market, Nikkei, is down nearly 1,100 points. The Korean markets are under pressure. For Kospi, we got inflation numbers for the month of May at 3.1%. It's come in ahead of market expectations. So that's a bit worrying because the street fears Bank of Korea will tilt towards raising interest rates now. So Kospi is also feeling the heat on account of the conflict-related inflation and perhaps the tech sector. But You've got green on the screen when it comes to Hang Seng and the Taiwanese market. Hang Seng is actually holding up pretty well. But let's get back to the latest about the war and the updates here. Speaking about the West Asia tensions, Jeffrey Sachs of Columbia University told CNBC TV 18 that it is clear United States cannot win militarily in Iran. Listen in.
We're very close to resolution if the United States will face reality. Basically, this was a war that was supposed to last one day. Israel and the United States thought they would chop off the head of the Iranian regime, put in their own leader, and that would be the end of it. Of course, this was proven wrong within hours of the first strikes on February 28th. Since then, the situation is clear. The United States cannot win militarily.
Well, on the U.S. markets, this is Mohammad Al-Arian, Chief Economic Advisor at Allianz, saying that inflation still remains above target, adds the question remains on what the Fed does in this volatile environment. Listen in.
Let's not forget we're now in this 63rd consecutive month of inflation above target. So there's been failure on policy.
That they cut rates into.
And there's been failure on communication. But I think we've got to get used to, Joe, Chair Powell has carved out, former Chair Powell has carved out independence as his thing. And we will hear from him repeatedly on this.
Yeah.
But the debate is moving on. And there's a real question mark as to what does the Fed do in this environment? And also, how divergent will the Fed become from other central banks? So I think the central banking debate will move on. But Chair Powell has carved out his issue is Fed independence. We are now entering the 4th month of a war that has disrupted supplies of energy, and yet markets are in their 9th week of consecutive increases, and yet the willingness to spend by investors, by governments, by consumer hasn't been dented at all, and the question now becomes ability. Can everybody continue to spend despite what is going on in the real economy? So before the war, and particularly, I felt they should have started in July, which they didn't. Now I think you stay as is. You neither hike nor you cut, waiting to see how the economy plays out.
We got a lot of interesting opinion on CNBC overnight. Ruchi Sharma, Chairman Rockefeller International, spoke about the foundation of the current market levels. And his worry is the high fiscal deficit, because he says that is artificially driving corporate profits higher.
The mirror image of running a very large fiscal deficit is that your corporate savings tend to be very high. So the big difference between the late 90s and now is that we're running a fiscal deficit of 6% of GDP. And that is artificially boosting corporate profits. It's like an income transfer happening between the public and the private sector. The second point that I make here is that history is somewhat wrongly remembered, that now we like to poo-poo the entire dot-com boom. So I looked at what were the earnings actually at that point in time. And then you figure out that the earnings of the tech sector and the earnings now, at least the earnings growth, was quite similar. It just is that because we had the crash later, that everyone remembers that, with all the negative connotations, but actually the earnings growth of the tech sector in that 5-year stretch of that boom was 20% as well. We keep comparing this to 99-2000, right?
Yeah, so where are we in that comparison?
Yeah, so we are nowhere near 99-2000 as far as the valuations are concerned. But the only caveat I have today is that the earnings could also be in a bit of a bubble. And that's because the earnings are being artificially inflated, as I said, because of these 3 factors, including the government deficit. Back in the late 90s, the government barely ran a deficit.
Well, that is Ruchir. Interesting comparison, and listen to that longer clip, and he makes some interesting points there. We'll take a quick look at the interactions which are lined up here on the program. So 8:35, we have the management of Walcard. It's a big approval from the US FDA, which has come through for Zenic. 9 o'clock, we have BofA Global Researchers Gunjan, who will put the spotlight on the auto space and what to do with the names there. 9:20, Lawrence Belanco of CLSA. We'll talk technicals, markets. 9:30, the management of Bajaj decodes the numbers for the month of May. Glenmark Pharma will be speaking with 9:40 on their 4th quarter numbers. Blue Star joins us. Hot summer, longer summer apparently. B. Tyagarajan joins us for that. Towards the end of the program, Lata is at the Morgan Stanley's investor conference. She speaks with Chetan Iyer about RBI rupee rates and, of course, the rest of Asia.
Time for a quick break. We've got a lot of stock-specific action we're going to be focusing on the other side in our special Top 10 segment. Let me run you through the list. Two stocks reacting to positive news flow. Hero MotoCorp and oil producers. On the flip side, NTPC, Coal India, Acme Solar. They'll be reacting to negative news flow. Add to the list, NHPC, Alchem Laboratories, Ola Electric, OMCs, and City Gas Distribution Companies. Some fundraising as well in there. I'll tell you what. Take that break, come back. We'll run you through all of those details. Stay with us.
Welcome back. It's a Tuesday morning. You're with us watching Bazaar Morning Call on CNBC TV 18. It's been tough few days for our markets, challenging. The Nifty yesterday closed with a cut of about 165 points, ending below the 23,400 mark. The FIs have been selling. And this morning, the GIFT Nifty suggests another downtake. But what about stocks? Our research team is standing by with CNBC TV 18's list of top stocks for the day. Sudarshan first joins in with Hero MotoCorp May sales numbers.
Good set of numbers that Hero MotoCorp has reported for the month of May, and scooterization trend continues, and it continues to lead the growth for the entire company. And even in the motorcycle front, company has reported a double-digit growth. If you talk about the domestic numbers, motorcycle segment has seen a growth of almost 9.8%, and scooter segment has seen a double-digit growth. So total sales have increased by 12% to 5.70 lakh units. Our expectation was around 5.65 lakh units. Domestic sales are up 10%, and exports, though contribution is very minimal to the total sales, but exports have increased by 78%. Motorcycle sales up 6%. Scooter sales continue to see a double-digit growth. Electric two-wheeler registrations have been seeing a significant increase over the last few months, and this month too, it has seen a growth of 166% for Hero Motors brand, that's VIDA. Now, growth was led by 125cc segment, and that was Deluxe 125cc, premium motorcycle and scooter. Also, all these three have seen double-digit growth. And as far as the new launch is concerned, company has recently launched Super Splendor XTC 2.0. That's in 125cc segment. Remember, 125cc is the segment which has been seeing a maximum demand as far as the motorcycle is concerned. So on the basis of May month numbers, I'm going with grey.
Got it, sir. Good to hear that you're going with green on that one. I'm going with two stocks in the red, and both of them actually were very, very strong in yesterday's trading session. NTPC and Coal India. Let's start off with the NMDC. The production number for the month of May was good. That was up by close to around 20%. However, the sales number or the dispatch number was a little bit disappointing because offtake was down by close to around 7% on a year-on-year basis. The reason for that dip is not Chhattisgarh, which is a larger proportion of their total sales, but Karnataka. The entire miss is because Karnataka volumes came down to around 700,000, which compares with around 1.34 million tons. So that's nearly half of what we have seen, on a year-on-year basis. And, I spoke to a couple of people, and I believe the contractor there is changing, the mining contractor as well is changing, and there are some administrative procedural issues that are taking place, which hampered the sales number in the month of May. And now they're working on resolving it. So they believe that it's more, a near-term phenomena and things will recover. But for the time being, because of a weaker sales number, going with red out there. On Coal India, yesterday it had a very, very good run. And they've fixed one part of the problem, which is offtake. Yesterday, we got news that the offtake was up by close to 2.2% on a week base. That's the best sales growth in percentage terms all the way since August 2025. It's a meager 2.2%. So they fixed one part of the puzzle. The other part is a little bit worrying because in a scenario where global coal prices are spiking up, the e-auction over notified price, in fact, is not moving up. It's only 36% odd. The street would like that number to go to around 50%. So some bit of a disappointment out there. So going with red, even on Coal India, because e-auction premium hasn't gone up by as much. But hopping across to Vinny, she's here to tell us about some more stocks that are on the news. Hey, Vinny, morning.
Hi, good morning. So first up, let's talk about Acme Solar. We are expecting Reddy. This is a CNBC TV18 news break that has been confirmed. They are launching their QIP to raise funds. The company will look to raise around 2,800 crores via this QIP. The base size of this is 2,600 crores. Additional green shoe option is of 200 crores. Indicative issue price of this is 279.50 rupees, which is an implied discount of around 9% that we could say. And there's an equity dilution of around 11.82% of the pre-issue outstanding equity share capital that is there. So we could expect red here. Apart from that, we're seeing NHPC that is red expected here as well. There's an OFS that has been launched here. Base offer of this is 3% of the equity. Additional 3% is for green shoe option as well. Floor price of this is fixed at 71 rupees. And 2 days, obviously, 2nd and 3rd of June, non-retail and retail investors can participate. Apart from this, what is also in terms of details for NHPC is that the base issue size of this is 2,139 crore rupees. And total issue size, including the green shoe option, would be around 4,279 rupees. Next up, we have Alchem Labs. That's also in focus. We're expecting red here as well. And this is there's a block that has been launched. What we understand is that the promoter group is and proponent entity is looking to sell this. The offer size of this is around 936 to 956 crore rupees. Floor price is around 5,200 rupees per share, which is approximately a 2% discount from yesterday's share price of around 5,300 crores as well. 5,300 rupees per share as well. And lastly, Ola Electric. What we are understanding, the sources say that QIP has been launched for fundraise of around 500 crores. Floor price of this is around 37.74 rupees. Indicative issue price is 35.86 rupees, which is a 9% discount as well. So keep an eye out on this one.
Thank you very much for that. We have seen a surge in the offer for sale and equity supply picking up in the market once the earnings season has come to an end. It was Coal India last week, and today it is NHPC and a couple of other private companies. Thank you, Vinny, for that. Manisha is now joining in for a quick update on crude prices. Manisha.
Well, thank you so much for that. It's been a very sharp surge in the overnight markets when it comes to the crude oil prices, 4% higher, and we are trading in the positive right now as well. The peace talks between US and Iran are showing little progress, and that is why the geopolitical premium is back in case of prices. There is a lot of statements coming in from Iran media which said that Iran is looking to suspend communications with Washington. This is in response to Israel's strikes in Lebanon. We have seen similar statements coming in from Israel as well. And then there is Iran media also suggesting that Iran and regional allies are considering a full closure of Strait of Hormuz and the Bab el-Mandeb Strait. Now that really seems to be a bit of a concern because when you look at this is the alternate route for Red Sea and Cape of Good Hope. So this is something that the markets are really getting worried about. The crude prices, remember, did decline 19% in the month of May, the biggest monthly decline since March 2020. June has started on a bigger note, and then we are also looking at peace agreements not falling through. And that is what is bothering the markets right now. The street does believe that at these current levels, you could be looking at higher prices from here on. You have Bernstein, Goldman Sachs, yet again suggesting that $100 and plus kind of levels is what is possible in the month of June itself.
Who would have thought, right, Manisha? Two important waterways for energy. One, of course, closed, and the other, perhaps, at the risk of closure. And that's an important one as well. That's essentially, you got Saudi on one side and Yemen on the other side, right?
It is.
Yeah.
And it is a bigger waterway as well, especially when it comes to European markets. And Prashant, not just crude, you will see an impact of that across commodities from coal to iron ore to agriculture. And overnight, we've seen almost everything surge quite strongly. So not just crude, but various other commodities are going to get impacted as well.
Yeah, if it does sort of come to it.
Yeah.
So we'll see. Thank you very much, Manisha, for that. And that's basically, the Houthis in Yemen. And the suspicion, of course, always points to Iran, that's backed by Iran. That the Houthis may sort of effect that closure if it came to that. So we'll see. But oil prices, they're off. They're at 95. They're off 98, which was the high. But the point is, from yesterday's level, they're maybe a little higher. So, and that's what I think markets are reflecting as well. I think we'll just take a quick commercial break here. A quick recap of stocks with positive news flow. So Hero, which reported numbers. Oil producers, of course, oil's up a little bit. NMDC, Coal India, Acme Solar are some of the names. NHPC, Alchem, Ola, more red than green. OMC, City Gas Distribution Company. So all of that we will focus on. We'll just take a quick commercial break here. We'll come back. Pankaj Murarka of Renaissance Investment Managers to talk about all of this and what he likes in the market. What is he doing on the other side? Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC TV 18, and the gift Nifty is suggesting a bit of an ugly start. Remember, last couple of trading sessions were pulled back close to around 600 points, and this morning again, another 200 points to contend with. We have Pankaj Murarka, CEO and CIO at Renaissance Investment Managers, who joins us on the show. Hi, Pankaj. Good morning. Thanks for joining in today. What are you making of entire market setup? And in the last couple of days, both globally as well as in our markets, the tech stocks have made a bit of a comeback. What's your view on that space in particular?
Morning, Nigel. As you rightly said, I think that the whole AI resurgence in terms of investments in infrastructure is really surprising us on the upside, and the incremental data point that we keep seeing every day globally is just is one step ahead of whatever the base case has been. The fact remains, overnight we saw now Google, which used to generate $150 billion of free cash, is raising $80 billion of equity funds to fund their AI capex. So I think, and I've read some reports where we're talking about aggregate AI investments aggregating to something like $7 trillion over the next 5 years. So I think that whole AI resurgence or investments is probably something probably very unprecedented. What we've seen also is, I think, in the first quarter of the year, we've seen that software stocks were beaten down very badly on the fear that probably AI will hurt these companies badly. And I think now, after having seen results from Snowflakes and Workday and some partnerships that some of these companies have done with, the LLMs, probably that fear is receding, and which is where we're seeing a strong rebound in software stocks that we've seen over the last few days or last week or so. And I think that will continue. And I consequently believe that Indian IT services will be a beneficiary of that as well. That whole narrative or fear-driven selling probably is receding, I would guess.
Pankaj, there has been a stealth bull market taking place in many of these HVDC power transmission companies. Hitachi Energy, GE Vernova. Do you have a view? Do you think if someone buys at current levels, they can make money? How long are the valuations? Can the valuations be justified to make a current entry point?
You can't justify these companies now on traditional valuation metrics. They are in a different orbit altogether. Now, the question is how long, what is the longevity of the growth that these companies are going to witness? And obviously, there are a lot of assumptions here in terms of, as I said, we're talking about 7.5 trillion, 100 gigawatts of hyperscaler data center capacity in the US at about $70 billion dollars per gigawatt, $7.5 trillion over the next 6-7 years. Will that be executed or not? If the answer is yes, and then probably these companies have more runway. Obviously, there are question marks about, meaning it just rings a bell in my mind about the whole telecom infrastructure build out or optical fiber build out in 95 when internet happened. Markets have a tendency to, industry has a tendency to overbuild capacity. So are we overbuilding it? And whether a lot of this investment that is happening can be today, on a rational basis, you cannot justify a lot of these investments on ROI basis. So coming back to our markets in terms of HVDC, CAPEX and what these companies are witnessing, meaning they are in a different orbit. Meaning I would reckon, we cannot use traditional valuation metrics now. But for people who are holding them, I think probably stay invested for a while.
Pankaj, morning. Just a here and now kind of question, right? When the GIFT Nifty is indicating another 180, 190 point lower start. Why, the mood's kind of bad, and especially when you see headlines like Korea has overtaken India, and it's almost a consensus now that maybe this entire thing needs to, the outperformance, the AI dragging everything higher, which is memory and chips and everything, right? I mean, that needs to cool off for India to start to do well. I don't know how you think about it.
Prashant, Starkling, Korea is a $1.9 trillion economy. And now, in context, India is a $4.2 trillion economy, and they have a market cap higher than that. So that reflects how markets are pricing. Obviously, meaning they are a big beneficiary of memory chips. Two companies are dominant there, SK Hynix and Samsung, and having a disproportionate impact in terms of returns. The markets are up 86% in the last 1 year. So, but I still believe that probably there'll be a mean reversion some point of time where probably India's growth story is far more sustainable, while we do not have, we are not beneficiaries of the investments into AI hardware or infrastructure. But when it comes to diffusion of AI, Indian IT services have a significant role to play. Near term, there's been impact because of compression on the revenues, but medium term, they'll be a big beneficiary of that. So I think some point of time, there'll be mean revision. I would like to call out this is another extreme in that sense, Prashant.
Yeah, I certainly hope so. It's an extreme. Pankaj, give us a few ideas to chew over, whatever you want to call it. which you think are really attractive at this point? Not investment advice, but just like, things to think over.
My view would be take a 3-year view on India and in equity markets, and I find pockets of markets where I find a lot of value. Some of these investments might not yield returns in the immediate term. As it is, if you step back and look at the markets are extremely polarized. On the breadth of the market has become very narrow. So I think, and as a consequence, there are pockets of markets where I find a lot of value. IT services is clearly one of them. Stocks have been beaten down. Valuations are, at a point where we saw during 2008 financial crisis. So obviously, there's a lot of pessimism that is built into these companies. While this year's growth is moderate, but I think if all of this AI investments has to yield results or yield ROI, then it can only happen through enterprise adoption. And if that were to happen, then Indian IT companies will be a big beneficiary of that. So stocks are trading at significant discount to the index and are trading at on a DCF basis. Now these companies are pricing in probably very low growth, probably 1-2% growth over the next 15 years. So they're almost like eggs growth in that sense in terms of what these companies are pricing in. So I find a lot of value there. Likewise, I find autos are poised for a cyclical uptick because I think the GST cut that we had last year was a big trigger. While there are near-term headwinds in terms of rising fuel prices, but I think eventually we'll get a deal on hand between US and Iran, and oil price will settle at level.
Pankaj, if I can just sort of come in there, just stay with us. Walkout management on the US FTA approval. My colleague Ekta caught up with Habil Khurakiwala. Listen in.
I think it will take us another 4 to 6 months. So for practical purpose, before the end of the year or early next year, we will be launching Zenith in the US market.
Okay. What is the kind of opportunity that you see from Zenith in the US?
I think we have a fairly large number of multi-drug resistance. And one of the unique advantages of Zenith is it works in all gram-negative organisms. So from that point of view, we expect fairly good potential. So, and normally what happens in a new molecule, that initially you have to get every hospital to approve the product. And the doctor has to have the experience of the product. And slowly it picks up. So it takes a little while in the beginning to get it reflected in sales. But once they start using it, then it's like a hockey stick. Then after a year and a half, the sales start zooming.
Just give us an assessment in what conditions this particular drug is used, Zenith. It is only going to be in ICU settings, and it's only going to be for conditions where no other antibiotic has worked. It's the last resort drug.
It is definitely in most cases, it's in ICU setting. And there are a number of other drugs, new drugs in the market that they have a limited effectiveness against one pathogen, generally, 1 or 2 pathogens. Whereas Zenith covers all the pathogen in a gram-negative space. Second, it is a bactericidal drug, and therefore it acts very fast. So collectively, the clinical outcome is far superior with Zenith than the other existing product, and that is a product advantage. And we hope that it helps in reducing hospital time as far as the patient is concerned.
Okay. Just wanted to understand, because it's an antibiotic and because of antimicrobial resistance, I'm assuming that this would be the last resort drug that would be used.
It is definitely a last resort drug, but sometimes if your clinical conditions are such that doctor would prefer, based on their clinical perception, to use the drug little earlier because every day's delay increased mortality by about 20%.
Okay. Just tell us about the compassionate use cases which took place in the US and the success rate.
We had overall 80 plus compassionate use cases. 6 of them were in US, the rest were in India and 1 in France. And in all cases, we had a success rate of about 90%, over 90%. And the other cases where the patients initiated our treatment very late because of the process and it being a new product. That's why in some of the cases, we lost a patient.
Okay. You had earlier guided for around a $1 to $2 billion opportunity from this drug, from Zanuck globally. Does that still stand?
Yeah, definitely it stands.
Okay. You had also indicated around 40% of that would come in from the US market. So I'm assuming $400 to $800 million in terms of a assessment of in terms of sales is what you're assuming right now from the US.
Yeah, that is generally so that the US contributes around 40-45% of the global opportunities. So we do expect at least 40-45% will come from the US market.
Are you talking about this on an annual basis, or do you think that this will be the peak sales that you'll hit?
Oh, this will be the peak sale, basically. It will not come initially in the first year or so. Yeah. But over the years, as the usage increases and doctor gets familiar with the molecule and where to use it and how to use it, and that is how a new molecule gets picked up year on year, then you get a much faster growth after initial 12-18 months period.
Okay. So what is the competition like? Is there any other antibiotic which might be in the pipeline which could give you competition? And what is the patent that you have on this drug?
Our patent is up to 38. So it's more than 10 years of patent life we have as of today. And as far as the new drugs are concerned, we do not see any in the pipeline, the new drugs there, but there are already some drugs which are used in some of the multi-drug resistant cases in the United States and elsewhere also. So that would be part of the competition.
Beyond UTIs, can this drug be used for any other condition in the US now?
It is being approved by US FDA in CUTI. So as far as the company is concerned, it would be for CUTI. We are also undertaking clinical trial for HCLTech, that is the lung infection, pneumonia, serious lung infection. So once that clinical trial is over, in about 2 years' time, then that would be an initial indication.
Interesting one there. Wockhardt Management speaking to our very own Ekta Batra. Well, time to slip into a short break. On the other side, we'll continue our conversation with Pankaj Murarka of Renaissance Investment Managers. We'll also get in our technical experts. Sudarshan and Sachidanand are waiting for you.
Okay, welcome back. That's the Walcott management earlier with us. There's some flashes at the bottom of the screen with regards to, what's happening with respect to the Tata Group. Tata Sons approving a large amount of investment into the digital businesses of Tata. Noel Tata, of course, raising concerns about the investment, the growth outlook, the projected losses. So we'll have more on this come up a little later. But I think it's an important story, highlights what's happening within the Tata Group and the disagreement with respect to some of the underperforming businesses. And of course, and on the digital side, Tata's, of course, as they continue to invest to build scale, returns have been hard to come by. And I think that is essentially the friction point. But this is, I guess, one of the many situations where there is disagreement brewing within the Tata Group at this point. Pankaj Murarka is with us. And Pankaj, thanks for staying on while we were on that Walcott management commentary. And I interrupted you there because we had to go across to it. But do complete the point. My question to you was a few ideas to chew over. You said, well, there are many, and take a 3-year view. So let's pick it up from that point. So you were telling us the 3 ideas.
Sure. So as I said, Prashant, IT services looks pretty good. I find quite a value there in the sector. Apart from that, autos look pretty, attractive from a medium-term perspective. They're near-term headwinds in terms of fuel prices. But as I said, I believe probably some point of time in the next few weeks or so, we get over this deal and oil price eventually will be much lower than where they are today. And the underlying demand momentum in autos remains pretty healthy. Apart from that, what we're really seeing is, apart from sectoral bets, what we're seeing is themes doing well. So clearly, some of these themes in terms of EV is a big theme because we know directionally penetration of EVs will increase significantly. And in the EV value chain, you have opportunities across both autos and auto ancillaries. And likewise, I think energy will be a big theme going forward because, given now what has happened and the world is awakened to the challenge of oil, I see significant investments happening in India within the whole energy ecosystem. So, and there are parts of energy ecosystem which are very extremely richly priced, as we were discussing earlier, the likes of GE, T&D and Hitachi, but there are other parts which are more reasonably valued. So I think there's still opportunities in the energy ecosystem.
Plus, in the energy ecosystem, the reasonably valued theme stocks?
Utilities are still reasonably priced, Ekta, I would say. And then we have companies in the whole, renewable energy ecosystem where I think the runway is reasonably long. And probably some of those companies look attractive in that sense from a slightly more medium-term perspective.
Yeah. Autos, when you said those are EV names or this, like passenger vehicles, you said you're expecting a strong uptick. That's passenger cars, two-wheelers, everything, or something on the EV side?
Well, I remain positive on both passenger vehicles and commercial vehicles. The demand for commercial vehicles still remains resilient, and given the strong investment momentum across mining and infrastructure, that was a big driver of growth for commercial vehicles. So that looks pretty healthy. The demand outlook there remains pretty healthy. And likewise, on the passenger vehicle side, after a very long time, we're seeing, emergence of pent-up demand because the industry went through a very, sort of a very muddled or a slow growth for almost 3 years between 2022 and 25. Despite these headwinds in terms of some rise in prices that the auto companies are taking and some fuel price hike, the underlying demand remains very resilient, meaning Maruti talks about a order book of 190,000 cars. There's a wait list on some models, which is 4 to 6 weeks. That reflects that the underlying momentum or demand is very healthy.
Yeah. Got that. So it's IT, it's autos, and it's some energy names, basically. Yeah.
Yeah, that's right.
Yeah, and financials as a bank.
Financials.
Yeah.
Yeah. Financials remains the largest exposure for us in our portfolios, and also because the highest weight they have in the index. I think I like financials quite a bit. I think some of the larger banks in India are now relatively inexpensive. And I've said this, I think we see loan growth improving this year from 12-13%, probably heading towards 15-16% this year, the larger banks in India are in great shape in terms of the balance sheet quality, and valuations are very inexpensive. Valuations are inexpensive. So clearly they look pretty attractive, I would say.
All right. We leave it there. Thank you very much, Pankaj, for staying on through the last 20 minutes or so. Appreciate your time here on CNBC TV 18, and good to get that view. Well, let's just get Hormuz in with the big movers from yesterday, which saw large volume-led activity as well. Hormuz, take it away.
Right, Prashant, morning. The highlight of yesterday's session was that even as the losers fell on significantly high volumes, those that bucked the trend did not do so on the volumes front. Take a look at Inox Wind. The stock was down 10% yesterday. It was the biggest single-day fall that the stock had since June of 2024. And in fact, the stock over the last 8 sessions, the stock has declined in 7 of those. And in fact, on the FNO side as well, the premiums on the June series 85 put option, that went up by almost 150% in yesterday's trade. The volumes on Monday were the highest in over 3 months. Over 5 crore shares were traded. The 20-day average was just around 1.5 crore, and almost a quarter of those were marked for delivery. So around 1.5 crore shares for delivery. The 20-day average of around 58 lakh, and it's been an underperformer this year, down around 32%. And from its 52-week high, which is close to 200 rupees, the stock is down almost 60% from those levels. Now, MTAR Tech, you were mentioning this during closing as well. The stock was down around 8-9%. Now, the stock declined in 4 out of the last 5 sessions, although the declines that happened were on subpar volumes. They were not very significant. The 20.5 lakh shares were traded. The 20-day average was only 21 lakh shares, and 21% of those were marked for delivery. Of course, there are certain days in between this 20-day period where there were outsized volumes, which is why the 20-day volumes look elevated. And the 4.5 lakh shares were marked for delivery. The 20-day average of around 3.5 lakh shares. And despite that fall yesterday, the stock is still up 200% this year so far. Infosys was one name among the IT names, of course, that bucked the trend yesterday. The top gainer on the Nifty. The 2 days of gains, they were following a 6-day losing streak. The 1200 call option yesterday was the most traded on Monday. The premiums went up by almost 56% on that option. 2 crore shares were traded. The 20-day average here too is on par, around 1.5 crore. Around 43% of those shares were marked for delivery, and around 80 lakh shares for delivery. The 20-day average again at par, around 87 lakh shares, and it was the 3rd most traded stock on the Nifty 500 on Monday. And despite some recovery that is being seen from the lows, the stock is still down around 25% for the year.
Thank you very much for that. Infosys had hit its 52-week low just in the middle of May at 1,089, and from that level we have seen a bit of a recovery in that. Yesterday was a big mover. Thank you very much for that. Sudarshan now joins in for the brokerage calls of the day.
Morgan has come out with a note on Reliance Industries. It maintains overweight call with a target price of 1,660 rupees per share. It believes that company should benefit from continued strength in its refining petchem spreads, and also because of weaker rupee against dollar. As far as the valuation is concerned, it continues to find it reasonable, and commissioning of new energy businesses will be a likely catalyst in FY27 for Reliance Industries. Next one is Lenscard. CLSA has initiated coverage with an outperform call, and target here is 604 rupees per share. It says company is well positioned to cater to affluent, urban and emerging cohorts, and also having affordable products as far as the mass segment is concerned. It's well placed to expand its India store network while maintaining store economics and product margin and operating leverage to drive India profitability, and international business profitability too has been improving over the last few years. Last one is Z Entertainment, which has bagged FIFA World Cup rights for the next 2 World Cups. CLSA has come out with a note, maintains outperform call, and target price here is 125 rupees per share. Company has bagged FIFA's 39 global football events rights to broadcast and stream in India. Considering FIFA being a global sport, this win, as per CLSA, will enable company to strengthen presence in sports advertising as far as and subscription is concerned. And also, company has likely won FIFA rights at valuation under $60 million, which is lower than what peer had paid for FIFA World Cup 2022. So CLSA is positive on Z Entertainment, and target price is more than 100 rupees per share.
Thank you very much for that. Z was a big mover yesterday, large volumes. Thank you, Sudarshan, for that. Get into a break. On the other side, pre-opening rates coming up. We'll also be joined by Gunjan Prithyani of BofA Global Research to put the spotlight on the auto sector. Stay tuned. Welcome back. It's time now to get in a few technical trading ideas. Sudarshan Sakhani, Sachidanand Utekar of Trade Bulls are now joining in on the show. Sudarshan, let me begin with you. A tough few trading sessions. Are you sensing a bit of a breakdown? What's the advice?
Yeah, good morning. I think the trend which is down is likely to persist till we find some kind of an exhaustion. And obviously, we don't know when that will happen. But I'm assuming that the strong momentum cannot continue on the downside. So perhaps we'll find some exhaustion, some kind of a beginning of a base building either today or tomorrow. But we'll have to see that before we can take a position. So as of now, the best strategy is to step aside. Do not try to do any bottom fishing. This is not a market where you want to do that. We want to see markets stabilize before thinking of any trade. So for the time being, step aside.
Nifty in a no trade zone now for now. Wait for base building. Sachidanand, you want to come in? What's the Nifty call?
Good morning, Rima. Good morning to all the panelists. Clearly, I think the Nifty saw a very strong reaction at 24,000 levels. And, we saw that particular gap at 24,000 on 8th of May. So it has been a rejection gap. And on the lower side, we still have a very strong support gap, which was created on 8th of April, near to that 23,150 mark. Now, if you look at the overall data set for the day, the way the implied opening is positioned, there is a sign of support or an expectation of support somewhere close to around 23,200, 23,150. Being the 60 minutes in an oversold condition, I think any slippages towards this particular zone will again provide a good opportunity to create some contra longs. So the bias for the Nifty still remains negative, but if you look at the 60 minutes chart, there could be an extreme case scenario wherein some long positions can be committed. The stop loss should be placed at around 23,140 on closing basis, and we may see a rebound towards 23,300, 340 during the day.
Got it. Okay, all right, Sachi, got that. Sudarshan, you know what? A lot of viewers would have been hoping for whether or not it's the brave day. For now, you're saying no. Step aside, the take is not on the index, but you'll have a couple of trading ideas for us. So please give us that.
Yeah, that's a mix. Exide is a buy with a stop under 385. TCS, that sector is doing its own thing, is a buy with a stop under 2250. NTPC is a short with a stop above 385. And United Spirits is a short with a stop above 1280. So stocks sometimes give opportunities, but I have already explained the index is a no-go.
Got it. Sachidanand, what about you?
Good morning, Nigel. Nigel, I have three trading ideas, two on the long side, one on the short side. The first one being Coal India, wherein we have already seen a very strong outperformance in yesterday's trading session. We saw a breakout from a 15 days consolidation. There is a bullish flag formation, which is indicating continued strength, which could be witnessed and push the stock towards 495. The stop loss for the trade can be placed at 466 on closing basis, and fresh long positions can be committed for a target of around 495. The second stock on our radar has been NTPC Infotech, which is LTM. Even here, if you look at the overall construct, there is a base building action somewhere close to around 4100. We have seen a bullish crossover on its 5 and 20 exponential moving averages, and the RSI has already moved above that 50 mark. So we are expecting some positive surprise on this particular counter. We are expecting a move towards 4380. The stop loss for the trade should be placed at 4120 on closing basis. And on the short side, Adani Ports, after a very good, strong outperformance, is showing some weakness. We've already seen an engulfing bearish kind of formation on its daily scale. There's a negative divergence on its daily RSI, and hence we believe that there could be a swift move towards 1740, 1745 kind of a zone. So fresh short positions are recommended in Adani Ports. One can keep a stop loss at 1805 on closing basis.
Got that. Just a quick word, if you will, Sudarshan, on the IT stocks, right? I mean, I was just looking, the Nifty IT index is up a clean 10% from the lows. It's still down 35% from the highs. What's your sense, Sudarshan? I mean, for the longest time, we've had sharp rebounds, but then eventually it gets sold into and then you make lower lows, right? That's been the structure for a while. The high was made, the all-time high was in December of 2024. But sometimes, by the time everyone notices, stocks or an index in this case is already up 10, 15%, and then people start to look at it. Do you believe, looking at the longer term structure, this has made a bottom now, the Nifty IT?
Well, I think the bottom may be in place, but it's too early to give a confirmation. The confirmation comes when we see a correction, and that correction, the lows of that correction hold much above the final lows of this decline. That will also come. This 10 or 12%, or even if we go to 15% rally, will eventually see a correction, and that decline will tell us if this is over. If it is over, it will be a buying opportunity of a decade.
I see. So you're saying you need a test of this once again, and that test, the index is going to pass that test. It's going to hold the lows, and then you basically get a confirmation. So that's the point.
That's right. That's right. That's
okay, so this is still early. That's Sudarshan with the IT space. But, I just noticed clean 10% bounce off the absolute close that we saw in the middle of last month. But I think, Rima, we have our guest from Bank of America ready.
Indeed. Gunjan Prithyani, Senior Analyst, Automobiles, Auto Components at BofA Global Research, is now joining in from the sidelines of their India conference. Thank you very much for joining in. Great to chat with you, Gunjan. Let me begin with the entire EV theme. It's gaining a lot of traction, and many believe the energy shock that we're witnessing right now will lead to an inflection point. And the numbers are telling. Even a company like Ola Electric, for instance, has seen a 23%. Just as an example, I'm not asking you to comment on Ola Electric, but as a reference point, Ola Electric's sales in the month of May are up 23% on a month-on-month basis. The best monthly sales numbers we've seen in a while. Do you believe EV is at an inflection point? Is the street underestimating the sales growth? And is it a good buying opportunity? And if yes, how would you buy it?
Sure. Thanks, Rima, for having me. Yes, clearly EVs are seeing a pretty renewed interest now. We've seen a step up in the volumes, as you pointed out. I think there are two things here. One, of course, is the whole fuel inflation, which is sort of driving the push towards more greener options, and both CNG as well as EVs have seen a sharp jump in the bookings and inquiries over the last couple of months. I think also the other point which gets less spoken about is the number of new launches that we've seen on EVs now. Practically every listed company now has an EV model in their dealership. So I think more than the fuel inflation, which is more recent, it's also the model excitement and features that are coming through, which is driving the expansion of the category. Moving to the second point that you made, that every company is sort of seeing huge scale up in volumes. I think it's actually a supply side constraint right now. I mean, every company is actually struggling to meet the demand. So there is clearly a ramp up of capacity that every listed company is pursuing right now on the EV side. So it does feel there is a lot more momentum to go. Having said that, it is still restricted to a few sub-segments. It's more premium SUVs in passenger vehicle space, and it's mainly scooters and two-wheelers. So still not a massification of EVs, but certainly seeing renewed interest for now.
Gunjan, hi, morning. Prashant here. Just a quick word on, the space, right? Right now, the bigger question is, there's a bull market on in some spaces, but it perhaps eludes many other areas. So whenever this thing turns at a top-down level and there's foreign interest, etc., what are the kind of questions you're hearing? How are ownership levels across auto stocks, and how is it looking generally? How is the sector positioned?
Sure, Prashant. You absolutely are, you hit the nail on the point. Essentially, what you're seeing right now is, the demand is extremely resilient. Having said that, there are two sort of growth risks that the investors need to navigate. One is the margin risk, which is very well spoken through this reporting season, and to some extent also led to earnings downgrades for the sector. The second risk is the growth risk, which is essentially due to the affordability hit that we may see due to fuel price inflation as well as the vehicle price inflation. I don't think the growth reset or a growth hit is as of now a base case for investors. So in that sense, if we do see deceleration in growth in second half of the year, we could see more earnings downgrades for the sector. So as of now, margin risk seems priced in. Growth for now seems to be holding up fine. So we'll have to see how the second half unfolds. Certainly, I would think that the risk reward is not so straightforward for the sector anymore. It would rather be a more bottom-up stock-specific approach that investors will have to navigate.
Hi, Gunjan. Good morning. Good to see you in. Missed meeting you in person today, at the conference, but good to have you on the show. Gunjan, I'm looking at your note and you're saying that FY27 PV growth guidance given by the OEMs appears more optimistic than industry growth outlook. Who do you think is best placed to actually meet their guidance and who misses it by a margin?
Hi, Nigel. I'll of course not comment on the company specifically, but I think you can clearly see a lot of euphoria on the passenger vehicle space. The numbers, the guidance that most of the companies have spelled out is pretty much everyone is talking about double-digit growth. But when you look at the industry forecast, they're talking about 7 to 8%. So there's clearly a mismatch between what the listed companies are guiding as well, in contrast to the SIAM forecast. My sense is there are particularly a couple of companies which do have backlogs and had production constraint in first half of the year, either due to capacity constraint or transitory issues. As those ease in second half, there are few of those companies which have better visibility on volume growth. But passenger vehicle within all subsegments does sound a lot more euphoric in terms of the demand trends.
Okay, all right, Gunjan, just as I was getting into the show, I had a word with a couple of steel producers and OEMs and them, they normally get into this phase where they fix the prices higher for quarter one and quarter two. They either do it on a quarterly run rate or maybe sometimes on a half yearly and sometimes even on a monthly basis. What, according to you, have you penciled in with regard to higher steel, and the raw material basket itself for quarter one? Because you clearly mentioned that there could be some margin pressure as well. For that, they'll have to absorb some kind of price hike, which hasn't been done in the past quarter. So your take on that?
Sure. So, Nigel, of course, the margin risk is the biggest headwind that the sector is facing right now. I think on steel, it is a quarterly reset. It does seem like there could be anywhere between 5 to 10% inflation on steel in particular. But besides steel, it's pretty much the entire metal basket, be it aluminium, precious metals, which has seen a sharp rally. So, to put numbers in perspective, the raw material headwind for the sector is anywhere between 3 to 5 percentage points. This is quarter one versus quarter four, so incremental headwind. The price hikes taken by the players range somewhere between 2 to 2.5%. So there is clearly a gap that the companies will have to navigate through austerity measures, cost reduction programs. But I do think that it is difficult to cover up that gap, and we will see a severe hit onto the margins in quarter one. Having said that, I think I would also bring a point forward that margins in case of autos, when it comes due to metal inflation, is not really a structural issue. As the metals plateau out and some of these price hikes go through to the market, you do see normalization with a 2 to 3 quarter lag. So, I would look at it as first half being pretty much very weak on margins, but second half should see some normalization as the commodities start to plateau out.
Gunjan, you highlighted two risks for the auto sector just in the near to medium term. One is cost inflation, and you were talking about it, and two, higher fuel prices driving higher cost of ownership. What about the risk of a poor monsoon? IMD has already lowered the forecast from 92% to 90%. There is talk of a super El Nino. If that plays out, do you see, along with the risks that you've highlighted, a big impact on tractors or entry level or two-wheelers? What's the sensitivity looking like? And how much could growth estimates be moderated because of this monsoon risk?
So, Rima, on the tractor industry in particular, I do think we've gone through a super cycle for the last 2 years. There's already a pretty high base effect. And to that extent, if monsoons don't fare well, there is a risk to the industry in fiscal 27. Having said that, this is very widely debated among investors for last 6-9 months. So I don't think really it is an incremental big surprise to the investor community. I think what could incrementally be a negative surprise is if we start to see demand hit at the entry segment. The affordability hit, when you look at from the fuel price inflation as well as vehicle price inflation, it does matter a lot for entry vehicles, both in passenger vehicle and two-wheelers. So stepping back, GST was a big tailwind because you saw the total cost of ownership coming down. But given the way the price hikes are coming through, there is some risk at the entry end. While premiumization as a theme sort of remains intact for now.
The other interesting thing that I picked from your report is talking about the steps taking in this entire energy security. So in terms of ethanol blending in fuel, we're already at 20%. But recently there were articles about potentially even going up to 85%. So these could be policy steps that the government could look to take eventually. What are your thoughts? Have you actually picked up the intent from the government towards going drastically to 85%? Because that's a big step change in the architecture, from the pump's point of view, storage point of view. And you also cite the example of Brazil in one of your reports. For the benefit of our viewers, take us through the thought process behind this.
Sure, Rima. So ethanol, clearly, when you look at on paper, it is a promising policy tool, addresses practically all the issues that the government needs to look at from an energy diversification perspective. Having said that, I think there are clearly 3 constraints that the policymakers will have to think through for the adoption of flex fuels. I think first and foremost, the auto industry will need to upgrade the engine and also recalibrate the various auto parts to be able to be compliant with flex fuel vehicles. That will mean some cost inflation. Second, you will need OMCs to roll out separate infrastructure, both in terms of distribution and storage for the blended fuel. And third is the most important. I think customer adoption will only happen when it starts to make sense in terms of fuel economics. So the main point here is that ethanol is about 25 to 30% less energy efficient, and in that will lead to some fuel efficiency loss, which is where I think government will have to look through the fuel pricing or give a demand incentive to drive adoption of flex fuels. Hence, I don't think that E85 or flex fuel is practical in the immediate term. What could actually play out is a more calibrated gains on the ethanol. And there have to be some policy enablers in terms of either fuel price economics or demand incentives that will drive the adoption.
Yeah, Gunjan, good luck at the conference. Wish you have a productive one and appreciate your time here on CNBC TV 18. Thanks very much. All right, well, 9:10 calls. There's not 9:10, 9:14. So I think we have 30 seconds to get through this. Sudarshan is back with us. Sudarshan, what do you have?
Exide Industries, buy Exide with a stop under 385.
Okay, Exide is the call from Sudarshan. There's a couple of seconds to go for market open. So I think we'll stay with prices. 150 down on the Nifty, about 320 down on the Sensex. And, it's a lower start once again. It's not turning out to be a great week, right? I mean, and it started, of course, with Friday and the sell-off, and it's sort of continued yesterday. And let's see if there's any reprieve today after the lower start. First rates should start to come up, and then we will take it from there. So that's the opening bell. We've got 23,270, 23,270 on the Nifty. Basically, you're right at the, lower the upper end of the gap which was made. I think this was in April, so you're back to those levels once again. If you just want to see where we find ourselves at, so yeah, it's sort of fallen through, I think, those levels, or right about there now. 23,260 is where the Nifty is at. Nifty Bank is down about 0.8%, 53,200. So that's down. Mid-cap index is down 0.6. The small-cap index is down, and at least starting lower at this point in time. So 870 down and about 500 higher. That's the declines to advances ratio, but this is just very, very early. It's all IT which is jumping. Infosys, TCS, HCLTech, Tech Mahindra, Wipro. It is the top 5 gainer. There's the top 5 gainers of the Nifty. Hindalco, JSW Steel, and Tata Consumer, the others, and everything else is in the red. So 120 lower on the Nifty, and 23,250 on the index itself. Rima.
Well, IT once again. In fact, even in the US, you are seeing buying coming through in software names. So overnight, NVIDIA, of course, was higher, but ServiceNow had a gain of 9%. IBM rallied 8%. HP was a big mover with an 8.5% rally. So that up move which you're seeing in software names in the US is translating into services names out here. And you go down the curve, even in the IT names, you've got gains coming through in LTM, Oracle Financial. So Oracle Financial is one of the few listed companies in India which is a products company catering to the banking space, the BFSI sector. So unlike the large cap, mid cap IT, which is predominantly services, Oracle Financial Services, OFSS, is product, persistent Coforge, Emphasis. They've been outperformers and they're seeing some buying today. So the top gainers include IT, top 4. If you go down, you've got JSW Steel and Hindalco. They're managing a little bit of a green for themselves this morning. On the way down then, it's a much longer list. Bajaj Finance is the top loser, 3% down. Eternal seeing selling pressure. You've got cuts in many pharma names, hospitals, pharma, so Apollo Hospitals, Dr. Reddy, Cipla losing in trade. Auto names like Maruti Suzuki under pressure. Shriram Finance is NBFC. Along with that, we spoke about Bajaj Finance, Bajaj FinServ. So NBFC facing the brunt of the weakness today. Along with that, the Nifty Banking Index, which has lost another 500% in today's trade. Very few places to hide, Nigel, barring an IT once again.
Well, that's right. Sterlite Technology is a stock that moved one way from around 300 all the way to closer to 590 rupees the first tick was. And from the top, someone has sold a little bit. So that's why after moving from circuit to circuit, Sterlite Technologies has, the circuit got released on that one. From, I think, it moved from 591, it made a day's low, I think, much lower than that, fell close to around, it fell $50 from the top, but someone has lapped into it again. So that's a stock that's finally come off the circuit, but appears it's moving back into the circuit mode. NHPC, well, that one's lower because of the fundraising, as is the case with Ola. NHPC is interesting because they're offering a discount. There's a dividend yield and then valuation's pretty okay at the base price. So let's see how demand shapes up out there. Anand Raj, good news coming in. That stock is flying away on rather large volumes. NIT, that's the other stock, in fact, that's doing well. So good up move is what you're seeing on NIT as well in today's trading session. And Uflex is the other name that's actually opened up in the green. On the flip side, Supriya Life, stock that went one way up, that one in fact has come in for profit taking. I recall post its numbers. Supriya Life, I think, was up 20% when the management had joined us. Today it's giving up close to around 6.5% of those gains. I'll tell you what, with the markets down 140 points odd, maybe just in the near term, risk reward could favor a bit of a relief rally because the fall has been very sharp. And so let's see, at around, I think the day's low is around 23,225 or thereabouts. So I think that's going to be important that we defend. And maybe, in fact, with the PCR down, shots in the system, the kind of fall that we're seeing, maybe risk reward could trigger a bit of a relief rally. Weekly expiry though.
100 points lower, so there is a bit of a recovery afoot at this point in time. Anand Raj is, of course, making a move right now. So 23,280 is where we find ourselves at. We have Lawrence Belanco now joining in. He is, of course, with CLSA, and he's someone who tracks technicals, much sought after opinion and views. Lawrence, welcome back to the program. Thanks very much for being here on CNBC TV 18. So let's just start with outlining your views on the Nifty first. It looks like we've been stuck in this range for a long time, Lawrence. And now we're at the lower end of that range rather than the upper end. How is it looking? What's the structure telling you?
Yeah, unfortunately, lack of momentum has left us in this trading range that we've had for going on 24 months. And, that range is defined by the lower boundaries around the 22,000 to 22,300 and the upper boundary at that 26,000 to 26,300. And in the very near term, there is the 8th of April gap, which does give you some near-term support around the 23,200 area. So those are the levels that we're looking at. But in summary, a lack of momentum and, if anything, risk towards the bottom end of the range that we've seen over the past 24 months.
So the April, that's a 22,719 low, right? That was the gap area. So 22,800 roughly is where you're saying the near-term supports are at.
Yes, that's right.
Okay. If I were to ask you, what's the odds you'd put on that being broken and this being what's your sense, or do you think we're likely bouncing from somewhere here?
Base case is that we remain range bound here, and the price action since the 2024 highs is part of this digestion phase after the run up of the COVID lows. So this is sort of a longer term range that digests those gains that you had off the COVID lows. And ultimately, this should give us a platform for a major breakout through 26,300. But in the near term, we're not expecting any imminent breakout from this range. And there is short-term risk to trade towards that bottom end around the 22,300. So, that's the level that we'd look to bottom fish at. But, right now, there is just a lack of momentum when we look at the headline index.
Lack of momentum, lack of buying. Lawrence, that's what we can see in India. But since India's sentiment is linked to what happens with the global AI trade, what's your view on what's happening with the AI stocks or even countries or indices like the Kospi, Taiwan, which are so indexed to AI heavyweights? If you could give us a top-down view on AI and individual stocks. Yeah, go ahead.
Yeah, I understand. I mean, there's quite a bit of dispersion within US tech and within Asian tech too, with the Indian services names having been sort of big underperformers, you're getting a bit of a snapback now. But if I'll focus in on the North Asian and the SOX index in the US, which has been the lead part of technology since the March lows, we have started to see some evidence of slowing upside momentum. So the highs that we made last week in the SOX index, in the Kospi 200, as well as the TAIEX in Taiwan, have come with a lower momentum reading when we look at the 14-day RSI. And it's normally that signs of slowing upside momentum that tends to lead to a corrective trading range. Now, if I just stick to the price action since the 2025 lows, the SOX index has had 3 prior periods of slowing upside momentum that resulted in a trading range that developed over the next 2.5 to 3 months. So we do think that, the strong recovery of the March lows is approaching a point of exhaustion that should lead to a period of digestion and a consolidation developing in the SOX. And I think this is what's giving some fuel to the recovery in software. And it's also giving some fuel to the recovery in the Nifty IT sector itself, having been a big underperformer.
Do you have a view on the levels of Nifty IT?
Yes, so base case on the Nifty IT is that we've got a mean reversion trade playing out. We did get slowing downside momentum into the May lows. And if you just look at a mean reversion trade back to the 200-day, we still have another 12.5% upside for that rebound trade.
All right. Hi, Lawrence. Good to see you, Ben. A quick word with regard to the point you were making on Kospi as well as Taiwan. A bit of a divergence out there. And you said it's happened in the past, and normally we see some kind of a pullback. The last time this happened, what was the kind of pullback we saw?
Yeah, so if you look at the last pullback, it was into the February highs, and that was 15% for the Korean market. It was roughly 16% for the SOX index. If I look at the average decline, we've had 3 of those since the 2025 lows. We're looking at about 10 to 12%.
Okay, interesting. Let's see whether or not, finally we see some kind of a pullback on those markets because they have been running on steroids. You've given us the outlook with regard to the Nifty, but what about the mid-cap index? That's been in a world of its own. In a market that's actually been quite brittle for our headline index, the mid-cap index has relatively outperformed, even if you compare it to the time from when, this war has broken out. In fact, the mid-cap, the small-cap indices are higher, while our Nifty is 6-7% lower. What's your view on the Nifty mid-cap index?
Yeah, it's been one of our favorite parts of the Indian market. We did our outlook piece for 2026 in November last year, and we highlighted the Nifty mid-cap space, which had basically been consolidating since its 2024 highs. And, punching through the top end of this range, we think the Nifty mid-cap can continue to re-rate and remain a leadership part of the Indian market. And the breakout from the 24 to 26 trading range gives us roughly 30% upside. So that is a place that we would focus on. We would look for pullbacks that we get within the mid-cap space to look to add to exposure. And we think that leadership is intact and should remain in place into year-end.
So you're saying you'd buy into the mid-cap index or the mid-cap index constituents on pullbacks, right? And you see another 30% from here, from current levels.
Correct, yep. So look to add on pullbacks in the mid-cap space. We think it maintains leadership within the India market.
I see. What about small caps, Lawrence?
We see more work there. We've got that more in the trading range like the Nifty, so we haven't seen any conclusive breakout there. Yes, it's shown some relative outperformance since the March lows, but as far as leadership goes, we'd prefer mid-caps over small caps, as well as mid-caps over the large cap side too. So our focus really is where we're getting the most constructive price action within India remains mid-caps.
You know that earlier point you made that the semiconductor index, Kospi, Taiwan, the new highs came with lesser lagging momentum. And for large caps here in India, it almost feels like that's got to happen. That momentum in some of these other pockets need to cool off for people to turn their attention here to large cap stocks in India. Do you agree with that kind of thinking, Lawrence?
Well, I think if you think of the large cap side, if international investors come through, it's normally the large cap stocks that get the initial attention and fund flows. And the fact that India hasn't broken down, we've been in this trading range, but that trading range hasn't given India any relative outperformance versus the broader emerging market index, which is dominated by the North Asian indices. So if those North Asian indices do take a rest and there is some rotation, people can start to look at the India market. Right now, as I summed up earlier, at the large cap index level, we're not seeing a big pickup in momentum. So I think to gain attention from the emerging market fund managers, we'd also need to see some absolute momentum on the large cap names to get some fund flows back into the India market. That may take some time. I've been sort of highlighting to our investors, to focus on the mid-cap space if you're looking at increasing in India exposure, because that's where we see the momentum, we've seen the breakouts.
And stocks, Lawrence, in the mid-cap space, would you have any ideas?
I might just give you two, Polycab one and KEI Industries being the other. Similar exposure, but both stocks have broken out of their trading ranges from the 2024 highs. We've seen that at leaderships and other stocks we've been highlighting in mid-caps, and we've seen a bit of a pullback in BSC and MCX on the exchange front. We think both those stocks on pullbacks you can look to add to. So those four would be what we've been highlighting previously, and we'd look to buy on pullbacks there.
Lawrence, one more I think you can give us besides those four, the exchanges and the cables and wire space. I think you're looking at Dixon as well, the AMS player. That's the one that's pulled back a goodish bit.
It's a different structuring that. Yeah, it's a different structuring that we haven't seen a breakout to new highs and a trending side, but we have seen slowing downside momentum. It has put in a base, so that fits into our cover short bottom fishing buy basket. And yes, within that mid-cap space, that's another one to look at.
Well, what about, Lawrence, the power, and entire sort of, the power, the grid infrastructure companies, right? I'm talking about names like Hitachi and GE Vernova and Siemens and ABB and that lot. And it's a group of about 10, 12 names, all-time highs. What's your sense?
Again, they've been trending stocks. Do they look attractive to be adding right here? I'd probably look for a pause and a pullback. I think that is partly related to the AI theme and AI trade. So if you're looking at the SOX index going through a pause and pullback, I'd expect the grid names and the names associated around that sort of power side to also experience some kind of digestion phase before the longer term trends would resume. So yeah, I would look at some of the laggards would be 0.1, the mid-cap space 0.2, and some of these leadership stocks related to that sort of AI and energy theme is probably a period of digestion similar to what I would expect in the SOX and the North Asian indices right here.
Although it seems much more, it's easier and comfortable, and you'd sleep easy buying, it not necessarily a judgment on the outcome and what kind of returns you would get, but it just feels buying beaten down IT names perhaps is a better, idea compared to some of the leaders. Sometimes it's the exact opposite thing to do, but I don't know. Any thoughts, Lawrence?
Well, I think I would highlight the IT services names in India more as a mean reversion trade. I'm not getting any indication that we get sustained long-term leadership from the space on the current profiles that we have. But as far as a tactical trade, and if I had to put a new dollar into the market, I think, outside of the mid-cap side, if you're looking for some mean reversion action, the IT services names do stand out for that type of move.
Lawrence, I know it's hard to say this because crude prices are moving based on the headlines that we get from the heads of US and Iran, but any way to think about where crude is likely to move in the near or medium term?
Yeah, I think the interesting thing is we've gone from a period where you come in the mornings and you sort of gauge where the oil price has gone, and it's sort of had a big impact on risk assets. But over the last 2 months in particular, we've just seen oil, Brent oil that is, trade between $90 the bottom end, 119.50 being the top end. And it's been more the yield market over the past 2 weeks that has had a bigger impact on risk asset moves. So right now, we're really just looking at quite a steady ranging period for Brent between that 90 and 119.50. So I'm quite focused on $90. If we do see Brent oil break below that, that will give us, I think, sort of further indication from the oil market that we're starting to get a continual de-escalation on the Middle East scenario. So 90 is a key level that we're looking at on Brent oil.
Lawrence, what about the dollar index? That one has pulled back from that 110 odd mark. And earlier the 99 or 100 was a bit of a support zone. Now that is looking like a bit of a resistance, the 100 odd zone. Where do you see the dollar index headed from here on? Do you believe that it can pull back even more? And I'm not sure whether you track the Indian rupee, but that's been extremely weak in a scenario where the dollar index actually has cooled off. So if you're tracking that levels on that one on the chart.
Yeah, sure. So, we start with the dollar index, as you rightly outlined, that the 100 area having been support has now acted as resistance. So the breakdown below 100 that we had April last year, from a technical aspect, suggests that you do have a major top in the dollar. And that's been a dollar bull market from the 2010 lows. So we've had a 14-year bull market in the dollar, and we think that has peaked with the break below 100. So as long as the dollar index remains below 100, we think we've started a multi-year bear market for the dollar. That's, if we look at it in previous cycles from the 1985 peak or from the 2000 peak, the dollar has tended to derate over a 5 to 7 year period, and you get ultimate falls of between 40 and 50%. And, we 15% start from that 2022 peak for that dollar decline. So we think a major dollar reversal is unfolding with a number of years of weakness still ahead.
Right. No, got that. Just a quick word, Lawrence, on some of the larger names here in India. So let's start with Reliance, if you have a view. Again, there's been lack of momentum here. Well,
unfortunately, that's the case on large caps. When we talk about Reliance, or we even can talk about some of the larger banks, they've declined. They've had a bit of a rebound, and it's all about a trading range. So for Reliance, you've basically been between 1,300 and 1,600, and like the Nifty itself, there's no real evidence of an imminent breakout or breakdown. Or RCRCI, you've been holding above the 1,200 area in a range. The HDFC range has been much larger. But there is sort of good support in the highest 600s and lowest 700 area. So it is very sticky and range bound with lack of any leadership coming from the group. And the autos would be a space that we've seen more and more breakdowns develop. So, having been a leadership group through late last year, the start of this year, we've definitely seen a deterioration and a loss of leadership coming from autos.
Yeah, got that. Lawrence, we'll leave it there. Good conversation, covered a lot of ground. Appreciate your time here, and thank you for being here. So, the mid caps is the space for Lawrence. And of course, stay with strength. That's BSC and MCX and KEI and Polycab, and basically buy strong stocks when they pull back a little bit. On IT, of course, Lawrence's view that maybe we are in a bit of a mean reversion kind of a trade, and that is playing out, and there may be more to run here with the Nifty IT index per se. So that is the view coming through. But I think, Rima, we have the Bajaj management with us.
Indeed. So let's invite the auto sales numbers for Bajaj Auto were largely in line with estimates. Exports continue to maintain their monthly rate of about 2 lakh units. Domestic sales came in line with the company's guidance. We have with us Rakesh Sharma, Executive Director of Bajaj Auto, on the show. Thank you very much, Rakesh, for joining in. This is Rima here. While exports momentum is very strong, notwithstanding the issues that we're seeing right now, but you were hopeful of exports hitting the 2.5 lakh monthly run rate. In May, we were at 2.13. So has that fallen short? And if you could tell us the actual loss on account of the headwinds that we're seeing either in Nigeria or on account of Middle East.
Good morning, Rima. We breached the 2 lakh mark, I think, in October 25. And then from March onwards, it has been hovering between 2,15,000 and 2,20,000. I think we would have reached the 2,50,000 mark in May. but for the impairments on the supply chain side, which is, the availabilities and plus also the logistics issues which one is facing in exports. And that pushed the number down. But yes, with things coming back on track and supply chain availability is looking promisingly better in June, I think we should be clocking more than 250,000.
So June should be 250,000, 2.5 lakh units of sales in exports?
Yes, we are looking at 250,000 here onwards for the next few months. Our order book and our retails are suggesting that. The only caveat to that is any major disruption in logistics.
Got that. And the issue with respect to Nigeria, what are you expecting in Nigeria for June or July?
Yes, part of this recovery, or let me say the acceleration, which we are seeing, the surge in exports, which we are saying is also driven by Nigeria. I mean, there are three drivers to it: Nigeria, rest of Africa coming back very strongly, and of course, Latin America continuing to grow at over 35% for us. So within that, Nigeria is now clocking a growth rate of almost 80 to 100% compared to the same period last year. And the numbers are still coming in, but I would say that the retails would be at about 36, 37,000 last month, which is significantly above, the 18, 19,000 which we were achieving in the same period last year.
Are you seeing a moderation in the domestic two-wheeler sales? In May, it was about 10%, and plus now fuel prices have been hiked.
Yeah, you're very right. Actually, the motorcycle industry was on a breathtaking run ever since the GST cut, and the festive cheer continued in December, January, February, March. In fact, March for the industry was 20%. It dropped to about 11%, and the latest Vahan registrations are suggesting that it has further dropped to 4-5% now. The two-wheeler registrations on the Vahan portal are suggesting that. So there has been a sharp decline between March and April, May, largely, I would say, driven by the inflationary pressures. There have been price increases which we have taken, the industry has taken, which has reversed almost 50 to 60% of the gain which we had got from the cut in the GST rates. So that has dampened, enthusiasm a little bit. Then there is also, of course, consumer sentiment, which because of the LPG shortages, this whole issue has come into every kitchen of India, and that has depressed the consumer sentiment, and that tends to sort of push discretionary purchase. Now, only thing which is bucking the trend out here is the top 25% of the industry, which is still maintaining very similar growth rates to, let's say, Jan, Feb, March. Otherwise, the industry is definitely slowed down quite a bit.
All right. Hi, Mr. Sharma. Good morning. Good to see you. When, there is supposedly a big EV push on ground after the kind of spike that you've seen in oil prices. Tell us, how is your EV business doing? And what is your updated market share post-May?
Yeah, it's, every time the petrol prices move up significantly, we see a surge. The last time this happened, there was a point of inflection when petrol prices touched 100 rupees per litre, and suddenly we saw a surge in EV. And this is what we are witnessing right now with the petrol prices increasing and consumers anticipating some more increases. There is very, very strong support for EV. I mean, the two-wheeler, that is the scooter, e-scooters are growing at about 60-70% industry, and the e-three-wheeler industry is growing at 100%. So those are really very, very big numbers. In May, despite challenging our supply chain capacities. We have gained about 1% of market share and are at the number 2 position now consistently. In three-wheelers, again, supply chain got tested over there, but we're by far clearly now the number 1 player in terms of Vahan registrations. And combined, when I put it together, the e-portfolio of Bajaj Auto is now over 50,000 units, 1,000 crores, and profitable 25% of its domestic revenues.
And in terms of EBITDA for the e-portfolio, and what would the market share be? I think the last time I remember, Chetak was about 22%.
Yeah, so like I said, Chetak gained a percentage point basis again, Vahan registrations, and is now at 23%. And like I said, we don't get into segmental level profitability, but suffice it to say that we are in healthy single digits in the e-portfolio now.
In terms of the EBITDA, it's healthy single digit margins. Got that. Just getting back to the point about the moderation in domestic sales, you highlighted the headwinds that the industry is seeing. So in May, it was about a 10% growth. Given the base, what should we expect in terms of a growth rate or actual numbers for domestic sales in June, July?
No, in May, Rima, I said it is about 5%. The two-wheeler industry is 5%. In April, it was 11, 12%. So between March and May, the industry growth rate has really plummeted. The inflationary pressures are still there. Consumers' sentiment is still cautious, given all that is swirling around on the economic front and the geopolitical front. So we will have to really wait and watch as to how it goes. But I certainly don't expect it to improve immediately because, listen, we are also getting into now a very low period where the degrees of freedom in terms of movement and what companies can do is very limited. June, July, part of August is second half of June, then July and first half of August are generally very, very soft months. So I would say it'll be great if we can maintain, if the industry comes out with the similar number as what has happened in May, 5% or so, that'll be great if that happens.
So at a time when the growth is a bit headwinded and we are entering sort of a lean period, if there are cost pressures, would you be comfortable taking on price increases from here on, pass it on, or do you think the focus has got to be on growth right now rather than protecting margins?
So in the industry, one has to sort of peel the onion a little bit. Like I said, what is bucking the trend is the top 25% of the industry, where we are a major player above the 150cc. That is still growing very, very strongly. And we are gaining market share over there. Since last October, I think we've launched 10 new variants. 60% of our sales in that segment is now coming from there. Secondly, the e-portfolio. Now, e-scooter business is absolutely new business for us because we were not in scooters. And of course, the e-three-wheelers, which are as profitable as our domestic ICE three-wheelers. These two sub-segments are bucking the trend. And then there is the exports. So which is holding out very good promise for the next few months, at least as far as we can see. So when I put this together, the challenge is really not that we have to hunker down and there is a slowdown expected. I would say the challenge would be to ensure that navigate all this turmoil which is happening in supply chain and logistics and make sure that we pursue very hard these three segments which are bucking the trend in the overall industry. The dollar has helped us. It is 95 plus. It was 93 in April. It was 90 in Q4. And that helps us to mitigate the inflationary pressures on the raw material side. Part of which is also been recovered through very, very measured cost increases. So basically, we are having a very hard focus on pursuing these segments which are standing out: exports, high-end motorcycles, business. We are ensuring that through a combination of the mix, through a combination of rupee devaluation and the volumes which we will get, we hope to be able to maintain the margin outlook as we have been delivering in the last 2-3 months.
Got it. Okay, Mr. Sharma, thanks a lot for stopping by, giving us all of those details in terms of how you see the industry progressing, your EV portfolio, sales in the export market as well, going from strength to strength from here on. Wish you well and catch up at the end of this month yet again.
Thank you, Nigel.
Well, time to slip into a short break. On the other side, the management of Glenmark Pharma is waiting for us. They'll detail the past quarter's numbers and also the way ahead. Welcome back. This is Corporate Trader, and a quick word on the markets. From the day's low, there has been a wee bit of a recovery, and the tech index, that's the one that's actually firing away. I think the last 1 week or so, that's been the index to watch after seeing a big underperformance from a low of from 28,500 odd. It's rallied closer on 2,000 points. So good move is what we're seeing after a big underperformance. But let's turn our attention to the pharma space. Glenmark Pharma, that's the next management on our radar. The company's Q4 numbers actually came in below than what the street was working with. To discuss the numbers, what's the way ahead, we're now joined by Mr. Anurag Mantri, the Executive Director and the Global Chief Financial Officer at Glenmark Pharma. Hi, Mr. Mantri. Good morning. Good to see you in as always. Well, you've given an encouraging guidance actually for the next year. That's around 17,000 to around 18,000 crores or thereabouts. Could you tell us what all are you factoring in with regard to this growth target? Give us some color on the US business. I think Laboratories, did around $100 million odd. What kind of a growth you're looking at? And the India business as well. I think you're guiding for mid-teen. So help us out with the breakdown.
Thanks, Nigel. So if you see, I think last year, let's look at because before going to guidance, let's look at what are the drivers from here last year. So H2, if you see last year, was a more representative because in first half we did a FB deal. So the numbers were actually including of that. But even in H2, we delivered a 15% revenue growth and also the margin of around EBITDA margin of around 21%. Now here onwards, what we are guiding, because in if you see, last time when I met you, I think I guided that H2 should be 8,000 crore, but we actually missed some of the numbers in Q4 because of delay in some of our US approval, fluticasone especially, and also some of the supply chain related issues, which we will make it up in this year. So our growth is actually very broad based. If you see, all the markets we are doing well. So I think India will continue to do a double-digit growth, and we continue to outperform the market. US with the reasonable what the recent approvals we have filed in respiratory injectables, and also gradually the Monroe is starting the production. So we should see a good growth coming in US market also. Europe, we have launched, Laboratories continues to be strong, as you mentioned, and then now we have launched the Winlevi in UK market. We are planning to launch Winlevi in EU market. We have got the approval. So it will continue to have drive the Europe growth. And emerging market will continue to also be a very strong branded growth for us. So across the market, which include the LATAM, APAC, Russia, CIS, and MEA region. So we will have a broad-based growth. It's not a one geography dedicating to or risking to entire growth, because when you have a broad-based portfolio mix, good branded portfolios, I think we are very confident to deliver the 17 to 18,000 guidance. So what we have said.
All right. So just to understand, 17 to 18,000 crores of revenue in FY27 with margins in early 20s, I believe, right? 21 to 22%.
21 to 22%.
And India business grows in mid-teens.
Yeah, India businesses continue to grow at around close to 15% of the numbers.
Got it.
And it continues to outperform the IPM growth trajectory.
Got it. And Realtris grows at a faster clip is what you're saying. So could you quantify that?
Realtris, we have touched now $100 million marks. It grew 50%, and we have launched in China and the other markets, and also we are planning to launch in Brazil this year. So I think Realtris will continue to be a broad-based growth for us.
Got it. Okay. All right. Let's focus on a couple of other aspects then, Mr. Mantri. As of now, you have cash in your books. Could you help us out with the working capital cycle? Some part of the street is a little bit concerned out there. Could you tell us what is it according to your calculation? And I think you're guiding that the number comes down closer to around 100 odd. So for this year, what does it stabilize at? And given your ambitious plans, what is the peak debt number you'll be looking at in your books for the next few years?
So last time, Nigel, I think what we said to you is that I guided for that we will target a gross debt zero in March this year, which we achieved. We also guided that our net working capital days should be around 115 to 120 days. So we are lesser than that in terms of our net working capital days, which is still the best in the industry if you see. So net working capital and working capital efficiencies continues to be focused for us. In terms of this year itself, we'll be investing in our growth markets also, in our growth expansion in some of the markets. So we'll have some of the cash utilization over there for the larger benefit of the larger value creation for the stakeholder. But despite that, we will target at end of the FY27 also to be a gross debt zero. So we'll continue to maintain that position. And net working capital days, as we guided always, is that 115 to 120 days, which are best in the industry and which will continue to maintain those working capital days.
All right, Mr. Mantri, the vision that you'll have laid is y'all are looking to become a global innovation-led pharma company. And I think branded sales should account for around 70% of the mix by 2030. Could you tell us what is it right now? And how do you see this number gradually scaling up?
So, branded business is a clear focus for us. And if you see, we have a strong brands like Realtris is now what we are targeting. It eventually it should go to a $200 million plus brand. We have launched Tevimbra and Brukinza, the B1 products in India, which are doing well for us. Then similarly, we have done a two-partner in-licensing deal with Hangdui and Hanso, which is for Omlotinib and Tresta and Regeticon. So these will be also be coming in the next 1 or 2 years, because Amlo will be launched in this year. And so this overall, the branded market will continue to be very strong. As I said, Europe, Winlevi is another launch which we have done in UK and we are planning to do in Europe. So we have a lineup of the branded products. Even in US market, gradually we'll be selectively doing that. So I think overall we are very confident that 70% by 2030 of our branded portfolio to reach. We are currently at 60%. We have a proper stack up to how we reach to a 70% market.
Final question then, how is semaglutide panning out for the industry in India? And how is your product as well shaping up?
See, SEMA, the GLP-1 category represents one of the most significant growth opportunities in the pharma industry. And as we are seeing a strong expansion in India as awareness, access and affordability continue to improve. At Glenmark, we have meaningful experience from our liraglutide franchisee earlier portfolio, and which has helped us to build capabilities to market understanding in the category. With Glipig, our objective is to make semaglutide more accessible to patients and support long-term treatment adherence. The initial response has been encouraging, and we see an important addition to our portfolio. As the market evolves, we will continue to evaluate opportunities to expand in select international markets.
Got it. Okay. All right, Mr. Mantri, always a pleasure having you on the show. Thanks a lot for joining in. We've got your guidance down and the vision for the company. We'll track you to all of these numbers. Thanks for joining in.
Yeah, thank you.
Okay, all right. So that's the Glenmark conversation. Stock's flat, down about 0.5% or so. Let's sort of, take it from, we've done autos, we've done pharma. Let's talk about consumer durables. And I'm talking about the AC industry. So now the IMD has lowered its forecast for the 2026 outburst monsoon to 90% of long period average, with, of course, a certain error rate built in. It's down from 92%, which they'd seen earlier. And maybe a hotter summer, a longer summer, we don't know. But it's important for, AC manufacturers. And Mr. B. Thiagarajan, Managing Director of Blue Star, is with us to talk us through some of that. Mr. Thiagarajan, good morning. Great to have you with us here. Thank you very much for joining us. How are you looking at all these headlines, Mr. Thiagarajan? Before we get down to numbers and ask for your estimates, if there is any change for it, how are you reading the situation?
Good morning, Prashant. It's wonderful to interact with you. It was a great month of May. As you're aware, the summer had set in much later, only in the second week of April. And it was a weak April. And I think the industry would have grown more than 50% in the month of May. And if you look at the secondary sales, again, April and May put together should be close to 30%. Primary sales, April and May put together, my estimate is that in volume terms, it should be in the order of around 20 to 25%. And in value terms, it should be 25 to 30%. So in terms of secondary movement as well as primary, it is good. We do not know about June. As the weeks pass by, the footfalls are lowering. The consumer sentiment has changed dramatically once the petrol prices were revised. And as you're aware, I have been saying this, while the volume growth may be there, value growth may be there, the industry could not pass on the entire cost increase. In the process, I expect the margins to be substantially lower by at least 200 basis points or 2% lower than Q4 of last year.
How much is left to pass on, sir, in terms of price increases? What's the gap?
Sorry, sorry, sir. Please continue. Yeah, go on. Please answer that.
Rima, good morning. There was a price increase of 13% to be passed on till April itself. And out of which, I think only 8 has been passed on. 5 more percentage is yet to be passed on. And you have got in the meanwhile other increases like transportation costs or the petroleum-based products costs like that. So that will be another 5%. So which means we are sitting with another 10% of price increase, which will have to take place in the rest of the period.
Okay. I just wanted to, I'll come to the pricing bit in just a bit. So you said primary value sales growth in the first quarter so far, April, May, is 25-30% higher year on year. And volume growth is 20 to 25% higher year on year.
It a volume to value, there will be a 5% delta. I am saying that the volume growth will be 20 to 25, value growth will be 25 to 30.
Correct. And you gave us that number on how much margins will be lower compared to Q4. Can you just repeat that?
My estimate is around 200 basis points in operating margin level.
This is for what period? In Q1?
Q1.
I see. And once you take this price increase, which is left as you just explained, everything else remaining the same, I mean, where will we be at on margins?
I don't think you can take it at all, Prashant, because your sales will collapse. There is enough inventory in the marketplace. As I have been saying, the production capacity is twice the market demand. And one end, cost is going up. Other end, sentiments are going down. And so it is going to be a bad period.
I see.
Summer has played its role. The West Asia crisis is denting the whole picture.
I see. We had the management of PG Electroplast yesterday, and they were, they ran us through a bunch of these factors that you were outlining as well, Mr. Tyagarajan. The other one they kind of sort of talked to us about was, the dollar rupee and imports perhaps being a lot more expensive. Is that a large factor for you as well?
Yeah, for the summer season, the imports would have all taken place by January. So it had not impacted. That's why I'm saying going forward, leading up to the festival season, another 10% price increase will have to be taken, which the market cannot afford.
Okay, all right. Hi, Mr. Tyagarajan. Good to see you in, sir. You're indicating that demand is very, very strong, which is good. What about your market share, sir? There were some concerns that maybe you're not sounding as optimistic as earlier. Is the market misreading that? And actually, you're continuing to gain market share? Give us an update on that front and where do you see your market share headed?
I think we will be maintaining the market share. We might not have gained in April and May for the simple reason you have to protect the margin to the extent possible as well. So therefore, we have not gained market share. That is my guess as of now. I don't know what will happen in June. April and May, we would have just maintained our market share.
Okay, but you have not lost any market share as well?
I do not think so.
Okay, all right. Tell us about some restrictions have come about with regard to importing of, compressors. How much of your requirement do you source from third party? How much of it is imported? If you could give us a rough number out there, and how does it impact your business?
Nigel, these restrictions have been in place. This is a non-tariff barrier called Quality Control Order. From time to time, the government has been extending it. Now, what has happened is that they have linked it to the previous year imports. In Blue Star's case, we have been indigenizing steadily. As of now, somewhere around 50% are locally sourced, 50% is imported. Now, the order is talking about there will be certain quota based on the previous year imports, which I am not comfortable with. I do not think that you should incentivize somebody who imported more in the previous year. I think government is looking at it and some amendments should be passed. As of now, there is no issue with regard to the shortages or supply chain constraints. It is more about the cost rather than the availability.
Okay, very quickly, sir, on commercial refrigeration, category was in a bit of pain, I think, in the second half of the year. Though, how has the start been to this year on commercial refrigeration?
It is reasonably good. The growth is not as high as room air conditioner because in commercial refrigeration, the commodities play a huge role. For your information, something like a cold room, part of a cold chain, the input cost increase itself is around 24%. In case of a deep freezer, because it has got a high quantity of steel out there and also insulation material, the cost increase is somewhere around 16%. So obviously, the ice cream players, for example, they will be not expanding so very aggressively. So there is growth compared to last year in the order of around 15%. It is not as high as room air conditioners, but still, there again, the margin pressure is very high.
So we leave the conversation here. Thank you very much for joining in and sharing your candid thoughts on the industry.
Thank you. Thank you very much.
All right, let's get back to the markets then. There's been a little bit of a recovery. The low today was sub 23,250. We've managed to climb back above the 23,300. Tech is still in the lead. Chandan Taparia, Motilal Oswal Financial Services is now joining in on the show. Chandan, morning. Down but not out today, attempting a bit of a recovery. What's the Nifty trade and your stock calls?
Good morning, Rima, Prashant and Nigel. Thanks for having me. So, yes, the index started to form lower top, lower bottom on the daily chart. But the good part is that even after the negative and a gap down opening, the market managed to hold the support near 23 to 22 marks. The good part is that being the weekly expiry, some put writing is visible at 23,200. But the concern is the sustained call writing at higher levels may not allow market to move significantly. If I look at the data internal, India VIX is near 16.517, but FIs are selling and their long short ratio gone to below 2-digit number near to 9.5%. So here I'll go with limited upside kind of setup in the market. As of now, till Nifty doesn't surpass beyond 23,500, upside could be kept. An index can go down towards 23,000 kind of level. But for day point of view, trading range could be between 23,200 to 23,380, 400 kind of level being the VWAP zone for the index. Talking about Bank Nifty index, here we have seen a corrective move, but somehow the Bank Nifty is holding the support zone at lower marks. It has been making lower top, lower bottom as it failed to surpass 50-day mark. So the trading range would be in between 53,000 to 53,750 with limited upside in the banking index as of now.
Your stocks?
Yeah, so looking at the stocks, we have positive view on metal and mining name. So first trade will be from the metal space or mining space, that is buy on NMDC, one of the strongest counter and holding well, given a decisive breakout about 93, 95 marks with put writing activity. In fact, we have seen hold of 50-day exponential moving average with consolidation breakout. So recommending to buy with support of 93 for an upside target towards 103 marks. Second trading area, that is buy on persistent system, positive on the metal and IT name. In IT, we like Tech Mahindra and persistent, but persistent system is having one of the strongest counter. In fact, 2 days back, it formed a rough inverse head and shoulder pattern, which has bullish implication. So looking for extension of high rise high lows, which is being formed on the daily chart. One can buy with support of 54.50 for an upside target towards 57.50. One more idea will be Adani Energy Solution. After the corrective move of last 2 days, this counter started to form a higher base, trading above volume weighted average, which indicate bullish bias could be there. Previous hurdle may act as a support to form the role reversal kind of setup. So one can buy on a small dip with support of 1490 for an upside target towards 1590 marks.
All right, we'll leave it there. Thanks very much for that. We'll take a quick break here. We'll come back with commodities and Manisha on the other side. Stay tuned.
Welcome back. As promised, let's talk commodities. Manisha is joining in as always. Hi, Manisha. What do you have?
I'm looking at aluminum prices because all the commodities are quite choppy, but there is one directional move that we have constantly seen in a commodity, and that clearly has been aluminum. Gaining on the higher side, trading at a 4-year highs at this point in time, and we are trading above $3,700 a ton as well. This is what aluminum has done in sense of returns in last many years. So if you look at this year, we've seen 24% of gains come in for the aluminum prices. The last 12 months, aluminum has gained up by 50%. In last 2 years, it stands at 52% even then. But 3-year cycle shows a 70% of gain in the aluminum prices. And in last 6 years, this metal has gained up by 153%. So very strong moves continuing in case of aluminum. The last 3 or 4 months clearly have been news driven, and the reason that you have seen prices gain is majorly because of the West Asia conflict and because nearly 9 to 10% of aluminum in sense of a global output comes in from that area, which clearly has been cut off. The other thing is from China, which also has put a production cap at around 45 million tons per annum. Now remember, China produces nearly 60% of world aluminum. So any story, news, development coming in from China is going to be imperative on how the commodity prices move in there. And then it also is about the bauxite export restriction that Guinea has put in, and that is from 1st of June starting this month itself. That also is something that will support prices. It also is about the kind of backwardation that we're looking at in case of aluminum prices. The strong demand from AI data centers, EVs, solar, manufacturing, packaging, all of that has seen a surge come in on an year-on-year basis. And then you have a backwardation coming in, meaning that the spot prices are much higher than the 3-month futures therein, trading at a $60 of a premium. That tells you that there is a spot tightness, there's a deficit in this year as well, and supportive in turn. Also, the US signing proclamation amending tariffs on steel, aluminum, copper imports is something that the street is looking at and digesting in sense of impact there. So what we do understand from the proclamation is that the foreign companies qualify for a 10% tariff, but that happens only if the capital equipment includes at least 85% of US melted and poured or smelted and cast steel or aluminum by weight. Now that is something that the street will watch out for as we go ahead in sense of companies collaborating with US there. But interestingly, when you look at the per kg capita consumption of aluminum, India clearly is the lowest on the rank. They're at 3.2 kgs. The global average is at 11 kgs, and the highest clearly comes in from countries which are more into automation and packaging. So you have South Korea, China looking at 45 kgs. You have China at 25 and US at 15, and then India quite low on the charts there. When it comes to forecast in sense of aluminum prices, most of the banks and brokerages believe that we are looking at higher prices going forward as well. Last year, same time, the aluminum was trading at $2,500 a ton. We are trading at $3,700 right now. $3,800 of an expectation is what JP Morgan has put out. Goldman Sachs believes that this year could look at an average of $3,400. $3,200 of an average is what World Bank also has put out, which is nearly 26% higher than last year. So higher prices could just about continue for this one.
All right, Manisha, thanks very much for that. We'll take a break. We are back. Lata will be at the Morgan Stanley's Investor Conference, and she's speaking with Chetan Iyer about RBI, rupee rates, and of course the rest of Asia. Coming up in just a bit.
Hello and welcome to It's the Economy. This is a very special edition coming to you from the sidelines of the Morgan Stanley Investor Conference. And my guest today is Chetan Ahya, one of the best known faces of Morgan Stanley and by my estimate, one of the best economists tracking India and now Asia as well. Chetan, thank you very much for your time on what must be, I'm sure, a very busy morning.
Thank you very much, Lata, for having me, and thank you very much for coming at our conference site. It's a lot of buzz around here, so it's great to have you here.
I came to enjoy the buzz and even relay it to our viewers. Okay, for us and for you, I suppose, the big event is on June 5th, when the Reserve Bank will be announcing its next monetary policy. Now, one of the debates doing the rounds is, yes, FIT, flexible inflation targeting, is very good. But have we reached a time when interest rates are needed to be hiked to defend the exchange rate? Where are you in that debate?
So we don't think that the RBI should hike. India doesn't have an inflation problem. India doesn't have a current account deficit problem. So if you're going to hike interest rates, what purpose is it going to serve? If the purpose is to provide higher yields on your currency, then 25 basis points is not going to do it. How we did it in 2013 is by lifting the upper end of the policy rate band and effectively letting the liquidity tighten when capital outflows are happening. And you have to do something like, 150, 200 basis points of overnight interest rate hike.
Too expensive.
And it's too expensive. It's just not what the economy needs right now. So I think it will be counterproductive.
No, I'm asking you this because, as you know, you cover all of Asia. Philippines has raised rates in April and Indonesia did it in May. So there may be an expectation from the hedge funds, from the fund varieties, that there a rise in interest rates. Will a lack of a rise in lack of a rate hike disturb the currency at all?
I think it's not. In fact, it could backfire because a lot of the investors in India are the equity investors. And if you're going to take up interest rate hike, which will affect growth, it will actually lead to more equity outflows. So I think from a flow perspective, and even from currency management perspective, interest rate hike is not the best tool. The best tool is to augment capital flows if you need to be on a short-term basis. But more importantly, also work on the long-term solution for stabilization of balance of payments.
Then let us start with the short one, the short term. What are the options available to Reserve Bank on June 5th itself to augment capital flows, as you say?
So for the RBI, probably to operate in conjunction with the government, they could provide some hedge protection and attract some external commercial borrowings. It could be open to the private sector. I'm pretty sure you're going to get a lot of inflows. But if you just open it up to the banks and state-owned enterprises, government-owned companies, we can get something like $40–50 billion, and that will definitely be an immediate stopgap arrangement addressing the balance of payment deficit issue.
Yeah, those ideas have been doing the rounds and everyone is expecting something like that. But this doesn't endanger external debt to GDP types, right? 50 billion is par for the course.
It doesn't. And look, I mean, the issue is that you want to ensure that the currency is not having a self-fulfilling problem, which it is going through right now. Because the trading returns have been bad for FX investors, or the rupee has depreciated, it has led to some kind of a self-fulfilling dynamic. And mind you, it's the corporate sector in India where this self-fulfilling expectations affects the most. As you know from the data, foreign portfolio investment in debt is not really that negative.
It's quite sticky.
Exactly. So it's the domestic corporate sector which goes through this challenge. We don't have the published data from the government on what is the hedging ratio, where the other countries do that, provide that information. It would be good if the government actually compiles it. But in our estimate, corporate sector in India is now over-hedging or hedging more than what they used to in the past. So that has been a big issue. Imagine the trade is $1.5 trillion. So if 1 month's export remittances are delayed and 1 month of import payments are brought forward, that's $100+ billion of demand-supply gap that has to be filled. So I think you have to think about the stabilization of currency and checking that self-fulfilling problem that we have.
Fair enough. Actually, over the last 1 year, FY26, we don't still have the last quarter's BOP deficit. But even assuming, if you take the first 9 months, it was about $30 billion. And if you add, say, another 20 billion, the RBI's intervention should have been 50 billion. Their intervention is 190 billion in FY26. So clearly, it's because of this hedging. And
And the other solution is, Lata, to take out, the interest tax that you're deducting from for the investors from outside, and at the same time get rid of the capital gains tax. India is one of the very few economies in the world which is putting tax on that interest income for foreign investors and putting capital gains tax. And by the way, non-resident Indians, I'm included in one of those, can put money into domestic banking system and not have to pay tax on the deposits, or interest income on the deposits. So we have created such carve-outs, and we should create similar carve-outs for foreign investors. It's just like what you want to be in a relative space versus other investment destinations.
not deliberately make ourselves look difficult. Okay, let me come to the broader economy itself. I mean, see, we are still the fastest growing, largest economy. Then why is it that our corporate growth is not as high? Earnings growth, as you point out in that article in Economic Times, is not keeping pace with rival countries. Why is corporate earnings growth not as good as GDP growth?
Now, this is a very serious long-term issue. I think that we have been relatively slow in moving up the value chain. If you think about rest of the Asian economies, they have been doing all lot of basic stuff like electronics manufacturing years back, right? And then now they are evolving into semiconductors. Different countries are involved in the region in different parts of the semiconductor supply chain. Japan is into equipments, South Korea is into memory chips, Taiwan is into logic chips. So every country in the region has figured out something to be playing in this higher value-added part of the supply chain. Unfortunately, we have been slow in moving up this supply chain, and that's what is affecting our relative position. But the numbers are even starking versus developed world. So US...
Ours is what, 12%?
Yeah, first quarter earnings expectation for India is about 12%. South Korea is 150%. Taiwan is 48%. Japan is 33%. And US is 27%. So I think from investors' perspective, it is just very simple math of relative earnings growth differentials between India and the other markets. And that's actually at the heart of these FPI equity outflows. And at the same time, I think that this is also indirectly affecting the outflows from the private equity investors.
Okay, so let me therefore ask you, the rupee has fallen, and you know, at RER levels or RER measures, we are like 91 or 92. We normally, at real effective exchange rate, is a little over 100, at 105. Has it fallen enough and earnings turn enough for us to expect that sometime soon foreign investors will be, attracted?
Yeah, so we are thinking about two aspects here. One is the valuation of the rupee on a real effective exchange rate. As you mentioned, it's about 3.7 standard deviation below 10-year trailing mean. So, 10-year trailing mean is supposedly like the fair value if you didn't have any long period of wide current account deficit in that period, and which is the case in India. So it is fair to assume that to be the fair value, and now we are like 3.7 standard deviation below mean. So it's no problem of currency competitiveness. It's just the fact of balance of payments dynamic that is affecting the rupee. So we are expecting the rupee to appreciate modestly, and two reasons for that. Number one is that we are expecting that the growth trend in India is improving, so that should at least help some investors to think about the upside in some of the sectors. And at the same time, we are expecting that there will be some resolution to this Middle East tensions. And so if oil prices go down further from where they are, that will also help. And parallelly, we are also calling for a bit of weakening of the dollar. As you know, the dollar has also been relatively strong in this environment. And so as the dollar weakens, India's own earnings growth trajectory improves, and oil goes down, that will give some modest rupee appreciation.
Well, the other interesting report that you published recently was the very strong capex cycle in Asia, powered by power, defense, electronics. Will India benefit from that? If the ecosystem grows, does that make India's growth a little safer? And anyway, your forecast for Indian growth as well.
Yeah, so we are expecting this capex supercycle, Lata. It's driven by 4 drivers. Number 1, AI and AI-related infrastructure capex. Number 2 is energy. Energy is in turn for energy security, for powering AI, and also for energy transition. Number 3 is defense. And number 4 is industrial capex.
Okay.
Every economy in the world is trying to onshore industrial supply chain, and that's triggering a big round of investments. So these 4 drivers, we think, will mean that there will be a significant rise in capex across the region. In fact, it's happening across the world. And one favorite indicator of mine to look at this would be to look at capital goods imports. It tends to be very well correlated with GDP component of capex. And that in Asia is growing at 27% in dollar terms on a year-on-year basis. So this capex cycle is already booming. As regards India is concerned, it will also see the investments in all these 4 areas. So it's inevitable that India will also see a pickup in capex cycle. The only difference between India and rest of Asia is that they are actually also exporters. So when the US and Europe is spending in these areas, they are able to get the benefit of exports. India will be just the benefit of domestic investments that happens in these areas.
Fair point. Okay, actually, yesterday the MOSPI released the first new IIP series, and actually capital spending has been very good, or capital goods is like, I think, 12% growth in April.
That's right.
So,
That's right.
there's some encouraging signs. Even manufacturing, some 6.4% is looking encouraging. But a final question to you on inflation. I mean, we just had our commodities editors saying that, you know, aluminium, etc., are also at 4-year highs. And crude, some of it has gotten passed on. The Indian government may be forced to pass on a little more. So will we be, what kind of inflation do you see in India, and will that require rate hikes?
So we do expect inflation to head towards more like a little over 5%. But at the same time, you know, the drivers to inflation are, you know, energy prices. We don't expect that core inflation will go significantly above RBI's 4% target. And if that is not the case, we don't think this inflation should be a worry. And hopefully the situation in Middle East improves, and that, you know, oil prices, inflation will also sort of be ebbing. But underlying, there is no big demand pressure in the economy, which is taking the core inflation at a level that RBI needs to respond to this.
That's good to hear. Thank you very much, Chetan Ahia. Pleasure speaking with you. And I think some very important takeaways for us. We should hope that Reserve Bank and government will encourage some ECB offerings from Indian corporates with some hedging support. As well, you know, the longer term solution of getting into investments in electronics and skilling, R&D. Well, those longer term solutions are always there. Thank you very much, Chetan.
My pleasure to be with you.
Good. Let's hope.
The Indian market starts lower but is significantly off the day's low. The Nifty slips below 23,300 led by financials. The broader market corrects in line. IT is the top sectoral gainer as stocks continue their rebound. Metals gain as well.
Well, Force Motors slips in trade because the May sales numbers are down by close to 15% on a year-on-year basis, while domestic sales hit an 18th month low. The stock slumps close to 3% as we speak to trade at its lowest levels in 2026 so far.
The government launches an OFS to sell up to 6% stake in NHPC. Sources tell CNBC TV18 the floor price is at 71 rupees per share. The stock trades lower by over 4%.
Ola Electric launches a 500 crore QIP at an implied issue price of around 35 rupees and 86 paise a share. The stock is down close to 2%.
Wockhart's management tells CNBC TV18 it sees $1 to $2 billion in terms of a global opportunity after receiving US FDA approval for its novel antibiotic Xenic. The stock comes in for a bout of profit-taking, down over 6%, although it is still higher by around 40% over the last 1 month.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel, and with me is Ekta Batra. And the markets, as you can see, they're still down. Shade of red on the screen. However, we've come off the lows of the day. Hey, Ekta.
Hi, Nigel. Well, yes, not everything's not that dull. Just look at the Nifty IT index and the way the entire IT space is soaring in today's trading session as well. So there's definitely a comeback which has taken place for the IT stocks. But nonetheless, let's get going in terms of tech check on the markets. We have Jay Thakkar joining in from ICICI Securities to tell us what he's tracking this morning. Jay, hi, welcome to the show. Well, it's definitely subdued for the markets at this point. What would your call be?
Very good morning to you, Ekta and Nigel. Definitely, the start of the June series so far has not been that positive. In fact, Ekta, if you see that in the previous occasions, we have seen that the start of the expiry at least tends to be positive a day or two, and thereafter, if the momentum carry forwards, then we see further up move. As in this entire consolidation or corrective phase, we have seen that the initial days of the series, we see an uptick, and thereafter we see a downward momentum actually taking control. But then this time around, we have seen that despite FI reduced their short positions during the rollover, from falling from 2.25 contracts to almost 1.5 lakh contracts, 75,000 contracts almost, getting covered in the shorts. The market did not go up. Rather, we saw last week that the selling pressure increased, and now we are back to 2.25 lakh contract shorts on the index. That clearly indicates that the selling pressure is heavy, and on the upside now, 23,550 to 23,600 on an immediate basis seems to be a resistance, and in the medium term, 23,800, I think Ekta would be acting as a very, very stiff resistance. Until those levels are not taken off, we might see some further consolidation to correction at least until the levels of 23,100, which approximately is the gap area which Nifty had actually left during the up move. So 23,100 to 23,800 is where I think Nifty may consolidate for a few more trading sessions. But the best part is that
Oh, no. Okay, all right. We'll try to get in Jay back. I think he was making a point that 23,100 seems like a very, very important support zone. So we'll keep an eye out on that particular call. We'll try to get Jay back. By the way, keep an eye out on a few stocks in the broader markets. Vedanta, there was that news with regard to, an ED visit out there, probing the entity because of the transactions with the promoter entity. Take a look at that stock. Actually, it's gone into the green. So I think the street had a bit of a sniff on that one. Explains why the stock had bounced up a little bit. Jay's back with us. Jay, you're making the point, 23,100. Go ahead.
Yeah, Nigel. So I was saying that 23,100 to 23,800 now, Nigel, remains a very, very critical range for the Nifty. And unless we see a breakout on the upside, we might see some consolidation to testing of those gap areas of 23,100. However, one thing significantly, Nigel, that has changed since past couple of trading session is that Nifty IT is back with a sharp short covering rally. They were sitting at very high, highest shorts, I would say, so far, which we have seen. And in the past few trading sessions, we have seen this sector recovering overall. So it's just the BFSI segment, I would say, Nigel, which is still pending. Once we see a short covering happening with the BFSI segment, then I think market would really indicate thereafter that the short-term bottom is in place. So I think that 23,100 going forward, if those levels are seen on Nifty, that would be again a good buying opportunity.
Okay, all right, Jay. What about stocks? How would you approach specific opportunities today?
Well, Ekta, definitely, as I said that Nifty IT is gaining some momentum since past couple of trading sessions. So definitely, I have got one stock from Nifty IT, and that is Tata LXI. I think there are huge shorts out here as well, and the stock is trading around the levels of 4,500, precisely 4,504, and I'm expecting the stock to inch towards 47.50 in this short covering rally, placing a stop loss below 4,400. The risk is absolutely in favor of the bulls. So I have a buy recommendation on Tata LXI, pharma pack. I have been bullish on the pharma in the past occasions, and I think after some consolidation, Dr. Reddy's can be seen as a good buying opportunity. In this correction, Dr. Reddy's can be bought with a stop loss of 1,200 for a target of 1,350.
Got it. Okay. All right. Thanks a lot, Jay, for joining in and giving us that quick intake with regard to market levels and stock levels. Time to shift focus to our special segment, though, where we get you a few ideas for profit from Money Control Pro. Neha Dave of moneycontrol.com joins us to talk about a stock that she's tracking closely. Neha?
Today's stock idea is SBI. SBI's advances grew by 17% YOY in FY26, a notable feat on a loan book size of above rupees 49 lakh crore as of March end. Deposit growth lagged advances growth rising by 11% YOY in FY26. Despite a lag in the deposit growth, SBI's CD ratio, that is credit to deposit ratio on the domestic book stood at 73%, which is well below the industry average and large private banks. This will enable the bank to grow its loan book at a healthy pace in future as well. Management has guided loan growth of 13 to 15% in FY27. SBI's asset quality continues to improve with NPAs at their lowest level over the past 2 decades. Management expects credit cost to remain well below 50 basis points in FY27, supported by a favorable asset quality cycle. While the net interest margin disappointed, falling to 2.8% in Q4 FY26, management's guidance of maintaining margins at 3% on its domestic book is reassuring. Overall, the bank is set to deliver return on asset, that is ROA, of around 1% in FY27. Now, talking about the valuation, a sharp compression in margins along with treasury losses weighed on bank's profitability in Q4 FY26, leading to a correction in its stock price post earnings announcement. Consequently, the bank's valuation has corrected and the bank is currently trading at just one-time core book value estimated for FY28 after adjusting the valuation of subsidiaries. The valuation is attractive given that the bank has consistently delivered ROA of above 1% in the past 3 years and that the asset quality cycle is favorable. While the return ratio may have peaked, risk reward remains favorable, making SBI a compelling long-term bet.
Okay, all right, Neha. Thanks very much for giving us that stock analysis. Well, we need to take a short break with the news that we have the Bank Nifty, which is under pressure, so down around 0.5% currently for the Bank Nifty. We'll get you a lot more on the markets and stocks once we're back. Stay tuned. Welcome back. Well, let's get talking about some news. The government has launched an offer for sale in NHPC. Ola Electric is also under pressure after it announces a QIP. Vinny is here to tell us more about these stocks. Vinny, over to you.
Hi. So yes, in terms for NHPC, there's an offer for sale, like you mentioned, that has come in as well. That has been launched by the Deepam Secretary. Now, obviously, this offer for sale, base offer is around 3% equity. Additionally, 3% is green shoe option as well. That is there. And the floor price on this was set at 71 rupees. Obviously, it's 2 days. First day is today, it's going to be non-retail portion, and the other tomorrow is going to be retail portion. Now, apart from this, what we know is the total issue size of this is going to be around 4,279 crores, which is including the green shoe option as well. Now, in terms of the latest subscription data that we have that's come in, as of now, 4.51 times is the subscribe portion for the non-retail side, and the last transaction price for this was around 73.5 rupees. So that is something interesting that one should watch out for NHPC today, but we're seeing some bit of a pressure coming in here on the back of this. Ola Electric, that's another one. QIP was launched for this one as well. Fund was raised of around fundraise for up to 500 crores is what you're looking at. Floor price for this is around 37.74 rupees, which is around a discount to yesterday's closing price of 9%. This main proceeds are going to be used for debt repayment, expenditure incurred in relation to the company's organic growth initiatives, as well as general corporate purpose. So that is the reason that we'll keep an eye out on Ola Electric as well.
Got it. Thanks a lot for that, Vinny. Well, let's go across to Sudarshan. Sudarshan, Force Motors seems to be losing some part of its force in today's trading session because the May numbers were disappointing. Tell us more.
So yesterday we had numbers from Tata Motors Commercial Vehicle and Ashok Leyland, and both those companies had reported numbers that were below expectations. And after that, there was an expectation that even Force Motors can disappoint a bit in the month of May, and that's what we have seen. Both the segments, domestic as well as exports, have seen a decline. On domestic front, decline is 15%. On export front, because of supply chain issue, the decline is as high as 37%. And in resultant, total sales have seen a fall of 15%. It has come at 2,614 units total sales. And if you talk just about domestic sales, their sales were 2,560 units, and that's the lowest print that we have seen in last 18 months. So because of weak set of print for the month of May, you are seeing a fall in the stock, currently down almost 4%.
Got it. Okay, all right, Sudarshan, thanks a lot for that. Well, let's focus on NMDC. It seems the street is ignoring the near-term headwinds, and they're looking at some tailwinds in the time to come. Let me explain this. The EBITDA number that came in at around 2,650 crores, well, that was lower than most estimates. So the margins missed estimates, so the top line was pretty good. Because you had some trading revenue that came in because of the sale with NMDC Steel, which is a sister concern. But the reason that the margins were a miss, because the pellet and other minerals business, that's a smaller part of their business, they delivered an EBIT loss of around 100 crores. So that was the primary reason why it missed estimates. The street is looking ahead though. NMDC has gone ahead and they've effected price hikes to the tune of 500 around 600 rupees in Q1 FY27, and that will reflect in its numbers positively. They've also mentioned in their con call that they're targeting 60 million tons of volumes in FY27 and around 100 million tons by FY30. Now, this compares with around 50 million tons in FY26. They've laid out an ambitious capex of around 6,000 crores odd, which compares with around 3,300 crores in the past fiscal. And they say from FY28 onwards, that capex actually will even be higher. But they're giving a roadmap to around that 100 million tons odd, and it seems the street likes that. The update though for May was a little disheartening because the production number jumped up by close to around 20%. However, the offtake was lower by close to around 7%, and that was primarily because the offtake in Karnataka was down. But I understand there's a new mining contractor out there, so there's a change of contract and that's being stabilized out there. There's a new gate entry system as well in Karnataka, and that's being stabilized. So the street is saying this is a near-term headwind, but they're expecting things to improve from here on. That's why they're ignoring that sales number that degrew in the past month, because they're expecting things to pick up. Brokerage verdict, well, it's split. Nuvama, they have a hold rating, but they've increased their target price to 100 rupees from around 85 rupees. They've increased their EBITDA estimates by 13 to around 16% because now they're factoring in higher volumes as well as iron ore prices. Citi, on the flip side, they're maintaining their sell rating with a target price of around 85 rupees. They're expecting domestic prices to remain range-bound, and they're also pointing out that in India, supply will go up from other miners, namely Lloyd Metal and Energy, who has enhanced their iron ore capacity to 25 million tons from around 10 million tons. So they're citing higher supply in the market may not be so favorable for NMDC. Net-net, the street seems to be looking ahead, ignoring the near-term headwinds and believing that the stock is poised for more. From yesterday's low, in fact, the stock is up close to around 10%. Oh.
Okay, all right. So that's on NMDC. Thanks, Nigel, for that. On that note, we're going to take a short break, but we'll get you a lot more in terms of specific stocks as well as the markets once we're back. Stay tuned.
Welcome back. Very volatile times on the headline index, but a few stocks actually are fighting back from the day's low. Coal India started off on the back foot because there's a bit of a disappointment that e-auction premiums are not going up in comparison to the FSA prices. But that stock, the dip has got bought into. It's now at the high point of the day. So that's point number one. The other one is HCLTech. From the tech pack, you're seeing a lot of stocks coming back. And now HCLTech is up close to 5%. Beautiful move on that stock as well. And the big boy, HDFC Bank, that was down more than 1%. It's cutting its losses. That's what's helping the Nifty recover a little bit, almost moving into the green. But we've not covered pharma, so let's go across to Ekta. Ekta, tell us, Wokat, a massive opportunity. You spoke to the management earlier, but the stock has come in for some profit taking. Explain the opportunity to us.
Yes, absolutely. And, we spoke about this yesterday as well. The opportunity, the reason why the stock is under pressure today is because the stock has already run up 40% on a year-to-date basis. And it did see strong moves both on Friday's trading session, where it was up over 15% and in yesterday's trading session as well. So a lot is factored in terms of good news. Now, just want to put it into its perspective, around $1 to $2 billion is the opportunity from Zenith globally. 40 to 45% is expected to come in from the US. Peak sales, according to the management, could be around $1 to $2 billion. And they do have a patent for the next 10 years odd on Zenith. So that would be interesting to look out for. But earlier today, we did speak to Habil Karakiwala, who's the founder and chairman of Wokat. And let's listen in to what he had to say.
I think it will take us another 4 to 6 months So for practical purpose, before the end of the year or early next year, we would be launching Zenith in the US market.
You had earlier guided for around a $1 to $2 billion opportunity from this drug, from Zenith globally. Does that still stand?
Yeah, definitely it stands. Yeah, that is generally so that the US contributes around 40-45% of the global opportunities. So we do expect at least 40-45% will come from the US market.
Okay, all right, let's move on to another source-based story. And sources are telling Money Control that Noel Tata has raised concerns over growth at Tata Digital as losses continue to mount. Some higher management changes may also be in the works. Hormuz joins us to give us that quick update. Hormuz?
Hey, some developments, a couple of them actually from the Tata Group. And the first one, of course, is this Money Control exclusive where Noel Tata has actually raised concerns with regards to growth at Tata Digital. And the management of Tata Sons during the board meet had sought an equity infusion of around 7,000 crore rupees into this digital consumers business. Now, that includes companies like Big Basket, Tata Click, and a lot of these consumer-facing digital companies as well. And the projections that they put out there, they show that these businesses could continue to report losses over the next 3 financial years, and those losses could amount to well over 9,000 crore rupees. And Noel Tata in that regard has raised questions with regards to the growth projections being used to justify the investment that was sought, and he believes that the group now has to review and prioritize their investments as per the growth outlook. Now, sources are telling all of this to Money Control, and they also went on to add that the concerns that were raised on funding into a business that is yet to demonstrate a clear path to profitability. And so that is what the sources are telling Money Control. And aside of that, the second development is that sources now that are telling CNBC TV 18 that Noel Tata's daughter Maya Tata is going to be exiting Tata Digital and will head to a role at their group company, which is Trent. So that's the second development that has come in, but some concerns being raised by Noel Tata. That's the Money Control exclusive, and a management reshuffle also in the offing, possibly at Trent. That is what sources are telling CNBC TV 18.
Okay, all right, Hormuz. Thanks very much for that. And on that note, it's a wrap on Chartbusters. Stay tuned. Trading Hour up next.
Good morning, it's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. Joining me as always from Bangalore, Ritu Singh. Well, it's a choppy start to what has been a very rough start to the month of June. And after that initial 200 odd point gap down, the indices were showing some semblance of recovery, but that recovery is again getting sold into. So today, of course, being the weekly expiry of the Nifty contracts as well. And so now the most important level to defend on the downside as of now is the May series low of 23,262. We broke below that intraday, but now we are currently trading above those levels. Flashes at the bottom of your screens from the Vedanta spokesperson extending full cooperation to authorities, providing all the information sought. This is, of course, with regards to the search operations being carried out by the Enforcement Directorate. That stock too seeing some choppy moves today. Ritu, morning.
Good morning, Hormaz. Yeah, we'll keep an eye out on what follows with Vedanta, but it is a choppy start. Like you said, the only a major index that is shining in trade today is really IT, and we'll talk about that in more detail. It's up almost 12 to 14% from its recent lows, more than 33%, still lower, 33% from its all-time high. So we'll have to see how that goes. But apart from that, market breadth almost even, Steven. You have a similar number of stocks advancing as they're declining on the National Stock Exchange. 1542 declining now versus about 1448. The broader market's also seeing cuts of, for the mid-cap index, about 0.7%. For the small-cap index, 0.2% of the Bank Nifty. Below that, 53,290. That's where it is at, trading with cuts of about 350 points. But let's, as always, put the spotlight on the top movers and shakers, the individual stocks to focus on. And Hormaz has walked by to the wall to give us that list.
Yeah, indeed, it's been a choppy start, to this trading day, the weekly expiry for the Nifty contracts. But as of now, the bulls are fighting to hold the May series low, and you can see the recovery that came in at around about 10:15, 10:30ish. We went up to as high as 23,400 odd, but then again we've come off those levels. And you take a look at the Nifty Bank as well; that is also presenting a correspondingly similar picture. It was HDFC Bank that was leading that recovery, and there you can see the similar recovery move being played out on the Nifty Bank as well. That recovery is also being sold into again, but the index here too is as of now trading above the mark of 53,000. The one index that is supporting the Nifty, it did so yesterday, continuing to do so today as well, is IT. And despite this recovery, of course, all of these names are still down well over 20% on a 20 to 25% on a year-to-date basis. But Infosys is seeing its biggest single-day gain since May of last year. For TCS, it's January of last year as well. So both of them now anywhere up between 5.5% to 6%. Coforge, Sonata Software, these non-index names also doing very well for themselves. Every single constituent of the Nifty IT is trading with gains today. Tech Mahindra at one point had almost turned positive on a year-to-date basis, but that surge in Tech Mahindra has been sold into. We'll talk about that in just a bit. Look at the newsmakers in today's session, barring IT. NHPC, of course, after the OFS has opened for non-retail today, 5% lower on the stock. Ola Electric, the launch of its QIP. Alchem Laboratories, it will be interesting to see who are the buyers in this block transaction that took place. And Acme Solar is up 7.5% after the QIP launch. Of course, it was a confirmation of a CNBC TV 18 news break from earlier in May. Some companies that are extending their losses today. RHI Magnesita, after its results, is being battered every single day, 7.5% lower today as well. Physicswala has yet again slipped below the mark of 100, 4.5% lower on the stock. RVNL at a 52-week low, 3% down on this one as well. The all-time high on this stock is close to around 650 rupees. And Paytm too seeing a not so good day at the office today, 3% lower, below the mark of 1100. And some names at 52-week lows, the usual suspects that we have been highlighting over the last couple of days. SBI Cards is one such name, 3% lower on the stock now, well below its issue price of around 750. GSK Pharma down around about 2%. ICICI Prudential Life, another 52-week low for the stock. And Escorts Kubota makes an entry into these stocks that are having a not so good day at the office today, Ritu.
All right, not such a good day there. But Hormaz, thanks very much for running us through that list. Let's welcome the first management on the show today, Lumax Auto Technologies. They reported a near 50% jump in profits for both the fourth quarter and for FY26. They've also delivered double-digit growth on the top line. Margins have expanded as well. So looking good all around. Let's discuss the performance of the quarter gone by and the way ahead with the Managing Director, Anmol Jain. Anmol, thanks very much for your time here. You know, your revenue for the full year FY26 growing by 28% or so. It is significantly ahead of the industry. Will you be able to sustain this momentum going into FY27? If you could start by giving us your guidance there, and also the capex plans you have lined up and the kind of investments you're going to make in various, businesses through the course of the year.
Thank you for having me, Ritu. So first and foremost, I think the industry at large had a significant Q4 FY26, and by and large, the full year, the industry looked at record numbers in terms of production across segments. Lumax was able to outperform the industry growth largely on account of 2 or 3 different strategies. One is we are focusing on increasing our value content per vehicle. And if you look at the 3-year, 4-year trajectory, the value content per vehicle across 4-wheeler, 2-wheeler for us is continuously rising. Number 2, there are a lot of new products we are getting into through the localization route. So while it adds to our growth numbers, it not necessarily adds to the production numbers for the OEM. And thirdly, in certain businesses, we've also expanded our wallet share compared to on a year-on-year basis. So with these 3 aspects, we have been able to outperform the industry growth by almost 2x to 3x. Going forward, FY27, I think there is a lot of volatility. We do expect, however, the growth momentum to continue for the industry at large. And Lumax Auto Technologies, we are quite hopeful that we will continue to maintain the momentum to outperform the industry by about 2x for the full year FY27.
So, Anmol, in that regard, so that you said that if you can quantify that as well, the kind of revenue growth that you're anticipating in FY27 and on the margin front as well, what are the kind of numbers that you're working with there?
Well, difficult to quantify, but Hormaz, like last year, the industry grew by 12%. And as you can see, we grew at about 27, 28% for the full year. So as I said, we have outperformed the industry by about 2x, 2.5x. And again, because of the volatility, it's very, very difficult to give a number on the industry growth for the year. But, as I said, if the industry grows at 10%, we will continue to outperform that by 2x. And if it grows at single digit, then again, we will probably look at a 2 or 2.5x of the industry growth. In terms of margins, I think as a part of our midterm strategy, we want to inch towards a 20% EBITDA margin. I think the company is making significant progress and expanding the margins on a year-on-year basis. FY27, though we see a lot of input costs escalation, we are quite hopeful that we will be able to sustain or at least marginally grow the margins by maybe about 30 bips or so for the full year FY27. And earlier, I think there was a question asked on CAPEX. The company is sitting on a very solid order book of about 1,450 crores. Most of this will come in FY27 and 28. So the CAPEX plans for the year are anywhere between about 275 to 300 crores. Again, in line with delivering the order book for the next 24 months.
So you mentioned order book, Anmol. How much of that order book is linked to electronics, telematics, and your connected vehicle solutions, part 1? And 2, since the focus is on premiumization as well, how much of that is leading to an increase in your content per vehicle?
About half of the order book, Hormaz, is on our advanced plastics, which largely focuses on interior systems. And that is where the premiumization kicks in, and hence it helps us in increasing the value content per vehicle going forward. Regarding the telematics, or as we call it, the mechatronics part of the business, that is the second largest pie for the order book at about 25 to 30%. Mechatronics is one vertical which has seen an accelerated growth despite on a smaller base. But again, as a part of our next 3 to 5 year strategy, mechatronics will outperform the growth of the other businesses. And we are getting into a lot more technologically advanced products. These are sensors, these are hardcore electronic parts with a very high enabled technology. And that's exactly which will enable us to move up the margins as well. A lot of our growth is coming from product lines which typically yield a better profit margin than the consolidated level. And that's the part of the strategy how we want to play over the next few years.
Since you spoke about premiumization, Anmol, how much increase, if you could quantify, are you seeing per content in, across key OEMs? If you could give us a number. And secondly, also in terms of your order book, now how much of that is EV linked and how large a part of business do you think that could grow out to be?
So, Ritu, on the content per vehicle, I think the company used to operate at about anywhere between 25 to 30,000 rupees on a passenger vehicle, which significantly has over the years gone up, and now we're close to about 60,000 rupees a vehicle. A large part of this, of course, comes from the interiors, which is still probably more than half of it. But again, there are a lot of the other businesses which are consistently adding the value content per vehicle. As I mentioned earlier, localization is an integral part of our alternate fuel systems or even the mechatronics division, how we want to continuously push up the value content per vehicle. In terms of the order book, I think EV in general is a smaller part. We do have significant orders from passenger cars as well as two-wheelers for EV. But again, from the overall pie, it would not be more than about 10% or so for the total order book.
And what about the contribution from green fuel? If you could quickly detail that as well.
I think the green fuel is, again, something which we really bet big on because of the whole CNG penetration. And I was recently reading, one of the largest OEMs has had a significant ramp up by almost 40% on their CNG uptake. So CNG, I think we do believe has a very strong future in the Indian automotive, especially the passenger car segment. Again, the contribution right now, green fuel grew significantly for FY27, but I think we are pretty much on track to double the CNG revenues over the next 3 to 5 years, growing at upwards of 20-25% CAGR. And we remain absolutely optimistic and bullish on the CNG penetration in the passenger vehicle segment.
All right, that's quite the bullish commentary. Anmol, thanks very much for your time here today on CNBC TV 18. We appreciate it. And on that note, we're going to slip into a short break. But when we return, we'll focus on bond markets with Manisha Gupta. Welcome back. Let's get you some conversations from the sidelines of the Bank of America conference that's taking place right now. We have Bharat Subramanian, who's a senior analyst of energy at BofA Global Research, joining us now. Bharat, good morning to you, and thanks very much for joining us here. Let me just start with the very basic question on what's happening with oil prices. I think we have your last report only from April, where you had assumed the war may end in the next 2 to 4 weeks. We're far away from that. And, the peace talks seem quite fragile. There's one development one day and another the other day. Oil prices up 5%, down 5%. What are you building in now for the near term? Where do prices go from here?
Yeah, firstly, thank you very much for having me on the show. Look, unfortunately, I can't really comment on the direction of oil prices here. A lot of it, as you might appreciate, depends on the geopolitical scenario. But what we do build in essentially is if crude prices were to be higher for longer, we would actually prefer, say, the upstream oil and gas companies, the exploration production companies, rather than the downstream oil marketing companies. But I'd say just in terms of directional movement of crude prices, a lot really depends on geopolitics.
Bharat, thank you for joining in today's for today. But the bigger impact of these oil prices have been on the oil marketing companies, and after suffering for losses that have run into almost lakhs of crores, finally there have been some price hikes that have been put in place, but despite that they are still losing money on every liter of petrol and diesel that is being sold. But based on your estimates, how much more of a price hike would they need to undertake to at least break even, if not make money? Make money comes later, but at least to break even in the first place.
Yeah, so look, again, a lot really depends on, I'd say, two factors. It's not just crude prices, but also on currency depreciation as well. Both of them adversely impact the marketing margins for auto fuels, that's petrol and diesel. We have seen a couple of good measures. I think we did see excise duty cuts of about 10 rupees per litre in both petrol as well as diesel beginning of March. And more recently, we have seen auto fuel price hikes. But a lot, I think, has to do with where we end up, where Brent or crude prices ends up stabilizing, and where we actually see the USD INR as well. The other key point that we'll have to also watch out for is in terms of LPG losses. While this is a subsidized product, we have seen this widen quite substantially. In fact, in the month of May, it's actually gone north of 650 rupees per cylinder. So absolutely right, these are three key points to watch out for. But ultimately, the quantum of price hikes will largely depend on, I think, where crude prices settle and where the USD INR settles as well.
But in your base case, what are you building in? Your report talks about every 1 rupee depreciation, for instance, hitting marketing margins by 50 to 60 paise per litre. So, what is your base case building in today at the current levels?
Yeah, look, we are building in losses for marketing margins for the oil marketing companies this year. But essentially, our global crude price forecast is $92.50 per barrel for CY26. So that's the base case that we've really assumed. But essentially, as I said, these numbers, a lot of them actually depend on where crude prices ultimately settle and where USD INR ultimately settles, along with the petrol or diesel price hikes that we actually see getting passed through to the oil marketing companies.
In that case, Bharat, you're expecting oil to remain at around 92.5, which is, well, nearly where Brent currently is at the moment. So in that light, do you see the upstream companies as an investment opportunity, the ONGCs and the Oil Indias? Of course, you're not asking you for a stock-specific recommendation, but as a theme in general, does upstream provide a favorable investment scenario in such a higher for longer crude price scenario compared to the oil marketing companies?
Absolutely. So just a couple of points that I'd like to make on the upstream space. One is obviously both higher crude prices as well as INR depreciation is beneficial for the realizations for upstream oil and gas. Number two, I think something that we've also been highlighting is energy security as a theme. And herein as well, there's quite a lot of focus now on deep water and ultra deep water exploration and production. If you actually look at the last couple of years, a lot of the acreages that have been offered are in the deep water and ultra deep water exploration production wells. And last year we did see the ORD Act amendment, which has brought in quite a lot of regulatory stability. And this is essentially, I think, a move to entice global investments here as well. So while perhaps the domestic players would be anchor investors, we could see global capex also coming, global investors also coming in to put capex in the upstream space as well. So effectively, a good stability as higher for longer oil prices, along with USD/INR depreciation, we think actually the upstream oil and gas space is something that we would actually prefer at this moment for sure.
So that's about oil, Bharat. What about gas? Is that emerging as a bigger concern than oil today? I mean, the markets have been tightening. You've seen prices go up as well. Any names, if you could share with us in terms of companies that are most impacted? And from an investment theme point of view as well, which way would you lean?
Look, unfortunately, I can't really talk about single stocks. I can only talk about the sector as a large. So, look, we do have a very high dependency on gas imports as well, energy imports in general, but gas imports as well. I think natural gas is about 50%, LPG slightly more than that. Essentially, quite a lot of the upstream efforts by the exploration production companies domestically also is to do with increasing domestic gas production as well. And perhaps another key theme in energy security that we really do see, this is of course over the medium to longer term, is in terms of biofuels. We do see India having the potential to substitute up to 120% of its current natural gas demand using biofuels with existing feedstock. We do have a few bottlenecks here right now, but this, along with ethanol, is I think something that we are quite bullish on, at least as far as biofuels is concerned, as a way to kind of build an energy security in India. So yes, a lot of dependency on gas imports as well, but a combination of higher exploration and production domestically, as well as biofuels, which uses feedstock that's actually available domestically as well, could actually help in the medium to longer term to bridge this as well.
In light of that, Bharat, you've mentioned ONGC, of course, as your top pick, as in your report as well. You spoke about upstream as to how that can be an investment theme. You've chosen upstream over downstream, yes, but for the oil marketing companies, valuation comfort, dividend yield, so on and so forth, and that hope that sooner or later things will eventually return to normalcy, maybe 3 months, 6 months down the line. Would you use this as an opportunity to add on to these oil marketing companies and then cash in on the returns once things normalize?
Yeah, look, again, I will not be commenting on single stocks, but essentially the longer the crude prices stay higher and we see USD/INR, if it depreciates further, we would actually prefer to stay invested in upstream rather than downstream. Within downstream, we essentially see those that have a lower marketing to refining throughput ratio to relatively benefit. So that's what I can say are the relative beneficiaries of downstream at the moment, given the elevated prices. Of course, if we do see prices come off or even the USD/INR stabilize where it is and more price hikes coming in the pumps, it could be a different story. But in the current construct, we would still prefer upstream over downstream. And within downstream, those that have a lower net marketing sales to refining throughput ratio.
Okay, Bharat, before we let you go, I mean, of course, it's difficult to predict these things, and we've seen that a lot of analysts have proven wrong on it as well. Let's say, hypothetically, the war continues for the next few months. What are the key levels you'll watch out for? And, what are the levels above which, you'd have to revisit some of your calls that you've made on ONGC, etc.?
Yeah, I think quite a lot depends, as I've mentioned, on the levels of Brent or crude oil in particular, as well as USD/INR. The other key point to watch out for, I mean, I did mention the regulatory stability, especially with the ORD Act amendment that was introduced last year. But I would say another key thing to watch out for is in terms of whether there's any introduction of a windfall cess or a special addition excise duty on the production of crude and potentially even new well gas. That's something that we've not really built in our estimates. But essentially, I think that is something that we'll have to watch out for as well.
Bharat, thank you for sparing time and joining us today with your views on the oil and gas space. Wish you good luck at the conference as well. Now, shifting focus to the big story of the day as the index continues to remain around that 23,300 mark. The fact that IT stocks are the ones that are staging this recovery and they're continuing their recovery, they're lending support to the index as well. Infosys, TCS, all of them. Rima is here with more on the Indian IT recovery. Rima.
Indeed, Indian IT is leading the market now for the second straight session, and a couple of factors are things that are driving this up move. One, global rotation. So money is moving back into the software names worldwide compared to the Max 7. So results from many of the SaaS companies have been strong, some of them upping the guidance. So basically that fear in the market about a SaaS apocalypse or a breakdown in the business model, at least for now, has been put on the back burner. Secondly, the INR weakness, right? That's a direct earnings tailwind for many of the IT exporters. But the bigger thing is the valuation of this sector was beaten down hard. IT is, amongst the cheapest that we've seen in the last many, many years. So what we are seeing today is a big up move. And in the last 2 days, that's yesterday and today, stocks have rallied between 4, 5, 7%. But year to date, these stocks are still down between 20 to 25%. So in a way, this perhaps is a bounce and not a full-fledged recovery because the sector is still deep in the red for 2026. Now, most of the IT stocks had hit their recent, that's the 52-week low in March of 2026. And since then, what really stands out is the fact that mid-caps have recovered much harder and faster compared to large caps. So now I'm comparing it to the recent 52-week lows, which for most of them was in March. Now, stocks have recovered about TCS, for instance, 7.5%, and Infosys close to about 15%, HCLTech 10%, Wipro 11%, Tech Mahindra about 20%. Now compare this to the mid-cap IT names where you are seeing an across-the-board 30 to 47% rise from the recent 52-week low. So the divergence in the mid-cap recovery versus large-cap IT recovery is fairly stark. So Coforge stock is up 47% from 52-week lows. Tata Tech 40%, Hexaware, FirstSource. These are all stocks which have recovered about 30% from their recent lows. So I guess that's the key takeaway, right? There is no real one fundamental news which is driving the up move, but IT is providing leadership, but it's coming on a low base from an underperformance, and mid-caps are the ones which are recovering faster. Now, there is no real trigger for the IT sector. Earnings for the Indian pack kicks in only in the early part of July, but Accenture reports numbers on 18th of June, so that would be the immediate trigger to watch. So let's see whether this rotation, this up move in IT has more legs to go.
Right, we'll watch out for that. Rima, thanks very much for breaking that down for us. The IT pack doing pretty well in trade today. On that note, we'll slip into a short break, but don't go anywhere. We're back with more on the markets after this break.
Welcome back. The recovery continues on the Nifty as of now, 50 points lower now on the index. It'd be interesting to see whether that sustains or not. So that intraday recovery that came in at around 10:30, which got sold into, that's now gotten bought into again. And it remains to be seen how the second half of this weekly options expiry session pans out. Well, Nikunj Doshi from Bay Capital is now joining in to talk more on markets. Nikunj, good morning. Thank you for taking out time. This chatter around IT names, okay, AI is not coming after your jobs, it is not the end of the world. Suddenly from doomsday scenario, suddenly there is some light emerging at the end of the tunnel. Do you see this as the start of a turnaround for Indian IT, or is this just a bear market rally? You would use any of this to just exit your positions from here?
I think, frankly speaking, this rally, IT and services sector rally is, I think, on the back of a statement by Mr. Nandan Nilekani in the annual report, and saying that AI will not take away jobs and services will become even more important going forward. So I think the market is reacting to that optimism by Mr. Nandan Nilekani, and obviously he's the stalwart of the industry, so people will believe him. But still, from our point of view, IT services is still in uncertain times and uncertain waters. We don't know what's going to actually pan out over the next few quarters or years, because again, people are talking of rising token costs and all that. And so again, it's really uncertain times, and we don't know what will happen to IT services as a sector, but it will not go away. It is not going to vanish.
But Nikunj, the broader question then still is, have we seen the bottom? Has the IT sector make a bottom, or, this is just another bounce that will get sold into later?
Difficult to say anything on whether it's a bottom or not, because we've seen several times that market gets very bearish at the bottom, and right now I think till last week perhaps that was the scenario. So let's see, wait and watch. I think let's wait for 1 or 2 more quarters before calling it a bottom.
Okay. Well, Nikunj, back to financials that we spoke about last time as well. It's the largest allocation in your portfolio. Within that, as we're seeing this conflict drag on, some of the concerns, and you've seen the ECLGS also being, heavily subscribed to by banks, and clearly showing some bit of stress build up. And it's not just the aviation companies. So in the banking space in particular, in the near term, where do you see opportunities between public, private banks, NBFCs, or even some of the new age companies?
So I think, banking again concerns are that the rates will go up, and cost of capital cost of liabilities will go up for the banks. But I think it's still early to call that, and I don't see interest rates going up in India, at least in a near term, because the current inflation is mainly supply side, not because of the demand side push. So I think interest rates perhaps will be maintained, and on the banking sector per se, we are more bullish on the NBFCs in operating in niche areas. So like gold finance, or perhaps on the LAP area, LAP segment. So we are more bullish on NBFCs rather than the core banks.
I was just looking through your holdings, Nikunj. One of those names is Delivery, where you have a significant exposure. And Delivery is perhaps the only name amongst the class of 2021-22, barring Paytm, that has not managed to cross and sustain above its IPO price, the underperformer that it has been ever since it listed back in 2022. What drives your conviction on Delivery? And if you could add in to a lot of these logistics / supply side operators, if there is if there is any other differentiator that drives your conviction on Delivery.
So again, Delivery, I think, is right now leading the consolidation in the e-com parcel space. So they already acquired one company, and I think right now, whatever efficiency gains they are passing on to the customers and trying to gain more market share in the industry. So right now, their focus is to gain market share and perhaps weed out the marginal players in the industry. So I think Delivery right now is in the phase where they want to focus more on the market share rather than the core profitability. Even though they are profitable, no doubt, but still right now their focus is not to milk the cow, they're more into gaining the market share. So I think over next couple of years, we'll see that they will perhaps capitalize on the leadership they have on the e-com space, plus the part load truck sector or the full load segment. So I think logistics wise, it's a core sector for the economy, and they are likely to benefit from the tailwinds, and delivery being a leader. I think we would like to see their growth over next couple of years, and we are very optimistic on the company.
Anything in the PSU basket, Nikunj, with be it railways, be it defense, a lot of these larger defense names or the railway names, there was this one point where people could not stop talking about a lot of these railway companies / defense companies. But today, the railway names almost seem to be a forgotten story 2 years down the line.
So frankly speaking, means we are not into PSU as a space because we avoid government dependent or government led companies because the government priorities change often, and we don't know what their focus will be. So we avoid PSUs per se while participating. Again, we have signed UNPRI as an organization, so we don't look at defense as a sector also for investing.
What about healthcare and pharma, Nikunj? I mean, has the easy money, would you say, been already made there? If not, how would you look at this space? Is it the domestic manufacturing, the export-oriented? What looks attractive?
So pharma, I think overall domestic space is interesting, and export also because of the rupee depreciation plus the kind of tailwinds for the industry. We are optimistic on the pharma as a space, and we have a couple of names in the portfolio in the pharma space. But domestic is the main focus area for us right now, domestic pharma.
Domestic pharma, okay. And Mankind Pharma is one such name that's a part of that theme, right?
Mankind Pharma is one of the companies in our portfolio, right?
Nikunj, pleasure having you today. Thank you so much for sparing time and joining us today with your views on stocks and, of course, on the markets as well. Take a short break. On the other side, we hop over to the FNO desk with some trends on the weekly options expiry session and also get you some trading ideas with Ajit Mishra of Reddy Broking. Welcome back. Yet another instance of an intraday recovery getting sold into on the index. Here back below the mark of 23,300 as we speak. So it's very, very choppy right now for the markets. It's the perfect time to bring in Nigel, who's at the FNO desk, to tell you what are the latest trends from the FNO space on this weekly expiry day. Nigel.
As you said, Hormuz, things are choppy and expected to continue to remain so all through the trading session. The problem is yesterday we broke crucial technical levels. And that's why, the structure on the Nifty had got broken. However, the bulls are hanging on to two factors. One is the FI short positions have been very aggressive. Last few trading sessions, they've added close to 50,000 short contracts. And you have, the shorts now that are holding at around 90%. The other point is the PCR. At the start of today, it was sub 0.7. Now it's moved to around 0.9 because there is action on both the put as well as on the call side as well. So just take a look at a couple of factors now. As you said, the markets are down, right? Close to 80 points. But if you bought the 23,300 put, you're still not making any big money. The premium at the start of today was close to around 30 rupees, approximately 39 rupees or thereabouts. You're still not in the money with regard to that. Even the 23,250 put, well, the premium at the start of today was around 18 rupees. You're still not making money on that. That's clear signs of writing at those levels, which is telling you the bulls want to defend the lows of the day. While on the upside, the 23,400 call, that's been getting written from the word go itself. So just punching in these levels, with regard to the options data, you've got your range for the day. Any kind of move towards 23,500 odd will invite a lot of selling out there. So that's a resistance mark for the day, going by the kind of writing you've seen at around the 23,400 call. However, on the downside, the bulls will want to defend this 20,229. The slide has been very, very sharp, and that's why from those lows, we have seen a bit of a bounce. So the day's low is something you don't want to get violated on the downside. What's come to the rescue of the bulls today is the tech stocks. TCS, that one has been shorted. That's seeing a bit of a short covering bounce in today's trading session. HDFC Bank, I think that one as well holds the trigger today because that one has bounced a little bit off from the day's low, and there are some mild signs of shorts covering out on that one, which will be crucial for the Nifty Bank as well as for the Nifty. And Reliance Industries as well, some unwinding of positions, very mild shorts getting into the system, but I've seen at around 1,300 odd, there's a lot of demand for the stocks. We'll keep an eye out on that. I'm highlighting the big names because the bulls will bet on big names to pull the markets up. And in terms of stocks in the broader markets, NMDC, fresh buying being seen out there, good amount of cash-based buying, and there's long build-up as well. The street is getting quite optimistic out there. We'll keep an eye out on what the government of India thinks out there with regard to their holding in NMDC. So that's a stock that's seeing good amount of long addition.
All right. Thanks, Nigel, for running us through that. Let's bring in Ajit Mishra from Reddy Broking, who joins us now for a quick technical check of the markets. Ajit, 23,300 kind of levels we're at. Looks like we're making lower highs, lower lows. What are charts telling you? We're below both the 50-day and the 20-day average near-term levels you'd watch out for, and any particular stock picks for the day?
Hi, good morning. So yes, you are right that we are again reeling under pressure. Means the attempt that we made last week of sustaining up 24,000 mark fizzled out. And since Friday, we are seeing that the selling pressure has intensified and we are back to the previous swing lows. Close to around 23,250 was the area basically where we made the last low. The gap that we have on the daily chart is close to around 23,150. So broadly, this 100-point kind of a zone is somewhere we have the immediate support. And in case if Nifty fails to hold this area, then probably we are set for the next leg of the down move towards 22,800 mark. So the overall texture is still sell on rise until we decisively reclaim 24,000 mark, with 23,800 now being the immediate resistance. So, but at the same time, sectoral front, IT is definitely, witnessing a strong rebound, in the last few sessions. We are 7% up on the week-on-week basis. That is capping the pace of a decline in the index. So at the same time, on the other sectors, we are getting opportunity on long and short side both. So basis that, the first recommendation that we have on the long side is Varun Beverages, VVL, wherein the stock is not only holding strong, but in fact, it's witnessing noticeable traction after retesting its short-term averages. So 570 is what we are eyeing as an immediate target in Varun Beverages, with 515 as an immediate stop. And then the FMCG basket, which is continuously reeling under pressure, HUL, where the stock is inching towards its previous swing lows. Indications are in the favor that this decline may further extend, with 1950 being the next target area. So with stop at 2140, one can look for shorting opportunity in HUL.
Ajit, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. Yet another day of losses for Hindustan Unilever has just not managed a recovery after that MSCI-led selling that took place in the stock on Friday. Take a short break. On the other side, we come back with a check of India's macros and the macro signal on the other side.
Welcome back. It's down about 90 points on the frontline index, 23,293, below the 23,300 mark. That's where we're at. But let's get you the macro signal for the day as well. Let's start with the rupee, which is under some pressure today because of what's happening, the continued volatility in oil prices. That again is driven by uncertainty around the US-Iran negotiations and, of course, the sustained foreign investors selling in equities that continues. Now, the rupee has largely avoided sharp depreciation in the last few sessions. And thanks to, that's largely because of the central bank's intervention in the market. For now, you have the rupee at 95.16 against the dollar. Meanwhile, the oil prices have retained most of the gains from the previous session. Markets, of course, are monitoring very closely these fluctuating reports about the peace negotiations in West Asia, tensions there, while some reports were suggesting suspended talks, other news of troop withdrawals from Lebanon, etc. That's kept Brent crude prices near $95 a barrel. And amid the confusion, first we saw Brent crude prices rise about 5%, then they paired some of the gains, now trading at about $94.16 a barrel. The 10-year benchmark government bond yield, that's trading near 7.02% as we speak about, that's where it's currently at. The market is currently in a consolidation phase because traders are also going to watch out for what happens in the monetary policy decision that we'll see this Friday. Remember that the 10-year yield has climbed approximately 34 basis points since the start of the conflict in West Asia. Now, apart from this, there's other important data that came in after the markets closed yesterday, and that's fiscal deficit, which has surged to 3.62 trillion for the month of April, which is nearly double the kind of level that we saw in the same period last year. That, of course, is driven by a sharp decline in the government's revenue receipts and a jump in expenditure in the first month of the ongoing financial year. The decline in receipts follows, the government's decision to cut excise duty on petrol and diesel. That resulted in a revenue loss of nearly 14,000 crore rupees. For the full fiscal, though, FY26, the fiscal deficit at 4.4% of GDP is bang in line with government estimates. And finally, in another interesting development, South Korea's equity market has overtaken India's as the world's sixth largest. That, of course, as we've been telling you here, is driven by a relentless surge in chip heavyweights that are powering the global artificial intelligence build-out. The sharp rise in Korean equities has been led by Samsung Electronics and SK Hynix, both of which recently crossed the 1 trillion valuation mark. As of the 1st of June, South Korea's market cap stood at $5.04 trillion, surpassing India's $4.84 trillion, and Taiwan, which overtook India last week, stands at $5.15 trillion. And on that note, we will slip into a short break, but up next, we'll get you more on the markets, so stay tuned.
Welcome back. Well, the markets may have not gone anywhere in the month of March, but the margin trading book went in one direction, and that was upwards. And another 8.5–9% gain that the MTF book saw in the month of May from levels of around 1.16 lakh crore at the end of April. The figure at the end of May stood at 1.26 lakh crore rupees, and that is almost a record for the MTF book. Now, look at the 5 top traded names on the MTF book and the changes that they have seen. Yet another month where you have seen HDFC Bank emerge as the top leveraged stock on the MTF book to 2261 crore. Or the exposure is a 14% jump. But what has sprung a surprise in the month of May is ITC. The stock is at a 52-week low, but the MTF positions have almost doubled on the stock and almost now close to 1,800 crore rupees. Reliance Industries seeing yet another month of close to 50% growth in its MTF positions. Not so much for Jio Financial, and State Bank of India, after its fourth quarter results, has seen a very, very sharp jump in the MTF positions that it has seen. Now, if you take a look at the stocks that have seen the biggest increase, SBI features in that list with that 157% jump that it has seen in the month of May in its MTF positions. But the biggest one is from Pine Labs. At the end of April, the MTF exposure in Pine Labs was just around 24 crore. That has gone up to as high as 200 crore. It's a 730% jump that Pine Labs has seen. Lupin is one such name. Escorts Kubota, the stock is at a 52-week low. Their MTF positions have more than doubled as well. And Britannia, from 70 odd crore to well over 160 crore at the end of May. To get a look at the stocks that have seen a decline in the MTF positions, two mid-cap IT names feature prominently in that, both Persistent Systems and Coforge doing very well for themselves over the last couple of days, but the MTF positioning in May declined anywhere between 30 to 40%. Solar Industries is one such name that was in the spotlight over the last couple of days after its results, the guidance and so on. The stock saw some sharp moves there too. The MTF positioning has seen a decline. Polycab is one name that featured in the April to May review as well. Here too, the positioning is constantly seeing a downward move, another 44% knocked off in the month of May. And SBI Life, a stock, another one that has seen a 44% reduction in its MTF position. So actually the MTF book has seen a growth. It is at record levels, well over 1.25 lakh crore rupees, but two names that have sprung a surprise this time around, actually three to be fair. One is ITC, the other one is Pine Labs, and the third one of course is State Bank of India. With that, we take your leave on this edition of Trading Hour from Ritu and me. Thank you for watching. The markets continue to remain as choppy as they can be. Halftime report takes the action forward on the other side.
Stocks slip on fresh uncertainty over the US-Iran war and resolution that's coming in. IT and metals gain while utilities and healthcare drag.
A rush of share sales line up after the earnings season ends. The center looks to divest up to 6% in NTPC. Alchem sees a large block trade while Acme Solar and Ola Electric float QIPs. All these in a day.
Noel Tata, chair of Tata Trust, raises concerns over proposed infusion of 7,000 crores in loss-making Tata Digital. His daughter Maya will also exit Tata Digital and may join Trent or Tata Consumer. Sources tell cnbc TV 18.
The Aditya Birla Group is likely leading the race for Shell's Indian renewable energy platform Spring Energy in what is touted as an over $1.7 billion deal. The group presently has a presence in the segment via Grasim arm Aditya Birla Renewables.
Oil, copper and aluminium climb after Iran calls off talks with US and vows more blockades following Israel's continued strikes on Lebanon. Trump's claims of an Israel-Lebanon ceasefire and ongoing talks with Iran aren't enough to douse concerns.
Hello and welcome to a halftime report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Bhutra and Vinny Motiwala. Well, it is turning out to be a sluggish day for us again. So we have the Nifty, which is trading below 23,300 as we speak. We have the mid caps, which are under pressure as well. So down around 0.8% currently for the mid cap index. Bank Nifty down over 350 points as well. What really stands out as a beacon of hope is definitely the IT sector. So the Nifty IT index manages to outperform. It's gained close to 7% this week itself. And we have stocks such as TCS, Infosys and HCLTech, which have all broken out. Remember that the index itself is down around 18% on a year-to-date basis, but is seeing some bit of a comeback at this point in time. Hi, girls.
Hey, girls. Good afternoon. Of course, IT is something that we'll continue to discuss. Massive moves on this index today. But other than that, if you look at some of these constituents, the pharma index continues to trend lower. We have the energy stocks, which are not doing so well. The Nifty did attempt recoveries, but those were sold into. So that continues to be trend that we are focusing on. Pharma index is at the day's low. You have energy, which is not doing so well. Oil and gas also giving it some company. At this point in time, we do have a lot of these consumption stocks, which are at the day's low. For instance, Nestle India, HUL, Asian Paints, all these stocks are not doing so well and pushing the Nifty lower as well. So that continues to be the trend. Of course, the West Asia war and the uncertainty here is back in focus, and that is what is putting pressure on the markets.
Absolutely. That's what is putting pressure on the markets. And in the last 5 trading sessions, Nifty has seen red on the screen today. Obviously, that's what is continuing as well, right? And when you look at it, advance decline ratio in the last 3 trading sessions have been more in the favor of declines versus advances. But what's lined up for you all on the show today? We have a very exciting lineup, right? First up, we'll speak with BofA Securities' David Honor and put the focus on global and domestic markets. And in our movers and shakers segment, we will bring you the top buzzers in trade today and also put the limelight on NTPC, NMDC and Fast Motors. We also will be putting the spotlight on a slew of share sales in focus today with Nimesh and also bring you snippets from our conversation with Wockhart's Habil Kurakiwala on Zenith opportunity and what it means for the company. Okay, let's move on. And time for our first segment. That's the movers and shakers segment, where we track a whole host of stocks that are buzzing around in trade. First up, let's go across to Nigel, who's here to tell us why NMDC is in focus today.
Well, that's right. NMDC, in fact, has seen a good bounce from yesterday's low. And it seems the street is ignoring the near-term headwinds and they're looking ahead at some tailwinds. So let's run you through the numbers first. The numbers are a little lower than what the street was working with out there, but that was predominantly because some costs were higher and also the pellet business, which is a smaller part of business, that reported an EBIT loss of close to under 100 crores. But the street is looking ahead. What I mean by that is NMDC has already gone ahead and hiked prices by around 500 to 600 rupees odd for the first quarter of FY27. They've also mentioned that they're targeting sales volumes of close to around 60 million tons in 2027 and 100 million tons in 2030. This compares with around 50 million tons in FY26. So they're given a trajectory in terms of growth. The capex they're upping as well to around 6,000 crores from around 3,300 crores in the past year. And they're saying from year on, capex will remain a little bit elevated at more than 6,000 crores. Now, the business update was disappointing. Though the production number was good, up closer on 20%. However, the sales or the dispatch number was actually down by closer on 7%. But in Chhattisgarh, there were no worries. The problem was in Karnataka, where the volumes came down drastically. But I've had a word with sources in Karnataka, and the problem out there was there were a couple of one-offs. There was a contractor change out there which hurt them. And they expect things to normalize in the coming quarters as well, coming months itself. So the street is looking ahead on that front as well. Brokerages, they're split down the middle. Nuvama, they maintain a hold rating, though they've upped the target price to 100 from around 85 rupees odd. They have raised their EBITDA estimates for the next couple of years by 13 to around 16% because they're factoring in higher volumes, higher prices as well. Citi, though, they maintain their sell rating, target price of around 85 rupees. They're saying that domestic prices will be range bound. And they're also pointing out that Lloyd Metals, they have upped their capacity to around 25 million tons from around 10 million tons. So there'll be additional supply into the system. Put everything together, street is looking ahead, ignoring the near-term headwinds and saying there are tailwinds for the stock from here on.
Okay, all right. So that's about NMDC. Thank you for that, Nigel. But Force Motors is a stock which is not doing so well in trade. Sudarshan is joining us with all the details. Sudarshan.
It seems that Force is not working for Force Motors. For the month of May, company has reported decline in the total sales. Total sales have declined by 15%. And both the segments, you talk about domestic, there was a decline of 15%. Export, while the contribution is very negligible, but there the decline is as high as 37%. And total sales have come at just 2,615 units. But on the domestic front, which is the highest contributor to the total sales, their sales have come in just at 2,560 units, which is at lowest levels that we have seen in last 18 months. And that we expected after the weak set of numbers that have come in from Ashok Leyland and Tata Motors commercial vehicle yesterday. So it seems that because of supply chain issue, all the C players are facing the pressure. And on the back of this, Force Motors also reported a weak set of numbers. The stock is currently down almost 5%.
Okay, Sudarshan, thank you so much for that. That's Force Motors, that's in focus as well. But we have a couple of share sales that have taken place today as well. Let's go across to Nimesh to get more of a breakdown and understand more on this as well. Nimesh, afternoon.
Afternoon, Vinay. So, earnings season is over and the fundraising season has started. So, no respite for us. We have to keep looking for news and keep reporting. For, fundraise in one single day, I'll start with OFS first, which is NHPC. So, it's a second OFS by the government in just 1 week. We saw Coal India first, and now in NHPC, government is looking to sell 6% stake via OFS, including a 3% green shoe as well. And the offer price is around 71 rupees per share. So that's the reason why the stock is under pressure today. So this is just a start, I believe, from the government side as well. They've been lagging behind, but it looks like they want to catch up on this fundraising spree. So that's the first one. NHPC down today because of the OFS at 71 rupees floor price. That's the first one. The second one is Acme Solar. That's a big one, a QIP of almost 2,800 crores. But the stock has reacted positively, largely because my sense is that there is a very strong demand for the Acme Solar QIP issue of 2,800 crores. So that's the reason why the market has reacted a little positively. It's up 7% in today's market. The floor price is slightly lower, a 5% discount. But looks like given the demand, we've seen a bit of an uptick on that name. So that's the second name. The third is Ola Electric, a small fundraise, 500 crores, but nevertheless that stock is under pressure. There is a 10% discount in the QIP, and hence a bit of pressure on that name. And the last one is Alchem Labs. Again, a promoter is looking. They've sold nearly 1.5% in a block window today. Again, close to 900 crores that they've raised. But there is a 90-day lockup for the promoter. But the trend of promoters selling or the QIP is coming in, it's only going to increase from here on because the earnings season is largely over. So 4 today, but my sense is there is more lined up in the next 1 month.
Okay, your sense is that more lined up in the next 1 month. Thanks, Nimesh, for joining in and giving us all of that perspective in terms of the kind of fundraising that we are seeing. But we now have Hormuz to take us through all of the stocks that are moving around in trade today. Well, Hormuz, it's a quiet day, but a lot of stocks in focus.
Quiet day, but IT is making all the noise, if you can say that. The only sector that is lending some semblance of support to the market. Every single stock on the IT index trading with gains, none better than Infosys and TCS. Both of them are seeing gains of anywhere between 5 to 6% in today's trading session. And both of them have seen their biggest single day gain since at least May or January of 2025. For TCS, it's Jan of 2025. For Infosys too, it's the biggest single day gain in a few months now. Some of the other movers that you're seeing in today's trading session, some of them in the likes of Wokhard, the stock was up almost 40-45% over the last 5 days or so, and now it's seeing some bit of profit booking. At the top loser on the Nifty 500 today, 7.5% lower in today's trading session. But the other one that's doing very well though is Bliss GVS Pharma. Barring that one odd day, the stock has gained every single day since the Anupam Rasayan deal was announced, and since then the stock is up almost 40%. So from levels of around 300, the stock has moved to over 433. A stock that's not doing well today is Physicswala. The stock has slipped below its issue price yet again. Now it's at around 97, so it's sub 100, fourth straight day of losses for the stock, and it's now down around 14% in this 4 days losing streak. Now, another one not doing well is RVNL. And ever since its results, the stock has continued to grind lower at a 52-week low today, fifth day of losses. And from its all-time highs, which were around 650 rupees, the stock is down almost 65% from those levels. On the flip side, the stock that's doing well, though, is Aditya Infotech. And ever since its results were announced, the stock continues to move higher. Another 52-week high for the stock, up now 22% in the last 3 trading sessions, another 3% in today's trade as well.
Okay, a long list. Thank you so much, Hormuz. It's never a dull day, right? So those are the stocks which are on our radar. With that, we'll slip into a short break. When we come back, we'll get you BofA Securities' David Honor on the other side. Stay tuned for that conversation.
Welcome back to Halftime Report on CNBC TV 18. Thank you so much for staying tuned in. As of now, the Nifty is at 23,288 level. So obviously we have come off from that recovery that we were making, right? But we're still off the day's lowest point as well. Now let's shift focus and time for an exclusive conversation for you all. Maruti Suzuki reported sales better than expectations in the month of May. The total sales rose by 35% against the expectation of 24%. My colleague Sudarshan caught up with the Senior Executive Director Rahul Bharti and started by asking about exporters and exports. What's the strategy there? Listen in.
We have grown our exports, as you rightly said, in the previous few years from almost about 100,000 a year to 447,000 last year. And it is in times like this when the current account deficit and the country needs exports to keep the rupee stable also. We are happy that the exports will help to some extent. We are facing some kind of issues, as you are aware, in terms of the Middle East, the West Asia crisis. Still, since Maruti Suzuki has a portfolio of about exports to 100 countries of the world, so we are fairly de-risked, and Middle East contributed just about 12.5% last year to our exports. So we are hoping to protect at least last year levels of about 450,000 a year. Fortunately, in the first 2 months of the year, April and May of this financial year, we've been able to grow by 38% year on year. And the reason is because we have opened new markets for our e-Vitara exports. We are exporting e-Vitara to Europe and Japan, and it has been a good success there. Because of this de-risking to about 100 countries, we've been able to grow.
Medium-term annual target for exports, if I remember correctly, was 7.5 to 8 lakh units.
That's right.
Do you have any timeline in mind by when do you think you'll be able to achieve that?
We should be able to have 7.5 to 8 lakh of annual exports by the turn of the decade, which is 2031.
After exports, if I can come to domestic, the most heartening part of the sales for the month May was the Alto and Espresso.
That's right, 140%
Yes,
growth.
it was a low base. If I can say 6,700 units. This month you have done 16,275 units. Do you think this momentum will continue? Because it still forms a major chunk of your total sales. Do you think this momentum will continue going forward?
See, let us understand what is it that brought about this change. So primarily this structural change was brought about by the GST, where of course we added on by increasing, by passing on the GST benefit completely to customers and putting an extra bit of price from our side, from the manufacturer side. So there has been a structural change. We see many helmets into our showrooms, which means a lot of earlier two-wheeler customers are coming to the showrooms, they are expanding. We see it as a structural change and a sustainable change. Of course, there may be some short-term implications of the war or of the oil crisis or of the current economic headwinds. But by and large, this is sustainable and we are very happy about it.
So now let me talk on the issue which is talk of the town, that is EV. So you had launched one EV, that is e-Vitara, which you are focusing majorly in the export segment. So now going forward, so you have one EV. How Maruti is placed on EV front? Can we expect further launches going forward or say over next 1 year?
Absolutely. So when we entered the EV production and market, we discussed with our parent Suzuki Motor Corporation, instead of your manufacturing in Japan, can we do a combined single manufacturing in India, in Gujarat, and make India the manufacturing hub for EVs? Because it will help our economies of scale of manufacturing also. Fortunately, Suzuki agreed. So now we have made India as a global hub and we are doing meaningful exports from India. The e-Vitara exports alone is about 5,000 a month. And the e-Vitara is India's third largest exported model, which is very creditable considering that an EV All the talk so far has been about imports of EVs, but we are exporting it in meaningful numbers. So that leaves us, and we are shipping it to about 46 countries, plus the domestic market. So currently we have a production constraint. We are able to sell about only 2,000 a month.
In domestic market.
In the domestic market, plus 5,000 exports. Having said that, we are expanding our Gujarat plant capacity. Our plant, the fourth plant in Gujarat, should be commissioned by about August or September this year, 26, after which we'll have more capacity. We are very happy to also report that our EV demand has suddenly shot up. The kind of bookings that we have received have gone up by 100%.
So 100% from
about 2,000 levels to about 4,000 levels.
So you can say 2,000 levels. It was a few months ago, 2 months ago.
And after the Honorable Prime Minister's recent call for austerity, call for local saving petroleum, saving forex, the consumers have responded positively. They are showing a distinct change towards cleaner fuels like EV, like CNG. Our CNG demand has shot up by 40%, EV by 100%.
So after Q4 earnings, I was talking to Mr. Bhargava, and he said that obviously Maruti will be outperforming the industry despite a strong base of second half of last fiscal, that they are expected to do more than 10%, despite SIAM's outlook in the range of 5 to 7%. Can we still say after 2 months that Maruti is on track to do better than industry and do more than 10% growth in FY27?
So April and May we have grown by 38%, and it's a strong consumer momentum. This is the power of the Indian consumer and maybe the power of the Maruti Suzuki brand and its promise. This year we are constrained by supplies. We will be commissioning 2 plants of 2.5 lakh per annum capacity each. One we have already commissioned in Kharkhoda, the other will come up in Gujarat. So 5 lakh capacity, and that gives us room for only about 10% growth.
All right, that's the word coming in from Maruti Suzuki. With that, we'll slip into another break. When we come back, now we'll get to BofA Securities' David Horner on the other side to discuss the fixed income market. Stay tuned for that. Welcome back. You're still tuned into Halftime Report. Let's get a conversation going now. David Horner, who's the head of Global EM Fixed Income Strategy at BofA Securities, is joining us now on the show. David, good afternoon. Thank you so much for joining in. And when we talk about the fixed income markets, US yields is one of the factors that would drive investments, right? Where do you see that number going? Because already near that 4.5% mark, fiscal deficit is rising. We are seeing inflation also above the 3% mark. Will it continue to go higher? What's your sense here? And if that does happen, do emerging markets still continue to stay attractive because you are bullish on them?
Yeah, and thanks for having me. So indeed, we are in the short term concerned that US rates can go higher. We think the inflation numbers near term will continue to be somewhat concerning because of the impact of high energy prices, but also because the US economy is doing pretty well. So in the short term, meaning for the next several months, we think there will be higher rates volatility. We continue to think that the short end of the US yield curve can go higher. That means the whole curve can flatten. That means normally a stronger dollar. So if you think about it in terms of euro dollar, which is sort of the most important cross, we expect it to go to 114 in the next couple of months. Of course, for the rupee, that's not ideal. So we see dollar rupee still going higher. We have it at 98. But I think it's also important to emphasize that this is the view for the next few months. As you say, we are bullish for emerging markets from a structural perspective. We think structurally the dollar goes weaker. Emerging markets will benefit from that. And eventually oil prices will also go down again by next year. But I think for the next few months, emerging markets definitely have some headwinds.
Okay. All right, David, thanks very much for joining in. Well, you know, we've recovered from those almost 98 levels, I would say, for the rupee. But what exactly is that predicated on? Because you're expecting 98 to come through possibly in the next few months. And that might be a situation where we might have oil prices which might have eased, geopolitical tensions which might have also scaled back a little bit. So what might not be working for the rupee then?
So it's important to emphasize that first, of course, we don't really know what will happen next on the geopolitics. But what we do think is that even if there's a big improvement in terms of the Strait of Hormuz quickly, it will take quite a while for global energy markets to fully normalize because we're going to have to rebuild global inventories and it will take some time before the supply chain pressures can ease. So the inflation impact of this situation will definitely last for most of this year. And that, of course, has implications for global interest rate markets. And I think in the US in particular, it's important to bear in mind that the economy is generally doing pretty well. And even without this energy shock, there would be some inflationary pressure. So I think that needs to be borne in mind. That explains why we think that even if, let's say, there's big news on Iran very quickly, that it will take some while before the stronger dollar and the pressures on the rupee can dissipate from that perspective. But you're right. I mean, by next year, we should definitely see oil prices quite a bit lower again because there's a substantial amount of supply coming to the market eventually.
All right. Just on that point, with regards to the rupee weakness, how exactly are you placed in terms of what the FIIs might be doing with Indian equities? Because they've been persistent sellers. That's been a significant pressure point for the rupee. Do you think that that might turn around? There might be a sentiment change. How are you working with that trend?
Well, I mean, I think generally speaking, global investors are still very under-allocated to emerging market assets, both in fixed income and in equities. And of course, that also concerns India. We have had 10 years of rather low returns in emerging market assets compared to US equities. That has meant that the global asset allocation story is still very, very overweight US assets. Our view from a multi-year perspective is the dollar weakens and assets in the rest of the world outside of the US outperform. And of course, emerging market equities are an important part of that story. And I think that India will eventually, again, be able to benefit from that, considering that it is, of course, one of the major EM equity markets. EM equities have done actually very well this year. So the question is, what does it take to outperform again? So far this year, it has been all about tech. So what we need to look for is basically, we think, a return towards more of a domestic demand-driven global emerging market story. Where does it come from? Well, I think it comes from a return to the theme that we had last year, which is essentially weaker dollar, lower rates. I think that is probably not going to happen in the next couple of months, as I discussed, because of high oil prices. But we think that this will be the story that comes back by next year.
Okay. Hoping it comes back by next year, David. Good afternoon. This is Vinny joining in the conversation as well. Given all the situation, the headwinds you've mentioned, rupee at 98 you've mentioned, all of this, where are you allocating across markets right now? What on the emerging market fixed income side maybe is something you are looking at?
Well, so I think for the next few months, this is going to be a context of relatively volatile yields, still pretty sticky energy prices, relatively firm dollar. So I think this basically means that in emerging markets, we're generally taking a bit of a pause from our very bullish structural stance, so a bit more cautious, generally speaking. Where do we allocate the money? I think in this sort of environment, it's good to have some carry strategies in higher yielding currencies that don't have too much vulnerability when it comes to oil prices. So we like particularly a number of currencies in Latin America, like Colombia, Brazil, for example. We like currencies that have high carry and strong central bank support, like the Turkish lira, to name one example there. And we continue to be long also in the Chinese currency because we think it is very, very undervalued. Yes, of course, it also suffered somewhat from high energy prices, but we think this is a currency that has a lot of value from balance of payments perspective. It's very cheap compared to many of its trading partners. So there's plenty of opportunities. And I think, again, it's important to emphasize that the medium-term story for emerging markets, I think, remains very constructive, continue to be very bullish on the perspective of lower dollar, eventually lower energy prices. But next few months, we're just going to have to go through this bump that basically has been created by the inflation domino effect from this energy price shock.
Okay. David, quickly, because it was expected, do you expect the Indian bond markets to be included in the Bloomberg index? Or do you think there are still certain issues that needs to be fixed here?
I think, I think that index inclusion are always important events. This will definitely lead to, will be positive. I think, eventually fundamentals are the most important factor for us. We don't necessarily see index events themselves as big game changers because normally what happens is markets anticipate already quite a long time before that they materialize, and of course they usually materialize because of structural changes in the market. In a way, this is basically ultimately a sort of seal of approval based on fundamentals.
All right, David, it's a pleasure. Thanks very much for joining in and giving us your perspective on the fixed income market as well as the rupee, which David says could possibly hit 98 in the next couple of months. That's the target on the rupee, but obviously contingent on multiple factors. But we do have the Nifty, which is down around 49 odd points. It's recovered a tad bit. So remember that we were below 23,300 for the Nifty. So there has been a little bit of a recovery. We're above that level, as you can see, 23,330 is currently where we're at. Even the Bank Nifty has seen a recovery of around over 180 odd points from the day's low. So down around 350 odd points. Yes, there is a recovery, but the markets still remain weak at this point in time. We have the mid-cap index, which is down around 0.8%, and we have the advanced decline ratio, which is still in negative terrain. Well, a small programming note as we take a break. Uncertainty in the market is rising given geopolitical and trade headwinds. We at CNBC TV 18 are featuring some of the biggest faces in the market from 3 mega conferences to help you take informed investment decisions. Tune in to CNBC TV 18 to catch the top minds from Bank of America's global investment team, including Amish Shah and Vikram Sahu. You can also catch macro and market opinion from Morgan Stanley's Chetan Iyer, Rhythm Desai, and Jonathan Garner. Citi's Managing Director Sue Lee and CEO Jane Fraser will also be part of the blockbuster panels lined up only on CNBC TV 18.
Welcome back. Joining us on the show now is Rajiv Pabreja. He's MD Commodity Trading Corporation. Rajiv, hi, thank you so much for joining in. And it really is a big growing market in sense of dry fruits and superfoods that we have seen. But then the West Asia conflict and the fact that India imports so much from Iran and Afghanistan, and all of that is really stuck. What is the demand increase that we are looking at? What is the kind of decline in imports that you are factoring? And the most important question, Rajiv, is how much of a price increase are we looking at when it comes to dry fruits?
See, the war is affecting everybody, and the dry fruit industry is also affected by that. We can say that at least we will be having a reduction of 20 to 25% of imports in India, because we are mainly dependent on nuts and dry fruits from international all the way imports. India is producing only 15 to 20% of nuts and dry fruit, basically cashews and raisins. Markets have gone up like anything because of many factors. One is the logistics, one is the transportation, because of the ports closing down, then dollar going up. Dollar is also, nobody knows what is the calculation for the dollar going up. Every day the dollar is going up. And especially the logistics, which has the main effect. Like, for example, we are buying anything from Iran, which was costing us around $500. Today, we are paying around $15,000 for the same freight. Almost, you can imagine, almost 20 or 30 times more. And the transit time from Iran was almost 7 to 8 days, which is taking now almost like 45 to 60 days. So not only that, even from US, because of the freight going up, the cost of the fuel going up, everything has gone. Even the local logistic, even the local transportation has gone up. Even the packaging material has gone up. Because of the war, every product is affected. So we are expecting at least, already there is a jump of around say 10 to 15%. Still the demand for Diwali has not started, which will be started almost after a month, mid of July. And we think another 10 to 15% will go up. But accordingly, the sales will also drop down, because when the prices go too high, the sales goes down. All the nuts will be affected. I think so. Cashew industry is not going up because of the domestic production, and also being the domestic restaurants not working, ingredient restaurant industry not working well, and the same goes with the raisins.
Rajiv, the last 3 months, as you mentioned, since the West Asia conflict, we've seen dry fruit prices go higher. If we had to do a comparison really from what the prices were during last Diwali, because that is the time India really looks at demand coming back. The winter demand for dry fruits is the major one. So as compared to last Diwali, this Diwali, what are we going to be paying for commodities that are especially coming from Iran, like almonds and pistachios and dates perhaps?
I think so you will be paying at least 20% more.
40% more?
20 to 30% more.
Okay.
And if the demand goes up, then it can be 40% as you spoke out. But 20% is, but 20 to 30% is for sure, because reason is, it's not a question of the product. It is the things which are affecting the product. Logistic, plastic, packaging, transportation, labor, everything has gone up. So these are the factors which will be affecting it a lot. But see, India is a big country, and you know, we have a lot of upper middle class and middle class and upper class. If the demand continues, automatically we can expect the market to go up much more higher. But when the prices go beyond some limit, automatically people switch to other gifting item or something, and this can affect. But it is too early, and we don't know how long the war will go up. That's the basic. Another problem is the dollar. Like we were discussing earlier also, the dollar can go up to 100 rupees, it can goes up. If it goes up that way, another 5% already from people, we bought products which were at $90, $91 when the dollar was there. Today is 95 plus or 95, around 95. If it reaches around 100, another 5 to 7% will be jump because of the dollar. The product is jumping, 10% is effect for the currency also.
Rajiv, in last many years, what has been the demand growth that India has seen? And with all the factors that you have pointed to right now, are we looking at a contraction? And if yes, by how much?
See, India has been growing at a very good price, especially for the nut industry. We have been seeing that every year 10 to 12% demand was going up every year. But this is one of the year, I think so, there will be a negative impact or at least a stable impact. It can go down by another 5 to 10%, the demand will go up. But if you see the value-wise, it will remain the more higher, because it has, if the prices go up by 20%, demand goes by 10%, on average, if you see the turnover and everything, it will remain 10% higher on the higher side.
All right. Rajiv, you don't just do dry fruits, you also do spices. You do superfoods like chia seeds and pumpkin seeds and all of those nuts and seeds and the dried fruit that the market also seems to be growing. How are you looking at the overall growth therein?
See, that market is also going to see all the super fruits and all the super nuts, their demand also is growing up in India because the Gen Z wants a new thing to be there and they're ready to spend more because these are little costlier ones. Pumpkin seed is not costlier, but if you see like Brazil nut, you see pecans and all things which are coming up in India, they are the costly nut, but demand is growing up and picking up. But for especially for like pumpkin seed is a lower price item, but it is good for health. It is going up. Even like we were talking about edamame, there is a new thing which is coming. New generations are looking for alternative which are cheaper and good in protein. So things are changing, but demand is growing for these products also.
Rajiv, you mentioned already that it's taking much longer for India to get all of these products into the country. What is it that you're looking at as an alternative right now? You said some of the stuff is coming by air as well. That, of course, gets added into the cost of the dry fruits. So what are we looking at? Are you looking at other countries? Are you looking at other logistic ways to get this?
See, other logistic, what we are looking for, by flight, we are already doing it. Even we are finding like from Iran, we cannot go via port. So we are looking alternatives via Oman or via Turkey. We have already worked it out. Then like from US, we are trying to find better shipping lines. Even we want some support from the government. We need some support from the government when the goods arrive. Sometimes the documents arrive late, or sometimes we don't get a proper, because of the war situation, we don't get the documents on time. So we want the government should support something on the freight side or helping in the damage side at the port also. That is also part, because that is not going to anybody's pocket. It is affecting the customers at the end of the day.
Right.
So we are finding, like Afghanistan absolutely is a landlocked country. So we had an option via Pakistan, which was closed long back ago. Then there was an option via Iran, that is also closed. Now everything is coming via air. So if the government gives the subsidy to, not only the Indian government, if the Afghanistan government also gives the subsidies in products coming via flight, that also can be addition to the benefit to the customers.
Absolutely, point taken there. Rajiv, thank you so much for joining us and coming to the studios, taking us through all of the details about dry fruits, prices that we're expecting this Diwali as well.
Going to get very expensive.
Yeah, I'm just worried about Diwali.
From your edamame to matcha to dry fruits.
Everything is getting expensive.
Because of the war, everything will go up.
Absolutely.
Eat less, guys, eat less.
What's the most popular dry fruit that you're selling or product that you're selling right now?
Always the almond is considered as the king of the nuts. Because almond has been like, mothers have been teaching us that get up in the morning, have 2 almonds and badam khaiye. Badam khayenge, dimag tez hoga. So, and the production is big. And the import, India, you will be surprised, India is the biggest importer in the world for almonds in the world.
Okay, absolutely, badam khate raho, but we'll see the prices where that moves as well. But thank you so much, Rajiv, and thank you so much, Manisha, for taking us through that conversation as well. Viewers, by the time we're having this conversation, look at where the market has gone, right? 23,400, about that mark is what the Nifty is trading at. In the green, good recovery from the low, 190 points uptick from the day's low. Sensex has seen a recovery of around 660 points from the day's lowest point as well. IT continues to trend upward. Let's pull up the Nifty Bank also. We're seeing that see a up move as well in the trading session and move to the green as well. Obviously, IT continues to trend on that positive side. Infosys, TCS, we have HDFC Bank that's doing well. So very, very good up move that we've seen coming in the markets. Broader end of the market, let's pull that up as well, right? Where is that headed? We've seen that also see a slight bit of a recovery from the day's lowest point as well. So Nifty mid cap also is seeing a recovery. We'll watch out for that, where that is headed. Though nonetheless, right now it's still trading in the red. But the benchmark indices have moved to the green side, and that's what we'll watch out for. On that note, we're going to slip into a very short break. Out of the break, we'll have Vinay Rajani of HDFC Securities joining us, and he will talk to us about the trading strategies he's looking at, levels that he's looking at for the markets as well. Stay tuned in.
Welcome back. Well, good recovery coming in the market. So the mid-cap index is most formidable. It's down only around 0.3%. Remember, at one point in time, it was down around 0.8%. We have the Bank Nifty, which is now in the green, up around 115 odd points. The Nifty, which is up around 55 odd points, as well as the Sensex. So there's a complete reversal in terms of sentiment which has taken place. But two stocks sulking include Wockhardt and Glenmark from the entire pharmaceutical lot. So just watch out for that. Wockhardt is losing a lot of sheen that it picked up in the past two trading sessions, down around 8.5% for that. Vinay Rajani of HDFC Securities now joins in to discuss the markets as well as the tech calls that he has. Vinay, it is turning out to be a good session now for us. Turnaround which has taken place in the markets. But are you convinced?
Yeah, good afternoon. So more than 200 points recovery from the low of the day. And if I were to look at the open and low of the Nifty, it has been same today. So it is a positive sign. Many times you've seen that this kind of patterns gives the positive sign. So today's low was 23229 on open was also same. And for Bank Nifty also we can see that there is a double bottom formation at 53,120 odd level. So good recovery from the lower level. And the one important development is that Nifty has yet not breached the important support of 23,100, which happens to be the 61.8% retracement of the entire rally that we saw in the month of April. So in the month of April, from the lower level, we saw a 2,200 points recovery, and 61.8% of that particular move is placed at 23,106 odd level. So that has not breached. So there is a hope for the bulls to come back in the market, because unless we see a breach of 61.8% retracement, we can always have a hope to resume the uptrend, and that is what happening in today's trade. So traders can keep a today's low as a stop loss and go long from here. It looks like that it should extend the rally. The intraday zigzag could be there, but overall I'm expecting that today's low should be there, and that should be kept as a stop loss, and we can expect Nifty to extend this rally towards 23,700 to 23,800 from here on.
23,700 to 23,800. So that could be the next important level on the Nifty. For now, it has crossed the 23,400 mark. So in a market like this, Vinay, which are the stocks you would bet on? Were they on the downside earlier, and the sudden recovery has made you change your bets now?
Yeah, so the sectors which are showing relatively higher strength, I'm going for that. And so one is the IT sector. For last two trading sessions, there has been good momentum building in this particular sector. So LTI Mindtree, which has reversed from the long-term support, and entire sector has been performing very well. So LTI Mindtree June future can be traded long around 4340. I would suggest the stop loss at 4200, and immediate target I can see is around 4550. The second stock we like from the metal space is the JSW Steel. So it has been resilient, and entire steel stocks have been performing relatively stronger. So JSW June future can be traded long around 1315. Stop loss can be kept at 1295. On the upside, we can expect an immediate target at 1350.
Okay, keeping an eye out on JSW Steel as well as the names that came in there from Vinay. Vinay, thank you so much for joining us this afternoon on the show, taking us through your trading strategies as well. Thanks so much for that. But on that note, we're going to slip into a very short break with the markets now moving comfortably in the green at the day's highest point, 23,430 for the market. Short break, and we'll be back with more on markets and stock-specific action.
Welcome back. The recovery from the lows is all that we can talk about because it's massive. We are above that 23,450 mark as we speak. A lot of it is led by Bank Nifty, continue to be at the day's high. We do have a lot of these banking names, be it Kotak Mahindra Bank, SBI, all of them at the day's high. HCL too has recovered to the highs of the day. You have Titan, Adani Ports, Geo Financial. So it's actually all of these stocks which are contributing to the gains that we are seeing. Mid-caps continue to underperform, yes, but there is a recovery, of course, there as well. The advanced decline ratio, that will also come up for you on the screen. For now, it is in favor of decline. So the broader market underperformance continues. But do not forget, there is a massive recovery which is underway even on the small and mid cap. So we'll keep tracking market moves for you. But for now, we'll take your leave on Halftime Report. Stay tuned. Business Lunch will take all the action ahead.
Stocks see a sharp recovery from the day's low as volatile trade continues on weekly expiry day. IT remains the top sectoral gainer. Autos and FMCG bounce back into positive territory.
A rush of share sales line up after the earnings season ends. The centre looks to divest up to 6% stake in NTPC. Alchem Labs sees a large block deal while Acme Solar and Ola Electric have floated their own QIPs. All of this is just a single day.
Noel Tata, chair of Tata Trusts, raises concerns over proposed infusion of 7,000 crore rupees in loss-making Tata Digital. His daughter Maya will also exit Tata Digital and may join Trent or Tata Consumer, say sources.
The Aditya Birla Group is likely leading the race for Shell's Indian renewable energy platform Spring Energy in what is touted as an over $1.7 billion deal. The group presently has presence in the segment via Grasim's arm Aditya Birla Renewables.
Oil, copper and aluminium climb after Iran calls off talks with US and vows more blockades following Israel's continued strikes on Lebanon. Trump's claims of an Israel-Lebanon ceasefire and ongoing talks with Iran aren't enough to douse concerns. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan, and with me as always, Harmaz Patakia. Harmaz, good afternoon, and a good afternoon for the markets as well. We've seen this big recovery in the last hour, maybe 30 minutes. And, you know, that's because of that recovery we've seen in Nifty Bank. But mid-caps still underperforming the blue chips, but a recovery there as well.
Well, you blink and you miss. That's the kind of market that we are in, right? Good afternoon to you as well, Arundhati. And it was not a good afternoon for the markets, at least until the last 20 minutes or so. And all changes in just a fraction of minutes. And there you can see at around about 12:30 odd, the market started to move higher. And over the next 30 minutes, there has been a 200-point recovery from the lows of the day, back near that mark of 23,450. So the bottom line being that at least as of now, the bulls have managed to defend the May series low. And they would hope that that level, of course, sustains on a closing basis as well. The Nifty Bank is the principal contributor to the recovery that you have seen. Of course, the fact that the index losses were kept under check all through the day, courtesy of IT. But the last half an hour belongs to the Nifty Bank, and it is the banking index that has recovered, 650 odd points from the day's low. So yet another almost 1,000 point move in a single day that you have seen on the Nifty Bank. It's almost become a norm as of now. So a proper expiry related move that you're seeing, Arundhati, right now, and the bulls would definitely hope that this sustains. But of course, 23,500 now on the upside is the important level to watch.
Absolutely. And if you take a look at the sectors, the IT outperformance continues. The index at one point was the lone gainer in a weak market, but now we have other sectoral gainers that are helping the IT, helping keep the markets in the green. We've got Infosys, TCS that are rallying over 5%. If we can bring that up for you, you can see that both those stocks, TCS now over 6% in the green. We've got HCLTech as well. That's about nearly 4% in the green. All of the constituents on that IT index are all, you know, in the green at this point. What's dragging the Nifty low? We've got that pharma index, which is down about 1.1%. Sun Pharma, Cipla, Dr. Reddy's, all of them down a little over 1% in trade. Sun Pharma now also recovering about 0.2% in the red as we speak. PSU banks are in the red. They were losing more at one point, but now we're seeing a recovery there as well. SBI flat, Canara Bank about 0.7% in the red, and Bank of Baroda also seeing a recovery mildly in the green as we speak. But FMCG names like Nestle and Godrej, both of those stocks continue to drag. Nestle is about 0.5% in the red, while Godrej Consumer is about 2% in the red as we speak.
That's the market for you so far. And of course, the big talking point all through the day has been IT. Second straight day of gains. The IT index is up over 4% as we in today's session as well. And in fact, they have recovered significantly from the 52-week lows, have the IT stocks. But of course, the fact that they are still lower on a year-to-date basis is another talking point. But for now, IT up over 4%. Rima is here with more details on this.
Indeed, Indian IT is leading the market now for the second straight session, and a couple of factors are things that are driving this up move. One, global rotation. So money is moving back into the software names worldwide compared to the Max 7. So results from many of the SaaS companies have been strong, some of them upping the guidance. So basically that fear in the market about a SaaS apocalypse or a breakdown in the business model, at least for now, has been put on the back burner. Secondly, the INR weakness, right? That's a direct earnings tailwind for many of the IT exporters. But the bigger thing is the valuation of this sector was beaten down hard. IT is, you know, amongst the cheapest that we've seen in the last many years. So what we are seeing today is a big up move. And in the last 2 days, that's yesterday and today, stocks have rallied between 4, 5, 7%. But year to date, these stocks are still down between 20 to 25%. So in a way, this perhaps is a bounce and not a full-fledged recovery because the sector is still deep in the red for 2026. Now, most of the IT stocks had hit their recent, that's the 52-week low in March of 2026. And since then, what really stands out is the fact that mid-caps have recovered much harder and faster compared to large caps. So now, again, I'm comparing it to the recent 52-week lows, which for most of them was in March. Now, stocks have recovered about, TCS, for instance, 7.5%, and Infosys close to about 15%. HCLTech 10, Wipro 11%, Tech Mahindra about 20%. Now compare this to the mid-cap IT names where you are seeing an across-the-board 30 to 47% rise from the recent 52-week low. So the divergence in the mid-cap recovery versus large-cap IT recovery is fairly stark. So Coforge stock is up 47% from 52-week lows. Tata Tech 40%. Hexaware, First Source. These are all stocks which have recovered about 30% from their recent lows. So I guess that's the key takeaway, right? There is no real one fundamental news which is driving the up move, but IT is providing leadership, but it's coming on a low base from an underperformance, and mid-caps are the ones which are recovering faster. Now, there is no real trigger for the IT sector. Earnings from the Indian pack kicks in only in the early part of July, but Accenture reports numbers on 18th of June, so that would be the immediate trigger to watch. So let's see whether this rotation, this up move in IT has more legs to go.
Absolutely. Thank you so much for taking us through those details, Rima. Now, sources are telling Money Control that Noel Tata has raised concerns over growth at Tata Digital as losses continue to mount. Some higher management changes may also be in the works. Hormaz, you've been following and tracking this story. Tell us more.
You know, Money Control is exclusive, this story, and citing sources as well. There are a couple of developments that have taken place at the Tata Group. The first one, of course, as you just mentioned, Noel Tata highlighting the concerns with regards to the growth at Tata Digital. And all of this transpired at this recently concluded board meeting, right? And the Tata Sons management sought around 7,000 crore rupees worth of equity infusion to Tata Digital during that board meeting. And of course, the digital business that includes companies like Big Basket, Tata Click, and of course the consumer-oriented digital companies as well. Now, in that meeting, the projections were made according to which they believe that these businesses may continue to report losses over the next 3 financial years, and those losses may amount to as high as 9,000 crore rupees. And as a result of which, Noel Tata has raised questions regarding this growth projections being used to justify the kind of investment that is being sought, and he believes that the group should review and prioritize investments based on these companies' growth outlook as well. And he also raised concerns that investments are being sought in companies that are yet to demonstrate a clear path to profitability. So these are some of the concerns raised by Noel Tata. That's a Money Control exclusive that we have citing sources. Now, the other major development, of course, is something that sources are telling us right here at CNBC TV 18, that Maya Tata, who's the daughter of Noel Tata, will be exiting Tata Digital and will head to another role at another group company, possibly Trent. So there are a couple of developments taking place at the Tata Group, but of course, Tata Digital being in the spotlight with the kind of equity infusion sought and concern sought by Noel Tata.
Absolutely. So we'll have to wait and see what happens on this front. But let's shift our focus now to the latest update on the second attempt by global energy giant Shell PLC to divest its Indian clean energy assets. Ashwin Mohan joins us now with more details on this. Ashwin, we understand the deal is in the final leg. So who's in the lead?
This is by far one of the biggest ongoing deals in the super active renewable energy segment in India. What we are given to understand from our sources is that the Aditya Birla Group has in fact emerged as the likely frontrunner to acquire Spring Energy, Pune-based Spring Energy, which is the clean energy platform of British energy giant Shell PLC in India. Our sources are telling us that in the final leg, post the submission of the binding bids, the Birla Group has edged ahead of rival suitor private equity firm KKR. There were 2 other suitors, a consortium of Temasek and NIF and Actis. Valuation-wise, our sources are telling us that Spring Energy could be valued upwards of $1.7 billion. What's the rationale from the Birla Group's point of view? Well, Aditya Birla Renewables is the vertical that looks at this particular segment. It's housed under the listed parent Grasim Industries. It has ambitious expansion plans to increase its capacity upwards of 10 gigawatts in the coming years. Kumar Mangalam Birla is betting big on the renewable energy segment. He sees it as a big and important growth driver for the diversified conglomerate in the years to come. Also, don't forget that sometime back, we had BlackRock-backed GIP that had pumped in 3,000 crore rupees into Aditya Birla Renewables, valuing it around 14,600 crore rupees. In terms of official responses, Shell confirmed that they are indeed in talks with potential suitors, but said it's too early to comment on the outcome of the negotiations. Email queries to Birla Group and KKR remained unanswered. As far as the investment bank is concerned, it's Barclays that is advising on this big bang trade. Let's wait and watch to see how it progresses in the days to come, because remember, no final decision has been made as of now. Talks can still fall apart, but as of now, the Birla Group seems to have the edge. Back to you.
Ashin Bon, thank you for that update there. Take a short break. Back with more on the other side. Stay tuned. Welcome back. Shifting focus to the bond markets then. Manisha Gupta is here with all the latest updates. Manisha.
Well, it's the uncertainty that the markets do not like at all, and that's exactly what we are looking at right now. From the global markets, it is still about the strength in US dollar, which is weighing on to the Indian rupee. There is uncertainty also on the peace talks between US and Iran that seems to be stalling. And the overnight markets did see crude oil prices going all the way back to $98 a barrel. Right now in Asia, of course, trading around that 94, 95 mark. The corporate bond markets also are cautious, and this is ahead of the RPI NTPC meeting that is on Friday. And the bonds overall seem to be trading just about at the 1-year maturity. That is where the most of the participation is. Not too many people investing money for a longer term period. There's too much happening in the near term to keep reacting to. If you look at the overall bond issuances, well, that has seen a bit of a decline as compared to Friday, stands at around 2.55 billion. The secondary market trades also saw a bit of a decline from Friday of 96 lakhs to 96 billion to almost 92 billion. That is what the number was in the markets yesterday. The focus also is on the results of the bond auction by SIDBI today. SIDBI, remember, is planning to raise 30 billion, and this is via 3-year floating rate bond maturity of around 2029. Apart from SIDBI, Muthoot Finance is in the market today as well, looking to raise 15 billion therein. This is via the issuance of 10-year bonds for the maturity of 2036 therein. InCred Financial is in the market for 1.5 billion. They're doing or raising money via bonds maturing in December 2028. And then you have Muthoot FinCorp, which is looking to raise nearly 1 billion. They are doing it via reissuances of bond maturing in 2033. Vedika Credit Capital is looking to raise 400 million. They are doing it via 2028 bonds. And then you have Union Bank of India as well. They are looking to raise nearly 50 billion. They are doing it via Tier 1, Tier 2 bonds therein. And then you have Magma General Insurance. They are looking to raise 1 billion. They are doing this via 10-year bonds of maturity at around 2036. So various companies lining up really when it comes to raising capital via the debt markets.
All right, Manisha, many thanks for those details. Now, the Ministry of Statistics unveiled its new IIP series yesterday with the base year changed to 2022 to 2023 from the earlier 2011 to 2012. It also said that the IIP, or Index of Industrial Production, grew by 4.9% in April as per the new series, better than the 3.2% in March, but slower than the year ago April. Lata Venkatesh is here to tell us more about the April data and the new series. Lata?
Well, it does look like we have weathered the West Asia storm better. As you said, April IIP grew 4.9% per the new series, just 3.2 in March, when the hit was immediate from West Asia. But we are slower than the year ago April, 5.7. Manufacturing, more important because it's a large part of IIP, grew by 6.2% in April, good number, versus just 3.9 in March. Year ago was 6.4. So on a base of 6.4, 6.2, not bad. If you look at the ones that grew well for IIP, it was, electricity, gas, water supply, sewerage, mining. These are the ones that did not do very well. It was manufacturing that did exceptionally well. And it did well. Manufacturing is, by the way, about 75% of IIP. So that's important. It did well because of double-digit growth in 3 or 4 sectors, which are very important. Transport equipment, autos and trailers. That's one big category. The other category that did well was textiles. The other was machinery, electrical equipment, and electronic products. All these grew by, guess what, 10.5% to 19.5% over April and March, both months. What did not do well? Petroleum products, obviously, because the input price was high. Chemicals have done badly. Pharma has done badly. All told, you have to say that April, Indian industry has faced up better after the March hit. But what is interesting is the difference between the two series. What they have added is they've added water, sewerage, they've added renewable energy. Originally, almost all that we counted as power was thermal, legacy energy, non-renewable. They've also added rare earths. And they've taken out a lot of defunct factories. The old 2011-12 series had a set of factories. Many of them, not many, quite a few of them had been defunct or changed products. A lot of new ones that have started producing were not added. They have been added. So for 3 years, they are giving us both the the old series numbers and the new series numbers. I'm taking just 2 years, FY25 and FY26. Look at the new series and old series. Just look, overall IIP growth. In the new series, FY25 is 6.4%. Old series was just 4%. In FY26, the next year, 4.3 versus the old series, which was 4.1. So just changing the exact factories where there is growth has made such a big difference to the overall number. Manufacturing. Under the new series, 6.3 in FY25. Old series was 4.1, again lower. In FY26, manufacturing was 4.9. In the new old series, it was 5. So that's more or less the same. Electricity, again, in the new series, 9.5 in FY25. In the old series, it was only 5.2. Electricity in FY26, 1.1 and 1. Again, that's more or less the same. Capital goods is very big difference. FY25, it was 9.3 in the new series. Old series was half of that, 5.6. Likewise, in FY26, that's last year, capital goods, the new series grew by 11.7. Old series is 8.3. And finally, infra and construction, 7.5 new series, 4.3 for a year ago, FY25 and FY26, 9.1 in the new series and 5.5 in the old. So clearly indicating that we were not counting the right factories. We were counting defunct factories. In the old series, we didn't do all that badly if you look at the new series.
We haven't, indeed, and that's what the number shows as well. Lata, thank you for summarizing that for us. Take a short break. Back with more on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. AI giant Anthropic has confidentially filed for a U.S. initial public offering, taking an early lead over rival OpenAI in a race that will define the future business shape of artificial intelligence. Take a look at this report.
AI giant Anthropic has filed the paperwork to go public, the company said Monday. It takes an early lead over rival and ChatGPT owner OpenAI in a race that will define the future business shape of artificial intelligence. Anthropic, which makes agentic coding assistant Claude Code, did not disclose the size or the terms of the offering. Confidential submissions let companies advance IPO preparations while shielding sensitive financial details from rivals and the public. Its last fundraising round gave it a valuation of nearly $1 trillion, making it worth more than OpenAI. The crucial step toward a listing comes on the heels of SpaceX's mega IPO, which is on course to rewrite the record books. The Elon Musk-led company is pursuing a $75 billion offering at a $1.75 trillion valuation and could begin trading within 2 weeks. And a source close to the matter told Reuters that OpenAI is set to confidentially file for a U.S. IPO in the coming weeks, too. One analyst told Reuters the demand for capital from these IPOs will be so considerable that it is likely to create disruptions in the capital markets. So going public early will be a huge advantage.
Well, the Nifty is now up 100 points. To think about the fact that we were about to start 200, 250 points lower, and that's the kind of recovery that you have seen all in a matter of 30 to 45 minutes. We take a leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap radar on the other side when the midcap index is still underperforming.
Absolutely.
afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra, and today on the show with me is Vinny Motiwala. Vinny, good afternoon. What a rally from the lows of the day, and that is all that anyone can talk about, considering that the expectation was that because of the talks halting again on ceasefire, there could be a negative impact. But we did see that, but the recovery is something that is even fresher. So 131 points higher on the Nifty. Mid-caps, which were in the red, they continue to underperform, but we have seen a massive recovery there, and the advance decline ratio in favor of advances as we speak.
Oh, that's interesting there. And good afternoon, Shirley, coming in here. Good afternoon to you as well. And obviously 23,500 is what we're seeing coming in for the Nifty 50. Broader end of the market now comfortably moved up on that green side as well. And Nifty Bank too is managing to hold on to gains. But on that note, let's talk about the top headlines for today as well. And stocks obviously are seeing that sharp recovery from the day's low as volatile trade continues on a weekly expiry day. IT remains a top sectoral gainer. Autos, FMCGs bounce back into positive territory.
A rush of share sales line up after the earnings season ends. The centre looks to divest up to 6% in NHPC. Alchem Lab sees a large block trade, while Acme Solar and Ola Electric float QIPs, all these in a day.
And shares of First Motors under pressure after the company reports weak sales print for the month of May 2026. Domestic sales coming in at 18-month low. Stock is down more than 5%.
On the other hand, NMDC climbs over 3% despite reporting 7% fall in offtake for the month of May, while production rises 20%. Nuvama maintains a hold rating, while Citi rates it sell as domestic prices are expected to be range-bound. Okay, those are the top headlines. The market recovery is the big talking point that we are tracking today. But let's take a look at what the mid-caps and the small caps are doing, because despite that recovery that we saw earlier, the mid-caps yet they surged from the lows of the day, but the advance decline ratio continued to be in favor of the declines. That has reversed now. Mid-cap index is at the day's high, so is the small cap index, but the advance decline ratio has now turned in favor of the advances. So those two lines should come up for you on the screen, and that is where we'll see a convergence happening, and that's an important take. But again, it continues to be very volatile. So mid-cap part of things, that is something where we're not getting a definite trend since last couple of days.
Absolutely not getting a definite trend there. Rightly mentioned there, Sonal, but that's what we'll watch out for now. An expiry day, whether they also see a run-up like we saw coming in from the benchmark indices, and a strong, sustainable run-up now from here on is something that we want to watch out for. This 23,500, is it going to go back down again? But as of now, comfortably at the day's highest point is what the Nifty continues to trade at. And in terms of sectors, also IT continues to trend upward. Let's also watch out for Bank Nifty. That's the one that's doing well in the trading session. But let's move on to the first segment for the day, and we have our first segment, that's mid-cap movers. We have Sudarshan, who's here to take us through the mid-cap stocks that are moving around in the trade, and that's where all the action is happening. Sudarshan, over to you.
Pure expiry day move, what a recovery that we have seen in the market over the last half an hour. And some of the mid-cap gainers also, we have unusual gainers. You can see that all the IT names are buzzing in trade and tracking that. News and software, what a move, currently up almost 15%, following by SKM Egg. That's also trading with healthy volumes, currently up almost 13%. HLE Glasscoat is trading with healthy volumes up more than 12%. And similar move is being seen even for IFGL Refractories, and that also trading with gains of almost 13%. So the other mid-cap gainers, Goldman International has seen huge increase in healthy volumes, and that has led the stock to as high as 7% uptick that you can see in the stock. HCLTech and Mahindra, it was a strong set of numbers that company had reported, and continuously the stock has been moving higher. Today also up more than 5%. Sonata Software, another mid-cap IT name, that's up almost 5%. HCC and IFCI are two trading with healthy volumes, currently up more than 5% each. But while we are seeing a recovery, there are some mid-cap losers too. Workhard, that's, we can say that it's saying profit booking after a big up move that stock had seen over the last few days. Trade down almost 9%. Delta Corp, there was a news about the online gaming thing, and because of that it's been going one way, that's down. Today also down almost 3%. Physics Wala, it was a weak print for Q4, and since then this stock too has been under pressure, down almost 4%. Supriya Life and Jamna Auto are trading with a cut in the range of 5 to 10% as well.
Okay, thank you so much for that, Sudarshan. Those are the mid-cap movers this afternoon. But let's also move on and now talk about pharma space. We have Neha Manpuria, who is a senior analyst for pharma and healthcare at BofA Global Research, joining us right now from the sidelines of the India Conference 2026 of BofA. Neha, good afternoon. Thank you so much for joining us on the show. Firstly, let's start by talking about the pharma space. How are you thinking overall the Q4 FY26 numbers? You had the news flow yesterday. Actually, since Friday, we're seeing VOCA that's been in focus as well. So let's first start with Q4 FY26. And now, how are you looking at pharma for FY27?
Thanks for having me on today. So I think the fourth quarter saw a couple of things. One, you did see a very strong performance from the domestic segment for most companies. You've seen the domestic market growth improve from about 8% to 10%, and I think that was also reflected in most companies' domestic revenue that moved up. I think SEMA was a very small contributor to this, given that the launch had come in at the fag end of the quarter. But yes, we have seen, I think that will continue to be a tailwind for the sector, particularly for the domestic, the domestic revenue in FY27 as well. The second point was obviously this was the first quarter post the rev limit cliff for pharma companies. Expectation was that it will be fairly noisy. You could see very weak margins, but companies have managed to actually move through that rev limit cliff pretty comfortably. You have a good sense on what the base business margins are, and therefore how to think about earnings growth and margin improvement from here for most companies. Third, I think not so specific to the quarter is the capital allocation. You've seen a fair bit of M&A, in the sector in the last few months, quarter. I would also say last year with balance sheets being so flexible. And you've seen this across a wide range of space. You've seen it in innovation, which is specialty. You've seen it in OTC, CDMOs, even medtech. So, you are seeing companies look outside the traditional generic route, to other growth areas, which are slightly more longer term, but, to support their growth. I would say that's on fourth quarter. From an FY27 perspective, like I said, obviously domestic markets, it would be how SEMA does. I think SEMA is not only an opportunity in India, but for some companies also outside India. So how are they able to monetize semaglutide in India, outside India over the next year? That would be interesting to watch. You still have, while a lot of these companies are investing in newer areas, US still remains very relevant. So, the pipeline opportunities in US, particularly as you strip out rev limit, how that growth will pan out from these opportunities. Third, I think, like I mentioned, because there's been a fair bit of M&A, the company's confidence in being able to execute or scale up these new drivers that they're creating, I think that would also be closely watched, in terms of re-rating of the pharma stocks.
Okay, so that is a comprehensive summary of what you make of the pharma space going into FY27. Neha, but a lot of things still continue to stay uncertain. Pharma sector is not really immune, despite not having direct dependence on what's happening with the energy market, right? But crude prices remain elevated, supply chains are impacted. If that continues for a bit, do you think that will in some ways start impacting earnings by a bigger margin, considering that API prices could continue to increase? And that is something that could impact balance sheets going forward, and the M&A part that you're talking about could take a backseat for a bit.
So yeah, the West, when no company or sector is immune from the West Asia crisis, and similarly that's the case of pharma. I think immediately we have started seeing logistics cost increase, either because of container shortages, insurance costs going up, routes getting longer for shipments. That you've already started seeing to some bit in March and obviously in first quarter. I think from an API cost, yes, we have seen solvent price, particularly solvents that are linked to crude, that start to increase. But API price increase hasn't been to the same extent. Now we'll need to track this a little more closely because it remains very fluid in terms of where the crisis is going. The longer the crisis lasts, obviously the uncertainty continues, and that would mean that API costs could remain elevated. But the true impact of that in my view, will be visible probably in the second quarter, third quarter, because companies do have inventories for APIs. So, I think we'll get a true sense of how much that impact is from API costs, particularly, probably in September quarter earnings. So I think that's what I put it. But again, I see this as an earnings impact on the balance sheet. most companies have fairly comfortable, cash generation and cash flow positions, and therefore I don't see, increase in API pricing actually impacting their ability to continue to do M&A or invest in the business. I don't see that as a risk.
Neha, what I also want to understand is now the strategy, at least maybe for the next year or so, should it be more on the domestic side, domestic focused pharma companies? That's what everyone is talking about. Is that your play, and is your strategy also similar?
So I think the domestic, obviously because of the semaglutide, does provide, let's say higher growth. But would it mean higher margins because of semaglutide? Probably not, right? Because you are seeing companies invest a fair bit to create sales force for semaglutide. So while semaglutide might help growth, I think the improvement in margins because of semaglutide probably take longer till the time you take, you see these ramp up. I think, from an overall pharma perspective, I would still say, because of the FX tailwind, your CDMOs probably benefit from that, given they have a cost pass-through, so your API cost impact would be limited. So technically in the current environment given where FX, INR is, and their ability to pass through API costs, that would probably be higher in CDMO companies, generics, and then probably I would say domestics. Remember that domestics have been a big beneficiary of lower API cost post-COVID. So if we do see API cost increase, probably, that is the segment which gets impacted the most.
Neha, what about hospitals? What's your sense? We earlier saw a lot of PE buying, but then the ones which are owned by promoters are also doing well. General sense, what do you make of the occupancy levels and rentals going forward? What about the acquisition in this particular space?
Okay. I think hospitals, the last few years obviously have been very strong. It's well understood, reflected in valuations of the sector where margins have improved. I think, similar to pharma, yes, the focus is on capital allocation, but a little bit different because here we're talking about bed capacity being added. And I think the key debate in the sector is how does this bed capacity reflect, in margins, particularly given most, the margin improvement that you've seen in this consolidation phase over the last 5 years. I think what is happening in healthcare is the discussion is now becoming a little more nuanced from a capacity expansion point of view in terms of what are the markets where capacity is being added. Is there risk to existing hospitals seeing margin pressure as you see doctor churn or, because of new hospitals coming in that area. So I think it's getting a little more focused around that. Ability of companies to be able to navigate, this capacity expansion cycle over the next few years in terms of their ability to probably manage margin expectations of the street and therefore, what would be the earnings downgrade or upgrade in stocks, that will be a key differentiator. In terms of, private equity money, I mean, that's always been there in the sector. You're seeing a lot of that come to the market. I don't see anything changing on that.
Okay. Neha, point taken there, but thank you so much for joining us on the show this afternoon, taking us through important updates and, things that we should watch out for in the world of pharma as well as healthcare. Thanks so much for that, Neha. But on that note now, let's also listen into the management of Wockhardt. We managed to speak to Habil Korakiwala, founder and chairman at Wockhardt Group, after the company became the first Indian drug maker to secure a US FDA approval for a novel antibiotic discovered and developed in India drug. Listen into that conversation.
I think it will take us another 4 to 6 months. So for practical purpose, before the end of the year or early next year, we would be launching Zenix in the US market.
You had earlier guided for around a $1 to $2 billion opportunity from this drug, from Zenix globally. Does that still stand?
Yeah, definitely it stands. Yeah, that is generally so that the US contributes around 40-45% of the global opportunities. So we do expect at least 40-45% will come from the US market. Oh, this would be the peak sale, basically. It will not come initially in the first year or so. But over the years, as the usage increases and doctor gets familiar with the molecule and where to use it and how to use it, And that is how a new molecule gets picked up year on year. Then you get a much faster growth after initial 18 months period. Our patent is there up to 38. So it's more than 10 years of patent life we have as of today.
All right, that's the word coming in from Walk Hard. The stock is seeing some profit booking today. For now, we'll sip into a short break. When we come back, we'll get to Srikanth Chauhan of Kotak Securities on the other side for a technical check on the markets. Welcome back. Well, while the mid caps are underperforming the markets, there are a lot of stocks which are buzzing with huge volume. So look at Infobeans Technology. That stock is up around 16.5%. So Darshan spoke about some of these stocks which are doing really well in trade. There is also Quick Heal, which is higher in trade, 11% there. Confidence Petroleum is the other one, which is up around 10% as we speak. Rubicon Research reported really strong set of numbers earlier, and it is higher by 5.5% today as well. Sonata Software is the other one. So a lot of these stocks in the IT/services space doing well in the broader markets as well. But it's a good time to get a technical check on the markets. Srikanth Chauhan from Kotak Securities is joining us for just that. Srikanth, good afternoon. A surprising rally from the lows of the day. Is this something that the charts suggested? What are they suggesting now? Will we continue this rally or consolidate at these levels?
Good afternoon, Sonal. Good afternoon, everyone. So if we consider the overall technical pattern of the Nifty, then it was highly oversold. In fact, on last Tuesday, the markets were close to 24,100. From there, all the way in just 5-6 days, we saw the market falling to the levels of 23,200. So it's a pullback that currently we are witnessing. And this pullback can continue up to 23,600, 650, where the market is having next leg of resistance. As on the day of weekly expiry, the market has crossed the psychological barrier of 23,500. We can expect market towards 23,600 or 650, maybe today or by tomorrow morning. So that's the overall view. And in case if there is any correction, then close to 23,500 or 450, the market will find some support.
Okay, point taken. We'll keep an eye on those levels over there. Srikanth, what are your individual bets also that you're looking at? Is it more IT side, bank side? Where is it coming from?
So for IT stocks, I think they have delivered a decent return in last 3-4 days. We are expecting furthermore 5 to 7% sort of rally from current levels because most of these stocks, they are diverging positively, which is positive. And it's not the only 1 or 2 stocks. It's a complete basket. There we are seeing good amount of positive divergence. So we are expecting furthermore upside at least 5 to 7% from current levels. But specifically for next few days, we are targeting few stocks. They are means they did well in last few weeks. And in the near future also, we are expecting further more activity. In that specifically, we like NMDC, which is around 95, 96 sort of levels. The stock is forming higher top, higher bottom series, and it is going up gradually. So from here, the stock can move to the next levels of maybe 100 and in the best case scenario, 115. So based on technicals, it's a buy at current levels with a stop loss close to 90 with a target of 115 on the higher side. It is based on technicals. And the other stock which we like is NH Hospital, which is around 1920, 1930 sort of levels. There also, if we see the technical formation, then it is forming rounding bottom sort of formation. So based on that, again, the stock can move towards 2050 or 2100. So both these stocks are showing a lot of strength at current levels. And with a medium term view, we should look for adding them.
All right, take that point. Thank you so much, Srikanth, for joining us as always. So those are some technical bets that Kotak Securities is betting on. Well, a small programming note as we slip into a short break. Uncertainty in the market is rising given geopolitical and trade headwinds. We at CNBC TV 18 are featuring some of the biggest faces in the market from 3 mega conferences to help you take informed investment decisions. Tune into CNBC TV 18 to catch the top minds from Bank of America's global investment team, including Amish Shah and Vikram Sahu. You can also catch macro and market opinion from Morgan Stanley's Chetan Iyer, Rhythm Desai and Jonathan Garner. Citi's Managing Director Sue Lee and CEO Jane Fraser will also be part of the blockbuster panels lined up only on CNBC TV 18.
Welcome back to Midcap Radar on CNBC TV 18. Now, Nifty continues to hold on to the 23,500 levels as of now, up 0.5% in the trading session. IT continues to do well. Banks have moved to the green side as well, so that's what we'll watch out for. And the last 1 hour, which are the broader end of the market stocks that have done well specifically, are let's pull up HCL, Alkali Amines, Godawari Power, as well as Network Technologies. That also has picked up pace in the last 1 hour. So that is what we'll watch out for as well. But shifting focus to market data, momentum in the margin trading facility continues to be steady. Hormaz has done some number crunching to paint a better picture for us on this as well. Hormaz, over to you. Good afternoon.
Good afternoon. The markets, we have not gone anywhere in the month of May, but the MTF book definitely went in one direction, and that was higher. And as of the 30th of April, that number, the overall number, which stood at around 1.16 lakh crore, ended up at over 1.26 lakh crore at the end of May. That's around an 8.5% growth on a month-on-month basis, similar to what we saw sometime between March and April as well. So the MTF book continues to rise even as the markets continue to remain choppy. Three stocks that have sprung a surprise in this. But before I get to that, you take a look at the top 5 names on the MTF book, and HDFC Bank continues to top that list for the second month in a row. Exposure of well over 2,200 crores now, and the month-on-month change around about 14%. But the surprise package in this has been ITC. The exposure, which stood at sub 1,000 crore at the end of April, is now almost 1,800 crore at the end of May. That's an 86% jump on a month-on-month basis. Similar gains seen for Reliance Industries as well. Another 40% plus growth in the MTF exposure. Not so much for Jio Financial, but the other one, State Bank of India, after its results last month, saw a very significant move in the MTF exposure. 157% jump, well over close to 1,400 crore rupees. That figure was sub 550 crore at the end of April. Now, if you take a look at the stocks that have seen the biggest moves in terms of the MTF exposure, State Bank of India features in this list as well, of course. But the second big surprising name that I was talking about was Pine Labs. Now, the exposure that stood around 24 crore at the end of April was close to 200 crore rupees at the end of the month of May. So a 730% jump in that exposure. Lupin, Escorts Kubota, which is at a 52-week low as well, that has seen an increase of over 100%, as has Britannia Industries. Take a look at the names that have seen a decline in the MTF exposure. Persistent and Coforge, the mid-cap IT synonyms, they have seen a decline. Polycab's name featured in last month's review as well. That too continues to see a 44% drop in its MTF exposure this month as well, in the month of May. And SBI Life too seeing a reduction of a similar quantum. So the MTF book continues to grow even as the markets remain choppy. But three names that spring a surprise here: SBI, ITC and Pine Labs.
Okay, two of them Nifty heavyweights. Thank you so much for joining us with all those names, Hormuz. An important update, but a lot of stocks in the broader markets, we've been talking about them reacting to news updates. NMDC is one of them. Nigel is joining us to analyze that for us. Nigel.
Well, that's right. NMDC, the street seems to be looking ahead and they're ignoring the backdated data. The reason I say that is because they came out with the results a couple of days ago, and that was clearly a miss with regard to the operating profit as well as the margins. The problem was the smaller part of their business, which is the pellets business. It delivered an EBIT loss of close to around 100 crores. However, the reason I say the street is looking ahead is because in this quarter, that's quarter 1 FY27, they've already increased prices by around 500 or 600 rupees per ton. So that will reflect in the first quarter. Besides that, the management, on the con call, they guided that the volume should be at close to around 60 million tons in the coming year. That compares with around 50 million tons in the past year. So that's a big growth that they're guiding for. And by 2030, they're talking about around 100 million tons. Though they'll be incurring a big capex of around, close to around 5,000 crores in the coming year, 6,000 crores. And this will gradually increase over the next few years as they move towards 100 million tons or thereabouts. The near-term trigger ball, it didn't look too good. They came out with their operational update yesterday, and production number was up by close to 20%, which is good, but dispatches were down by 7%. The reason is Chhattisgarh did well, but Karnataka out there was a degrowth of close to 700,000 tons. The problem I understand is that the vendor change over there is a bit of change on the administrative front. So the street is viewing it as a one-off, and things will recover in the coming months itself. Brokerages, well, you are split down the middle. Nuvama, they have a hold rating. Target price, they have up to around 100 rupees, and they're up their EBITDA estimates as well, factoring in higher volumes and prices. While Citi maintains their sell call with a target price of around 85 rupees. They highlight that Lloyd's Metal as well is ramping up capacity from around 10 million tons. Now they have permission to mine close to around 25 million tons, which will result in additional supply into the market. So that's about NMDC for the time being. Street looking ahead. Back to you guys.
Okay, thank you so much for that, Nigel. But let's move on and talk about Force Motors. What's the reason about this stock being in focus? Let's go across to Sudarshan to take us through all of that. Good afternoon, Sudarshan.
Good afternoon, Vinny. So while most of the auto companies have recovered sharply from days low, one stock that remains under pressure is Force Motor. That's mainly because the weak print that company has reported for the month of May. Total sales have seen a decline of more than 15%. And both these segments, if we talk about domestic, was down 15%. Export segment, while its contribution is very negligible to total sales, that too has seen a fall of almost 37%. Just on domestic front, total sales have come in at 2,560 units, and that's the lowest that we have seen in last 18 months. And the weak print was expected after the weak or lower than expected numbers from two C players we had got yesterday, and those two are Tata Motors commercial vehicle and Ashok Leyland. So it seems that because of supply chain issue, there seems to be pressure coming in for CV players, and on the back of that, we saw weak print from Force Motors, and that's the main reason why the stock is down currently 5%.
Okay, all right. Take that point. Thank you so much, Sudarshan. So those are some stocks in the broader markets which are reacting to news updates. With that, we'll get into another break. When we come back, we'll discuss markets, some expert opinion on the markets, and a lot more. Stay tuned for that.
Welcome back to Midcap Radar on CNBC TV 18. While the Nifty continues to hold on to 23,530 levels, around that mark, we managed to speak to Chetan Iyer. My colleague Lata Venkatesh actually spoke to him at the sidelines of the Morgan Stanley India Investment Forum. And Chetan Iyer has been the chief economist with Morgan Stanley. We asked him about his views on Reserve Bank's policy decision later this week and how the central bank is likely to augment capital flows. Listen in.
We don't think that the RBI should hike. India doesn't have an inflation problem. India doesn't have a current account deficit problem. So if you're going to hike interest rates, what purpose is it going to serve? If the purpose is to provide higher yields on your currency, then 25 basis points is not going to do it. How we did it in 2013 is by lifting the upper end of the policy rate band and effectively letting the liquidity tighten when capital outflows are happening. And you have to do something like, 150, 200 basis points of overnight interest rate hike. I think from a flow perspective, and even from currency management perspective, interest rate hike is not the best tool. The best tool is to augment capital flows if you need to be on a short-term basis, but more importantly, also work on the long-term solution for stabilization of balance of payments. Probably to operate in conjunction with the government, they could provide some hedge protection, attract some external commercial borrowings. It could be open to the private sector. I'm pretty sure you're going to get a lot of inflows. But if you just open it up to the banks and state-owned enterprises, government-owned companies, we can get something like $40–50 billion, and that will definitely be an immediate stopgap arrangement addressing the balance of payment deficit issue. The other solution is, Lata, to take out, the interest tax that you're deducting from for the investors from outside, and at the same time get rid of the capital gains tax. India is one of the very few economies in the world which is putting tax on that interest income for foreign investors and putting capital gains tax. And by the way, non-resident Indians, I am included in one of those, can put money into domestic banking system and not have to pay tax on the deposits or interest income on the deposits. So we have created such carve-outs, and we should create similar carve-outs for foreign investors. It's just like what you want to be in a relative space versus other investment destinations.
Okay, that's about the economy, but let's also get into some market opinion. Today, Lawrence Blanco of CLSA says they remain range-bound for India due to lack of momentum, adds the mean reversion trade is being played out in IT, and that he expects a 12.5% upside on that. Listen in.
Lack of momentum has left us in this trading range that we've had for going on 24 months, and that range is defined by the lower boundaries around the 22,000 to 22,300, and the upper boundary at that 26,000 to 26,300. And in the very near term, there is the 8th of April gap, which does give you some near-term support around the 23,200 area. So those are the levels that we're looking at. But in summary, a lack of momentum, and if anything, risk towards the bottom end of the range that we've seen over the past 24 months. Yeah, so base case on the Nifty RT is that we've got a mean reversion trade playing out. We did get slowing downside momentum into the May lows. And if you just look at a mean reversion trade back to the 200-day, we still have another 12.5% upside for that rebound trade. Yeah, it's been one of our favorite parts of the Indian market. We did our outlook piece for 2026 in November last year, and we highlighted the Nifty mid-cap space, which had basically been consolidating since its 2024 highs. And, punching through the top end of this range, we think the Nifty mid-cap can continue to re-rate and remain a leadership parts of the Indian market, and the breakout from the 24 to 26 trading range gives us roughly 30% upside. So that is a place that we would focus on. We would look for pullbacks that we get within the mid-cap space to look to add to exposure. And we think that leadership is intact and should remain in place into year end. Mid-caps over small caps, as well as mid-caps over the large cap side too. So our focus really is where we're getting the most constructive price action within India remains mid-caps. I might just give you two, Polycab one and KEI Industries being the other. Similar exposure, but both stocks have broken out of their trading ranges from the 2024 highs. We've seen that in leaderships and other stocks we've been highlighting in mid-caps, and we've seen a bit of a pullback in BSC and MCX on the exchange front. We think both those stocks on pullbacks you can look to add to. So those four would be what we've been highlighting previously, and we'd look to buy on pullbacks there.
That's a market review coming in from Lawrence Blanco. But in terms of the markets, what are they doing right now? Like I mentioned, right, they're continuing to hold on to 23,500. Now we've moved on furthermore higher on in the day as well, 23,550, closer to that mark, 0.7% of gain that we're seeing. And what a recovery from the day's low, right, for the market. Nifty expiry, weekly expiry overseas today. But this week, a run-up is something, whether it sustains or no, is something we'll watch out for. Look at the constituents for the Nifty 50 which are supporting the up move. IT, that has been the trend in the last couple of trading sessions, last week specifically as well. And Infosys, TCS, HCLTech, that continues to do well. While on the flip side, some of the private banks not doing too well, Sonal.
Okay, all right. So we'll keep tracking market moves for you. The chemical space is also perked up. But with that, we are completely out of time on this edition of Midcap Radar. A special discussion with IEA's Fatih Birol when we return. Stay tuned for that very important conversation. Welcome back. You're still tuned into CNBC TV 18. The market recovery is something that we have been talking about. But if we talk about some stocks which are specifically contributing or are at least buzzing on the upside, Balaji Amines has to be one of them. 14.5% higher on that one, giving it companies alkyl amines. Now, do remember, Balaji Amines reported really strong set of numbers in Q4. The similar case is something that we saw with alkyl amines as well, 10.5% higher on that stock for now. These stocks have been buzzing ever since. Q4 has been strong, and the outlook and the commentary has been strong as well. And that's the reason why these stocks have been buzzing since then. The other pocket which is doing well today, at least, is the IT pack. Not only the large cap IT names, the likes of TCS, Infosys, but we do have other names on our radar as well. In fact, let's now cut across to my colleague Shireen Bhan in conversation with IEA's Executive Director, Fatih Birol.
Hello and welcome to the Global Dialogue. I'm Shireen Bhan. The on again, off again nature of the Iran-US peace talks and the continued uncertainty over the Strait of Hormuz have kept the crude oil markets on the edge. Crude prices have seen some wild swings as the US and Iran continue to clash despite the ceasefire, and there appears to be no consensus on an agreement to end all hostilities, at least as of now. The Strait of Hormuz remains one of the world's most critical energy choke points, with nearly a quarter of global seaborne oil trade passing through it. The head of the International Energy Agency, Fatih Birol, had warned a few weeks ago that oil markets could soon enter a red zone as global inventories decline and demand strengthens during the peak summer travel season. He's also warned of the worst energy crisis the world has ever seen. Joining me now to discuss all of this and more is the man himself, Fatih Birol of the International Energy Agency, speaking to us on the Global Dialogue today. Mr. Birol, always a pleasure. Many thanks for joining us here on CNBC TV 18. Let me start by asking you about the signals that you're picking up from the oil markets at this point in time. The Strait of Hormuz continues to remain blocked. There is no consensus as of today. Oil markets have, of course, been reacting today under $95 a barrel. What gives you hope, if anything at all, and what do you fear the most today, Mr. Birol?
Thank you. Greetings to India from International Energy Agency headquarters in Paris. We are facing a major problem in the energy markets, and as I said almost 2 months ago, this is the largest energy crisis in the history. We had 3 major energy crises in the last half a century. 1973, a major oil crisis. 1979, another major oil crisis. And 2022, after Russia-Ukraine war, a natural gas and oil crisis, especially in Europe. So the amount of oil and gas the world has lost, combined in these 3 major crises, is less than oil and gas we lost in this very crisis of Iran war. So we lost huge amount of oil, huge amount of natural gas, and this would have major implications for the global economy, especially in Asia, and within Asia, developing economies. So my biggest worry is the following. When we enter this crisis, we had buffers. The IEA has said that before the 28th of February, there was a lot of surplus, there was a lot of oil in the markets, pushing the oil prices down. And after the crisis started, we have been using this surplus plus the inventories, the stocks that the governments and companies have, and all this gas, oil we have already is now diminishing. The inventories, the stocks, the money in the pocket is diminishing and not new money is coming in. We are coming at the bottom of those. And as I said, if we are not able to see fully an unconditional open of Strait of Hormuz by end of June, July and August, the travel season around the world in many countries are starting, the flights and the cars and the buses. We may be entering the red zone for the global economy, especially those in Asia.
You know, you talk about entering the red zone in July and August, which is when you expect travel demand to rise. And you talked about an unconditional opening of the Strait of Hormuz. As things stand today, Mr. Birol, how likely is that scenario? We've seen Iran and Oman talk about a mechanism being put in place. They refuse to call it a tolling structure. But do we now need to grapple with the reality of that new mechanism coming into place? And what will that mean for the oil markets?
So what the oil markets want to see, what the energy actors, players want to see, that a state is open fully and unconditionally, which means that the tankers can travel without having any questions about security and without paying any fees, because the international law, the maritime law, tells us that the international travel in the waterways is free. So, of course, it's up to governments to decide what they are going to agree, under which conditions this agreement will be made between the different parties. But it is important to give the markets the confidence that the tankers can travel without any security questions. And this is, of course, not an easy task. Many people think, I talk with all the actors, both governments and the industry, many people think if it is closed once, it may be closed again. So this is something that I think the countries around the world need to give it good thought. What are the energy strategies, priorities in the future, and what kind of lessons they need to draw from this very situation.
I'll come to the lessons in just a second, but if I can talk to you about immediate next steps, Mr. Birol. You know, the 400 million barrel emergency release was the IEA's largest ever. You've said that it reduces the pain, but it is not the cure. We've also seen strategic reserves, for instance, for America being drawn down quite significantly. Now, are we looking at the possibility of another tranche from the IEA, and what will that mean in terms of the oil markets if, in fact, you go through with that?
So when I announced on 11th of March that we are releasing 400 million barrels of oil to the markets, it is historic. It is we have made several releases, but this is the largest by a big margin. We have seen that as soon as the markets saw that this oil is coming to the markets, to calm the markets, the prices went down by about $20 US. It provided relief. It was very good. And it was a unanimous decision of our member countries and many countries who are the accession countries to IEA to be a full member, such as India, gave a strong support, and here I want to thank Minister Puri for his strong support. Now, this 400 million barrels is big, but it is only 20% of the reserves we have. 80% is still in the pocket. And we will see, we will assess the market conditions, and if we think it is necessary, we will be ready to act immediately. So it is up to markets, up to market conditions. If we think there is a need for that, and we are ready to act immediately and swiftly.
If I may double down on that, Mr. Birol, you said that you will act immediately if the conditions so arise. What could trigger the move on the second tranche of the reserves being activated? What could those conditions be that will force your hand in some ways?
Now, we are discussing this in the last few weeks, few months, almost on a daily basis with our member governments. We need to come to a conclusion that the disruption came to such a level that it is now time to go ahead. But as of now, as we speak now, I don't think that we are at this stage yet. But we are monitoring the markets momentarily and very closely. If we believe it is the time, we will definitely go for it. But at the moment, we are not there.
Well, that is important. You're saying at the moment, the IEA doesn't believe that it is in the position to activate the second tranche as far as the strategic reserves is concerned. You don't feel the conditions are right for that, at least at this point in time, but it is something that you're actively monitoring. Let's also understand what the process of rebuilding will look like and what timelines we're talking about, Mr. Birol. Assuming that an agreement were to be reached between the US and Iran, that the strait were to reopen, in the next few weeks, what will that mean in terms of rebuilding, in terms of what is already stuck, the oil that's stuck at the Hormuz? What will it mean in terms of rebuilding infrastructure in key markets like Qatar, etc.?
It will be, in some cases, in some countries, it will be easier. Those countries who are able to store the oil in the major storage facilities, and the countries who have strong financial muscles and technical capabilities. For example, Saudi Arabia, I think, will move very fast. Emirates can move also fast, and some others. But some countries such as Iraq, I am worried about Iraq because Iraq's oil storage facilities are not as big as the other countries in the Gulf region, and there are many shut-ins of the fields. It may take some time, and also as I said, the financial capabilities of the countries are important. And it will be also depending on the damage that the facilities have witnessed, such as the ones in Qatar. I think it is rather naive to expect that the Qatar LNG terminals will go back very quickly where they were just before the war. So if it is, to sum up, if the Hormuz Strait is open, if there is a peace, it is an agreement, it will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process, volatile markets for some time to come.
If you're saying that it will be a rocky process, it will continue to be volatile even if the strait opens and there is an agreement, what does that mean in terms of oil prices? We've seen wild swings from 144 now down to about 95. What do you see as the possible ceiling? What do you see as the possible floor?
So I will not mention any specific price levels, but first of all, I would like to remind all of us that some observers say the oil prices are low, but they are not low. They are, let's remember that they are at least $30 higher than where they were just before the war has started. And it is already being a major pain on the economies of many oil importing countries, especially developing countries, and we will see they are going to push the inflation numbers up in several countries, especially when the currencies are not so strong. Looking at the next few weeks and months, I believe it will be rather a transitional period, and it will be not easy to get all the Middle East oil, which exported more than 20% of the global oil to the rest of the world, to see that everything will be easy and the prices will come down the next day. I think we need to expect that the prices will be at these levels for some time to come. And I am only worried, once again, that the Strait of Hormuz is not open before the end of June, before the inventories are going completely to the bottom, and before the travel season in many parts of the world starts. Otherwise, we may well see even higher prices than today.
Let me end, Mr. Birol. I know you're out of time, but let me end by asking you about the future as far as the OPEC is concerned, especially with UAE exiting the bloc. What do you see as the future as far as the oil bloc itself is concerned?
I mean, it is, of course, it is up to OPEC countries to decide what they are going to do. And I have recently, when I was in Vienna, meeting the Prime Minister of Austria for several issues, I had the opportunity to visit the OPEC Secretary General, and I think it is important that all the parties in these difficult days have a good, sincere dialogue, because this is a situation that we don't have the luxury to have tensions between the producing countries, consuming countries, and I think that it requires a good communication, good dialogue among the parties around the world. Emirates, they made their own announcement. The colleagues from the Emirates, both the minister and the other authorities, that they chose this way, and they are going to increase their production in the next years to come. And I also have good contacts, good coordination, and good dialogue with the authorities and the government of United Arab Emirates.
Well, Mr. Birol, always a pleasure. Appreciate you joining us. We hope it doesn't get to that scenario of the red zone that you spoke of, and we hope that there is a breakthrough in the talks that are currently ongoing. But appreciate you joining us this afternoon to talk to us about all things energy. Always a pleasure. Thanks very much for joining us on the Global Dialogue.
Thank you.
Well, that is Fatih Birol of the International Energy Agency, telling us very clearly about what the possible pain points are likely to be. In his words, it would be naive to imagine that even if there were to be an agreement between Iran and the US, that oil prices are going to drop significantly, as is being claimed by President Trump. But of course, also highlighting that there needs to be safe, secure and unconditional movement through the Strait of Hormuz. The red zone that he talks of is the July to August period, when travel typically is expected to pick up, and that could put pressure on demand. Supply already constrained. Importantly, the IEA is not looking at releasing the second tranche of the strategic reserves. Remember, they've already done a tranche, the first tranche of a historic 400 million barrels, but they don't feel the need to act on the second tranche just yet. We will take a break here, but there's a lot more coming up for you on CNBC TV 18. Stay tuned. We're back with more right after this.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Asian markets have opened up in the red. Most of them, at least, are trading in the red, right?
Trump essentially saying that negotiations with Iran are continuing at a rapid pace.
The gift Nifty suggesting a gap down start. Hopefully you see some kind of bounce from there.
The US contributes around 40-45% of the global opportunities.
And both CNG as well as EVs have seen a sharp jump in the bookings and inquiries over the last couple of months.
23,270 on the Nifty.
There is very, very strong support for EV.
Noel Tata has actually raised concerns with regards to growth at Tata Digital. A choppy start to what has been a very rough start to the month of June.
Our global crude price forecast is $92.5 per barrel for CY26.
So money is moving back into the software names worldwide.
The e-Vitara exports alone is about 5,000 a month.
To see a slight bit of a recovery from the day's lowest point as well.
AI giant Anthropic has confidentially filed for a US initial public offering.
What a rally from the lows of the day, and that is all that anyone can talk about.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and with me is Rima. Well, Rima, we are at the start of the show saying what a good recovery from the day's low, but just take a look at what's happened in the last 10 minutes. The Nifty has fallen close to around 70 points from the highs of the day, so it's going to stay very, very volatile. I think the last 60 minutes have plenty in store for us because we have the weekly expiry as well that will play out. A bounce from oversold levels, but from the top as well, we've slipped a wee bit.
Indeed. So today is the Nifty weekly expiry, as you said. So that's going to cause a lot of volatility. The Nifty Bank has slipped about 250 points from the top. The mid-cap index has dipped into the red. But it's good to note that crude prices have actually eased. At 8:30 when we started, at 9 o'clock when we started, the Brent crude price was closer to 95. It was 94.7. And now as we speak, it's 93.2. So that is a positive. And once again, it's IT leading from the front today. So let's get to the action then.
Well, that's right. Well, we've got an action-packed final hour of trade coming up on Closing Bell. Let's tell you what we have lined up. The market erases early losses to climb to the highest point of the day, gains led largely by IT. Pharma stocks, though, they are the sole sectoral drags today. Auto sales for the month of May pointing towards strong passenger as well as electric two-wheeler demand. But commercial vehicles seem to have taken a little of a seat back. Key takeaways coming up in just a bit. And Workouts Management tells CNBC TV 18 it sees a $1 to $2 billion opportunity after receiving a US FDA approval for its novel antibiotic Zanuck. The stock comes in for profit taking, down close to around 8%.
Okay, how should you position yourself in the last hour of trade? Ashish Kyal from Wave Strategy Advisors is now joining in with a few closing strategies. Ashish, the gains are not holding, but it's still a snapback from 4 days of a losing streak. So as we speak, we're up close to about 0.3% on the Nifty and the Sensex, but rapidly unwinding. What's the call on the Nifty? And do you see this 23,200 from where we took support today as a very important support level, which is unlikely to be breached?
Hi, afternoon to you and all the viewers. If you look at Nifty, like we talked yesterday also, the support zone is between 23,280 to 23,330, and that's where the markets try to form a low and also bounce back sharply from there. Having said that, the overall undertone remains sell on rise as of now because 23,530, 23,540 is going to be a hurdle. 23,500 sees a good open interest build up also on both sides. So looks like the call side, call sellers are active at around 23,500. So crossing that is not going to be an easy task. So it's going to be range bound. From here, we can again possibly see a levels of around 23,330, 340 on the downside. And one can play for that range. On the upside, the major hurdle is around 23,540 levels on the Nifties. But I think it's going to be sideways for now, as long as 23,220, today's low is intact.
Okay, got it. Ashish, what would negate this cautious stance of yours? Beyond what level on the upside?
On the upside, if Nifty manages to cross that 23,580, 23,630 mark, so 23,630 to be precise, if that is crossed, then we can say that short-term bottom is in place, and then we can start seeing some positive traction towards 23,900 or 24,000 levels. So 23,630 is going to be an important level, and one needs to keep a very close watch on that.
Got it. You want to fill us in with a couple of trading ideas?
Yes, absolutely. With respect to, we talked about how IT should outperform yesterday, and we can clearly see that performance coming from the IT large cap and the mid cap space as well, with Infosys up by nearly 5% or more than that. And the peak is going to be from Coforge. We can clearly see the mid cap IT has also started showing some kind of a green shoot, and Coforge is showing good momentum on the upside. We can expect a target of around 1,605 here. Stop loss can be maintained at 1,480. And the next stock on the buy side is going to be Redington India. We can clearly see it has formed a base. It was underperforming for quite some time, but formed a good base around the zone of around 225. Gave breakout. There is an acceptance near the higher range of yesterday's level. So Redington can be a target of 254. Stop loss can be maintained at 232.
Got it. Okay, all right. Thanks a lot for that, Ashish. Well, let's focus on the FNOQs then, because we have the options, expiry that will play out in the next 55 minutes or thereabouts. So why did we see first a relief rally? We had mentioned this earlier today. Every time the FI shorts move to around 90%, the PCR comes to around 0.65, 0.7. That's when we see a bit of a bounce. So there's a technical factor at play. And both those two seem to have overshot themselves. The fall as well has been very, very rapid. Next up, what about the data points? The Nifty is still holding in the green, but there is some put writing that we're seeing. Case in point be the 23,500 put. The premium is down to 20 bucks. It started the day at around 130 rupees approximately. At the high of the day, it was more than 200 rupees. So that's come off. That's clearly writing being seen at those levels. Well, on the upside as well, though, there is writing because you've got the direction right? But the time value of money is getting eroded. And that's why the 23,600 call, the premium that started at 33 rupees, that's come down to around 2 rupees approximately as we speak. So those are the two, the goalposts for today's trading session. Resistance levels, well, the Nifty Bank came very, very close actually to its 20 DMA, which comes in at around 54,359. While for the Nifty, the 50 DMA comes in at around 23,688. Now, both those two are the near-term resistance marks. We'll have to get past that to have a fresh round in terms of short covering. So they appear like very, very strong resistance zones, both those two. Individual stocks in focus, HDFC Bank. At around 11:30 odd, we did an FNO check and we said that the market needs to turn around, then this one should come in for a bit of a short covering bounce. It appears mild short covering has taken place. Remember, this is a stock that's underperformed. Even of late, it's come down to around the 730 odd mark, but today it's moved up a little bit and the shorts are actually getting squeezed out, which is good. Two stocks, though, that have been moving up, they have come in for a bit of profit taking. One is, BSE. That stock, in fact, we are seeing some fresh shots on that particular counter. The stock, remember, has moved one way, but it's come in for some kind of profit taking. While Swiggy as well, the stock that has been shorted, that actually is seeing a bit of a relief rally in today's trading session. So we'll keep an eye out on Swiggy, pull up that stock as well. Stock has moved up and open interest is down actually quite substantially. So that's why that one came on my radar. Net, we seem to be a bit of a range. I think on the downside, this 23,400 mark should hold out, while today's high becomes a very, very serious resistance, which comes in at around 23,550 or thereabouts. The reason is the Nifty Bank that's not able to hold up. But let's focus on the top sector. We're seeing a very, very smart recovery on the IT stocks, REMA. They've come off the 52-week lows and they've been really the sector of the last 10 days. Fill us in with some data.
Well, indeed. So the IT stocks are seeing a very smart recovery, leading the leadership over the last couple of days. And some of those levels will come up for you on your screen, the kind of up move that we've seen in the last 2 days. So TCS, for instance, has moved up 7-8%. Infosys, even more than that. But here, it's a combination of many things. One, we've seen global rotation take place. So globally, many of the SaaS companies, whether it's Guidewire, SAP, Salesforce, came out with good numbers. Many of them upped the guidance for the current year. So basically, it's given confidence that at least the SaaS apocalypse fear, which was there, has been put on the back burner. Secondly, the rupee continues to remain weak. It's pulled back from the absolute low levels, But a weak rupee compared to Q4 levels is still an earnings tailwind for the IT companies. And then the valuations or the kind of underperformance that we've seen from the sector, even notwithstanding the up move today, these stocks are still down 20-25% on a year-to-date basis. Valuations are trading below their long-term averages. But, just going by the kind of underperformance, it just gives you a sense that perhaps this is a recovery right now. It's a bounce back and not a full-fledged recovery. But what really stands out is that most of these IT stocks hit a 52-week low in March. From that level, the large cap IT stocks have seen a pullback of about 10, 12, 15%. That's from the 52-week lows. There you have those levels. It goes from 10, goes up to 20%. But look at the way the mid-cap stocks have recovered from the lows. So Oracle Financial Services, for instance, the 52-week low was on 17th March. It was a level of 6,234. From that level, Oracle Financial is up 66%. A Tata Tech is up 40%. A Coforge is up 50%. A Hexaware, First Source, many of these stocks are up close to about 30-odd%. So I guess the key takeaway is that many of the large caps are also recovering and bouncing back from oversold levels, but mid caps are where you are seeing the fastest recovery right now. And there are no big earnings triggers now. The next trigger will come in only in July, but Accenture reports numbers on the 18th of June. So that's still about 2 weeks away, but that would be the next trigger for the Indian IT companies. Sudeep, we were chatting with Lawrence Belanco of CLSA, and he called it a mean reversion technically. So he said the Nifty IT can run up to its 200-day moving average, which is about a 34,000 level. Currently, the Nifty IT is at 31,000. So we're looking at an upside of nearly 10%. But he called it mean reversion and not a long-term play, a tactical bounce. What's your view on IT? Was it overdone? Do you play this?
Well, I don't think I will like to play IT at this stage. I think the AI-related disruption is real. And probably we are seeing just the beginning of that. There is much, much more to come. That's our guesstimate. Look at the speed at which both Anthropic and OpenAI are coming up with new models, which is disrupting the existing IT companies. But having said that, there is no need to write off the IT companies because even Anthropic and AI have launched their own services companies. So it's very clear that they also understand that there is a need for services companies to take care of the models which they are launching very, very fast. So obviously, the large IT companies, small IT companies will have a role to play. But who will be able to play that role? My guess is that the mid-sized IT companies, particularly the ones which have taken steps in the AI arena, like a Coforge or even Persistent, KPIT, I think they have recovered faster, they are moving faster, and they are the stocks to bet on if you have to really get into IT. Time still hasn't come to look at the large cap IT companies.
Okay, all right. Sudeep, stay with us. Automakers, they are in focus on the back of May sales numbers. Sudarshan joins us to fill us in with more details on all of them. Sudarshan?
So all the companies have reported sales for the month of May, and overall the demand picture, I would say, it was a mixed showing for auto company. As far as demand is concerned, it was largely stable for passenger vehicles and two-wheelers. Export segment continues to see a healthy growth, and for two-wheelers, scooterization trend remains intact. One of the underperformers this month was commercial vehicles. So we'll start with two-wheelers. Bajaj Auto sales were largely in line. Export monthly run rate remains about 2 lakh units. For TVS Motor, it was an all-round bid. All the segments have seen growth of more than 30%. Hero MotoCorp, scooter, EV have seen a very healthy growth. And in motorcycle segment, the growth was led by Deluxe 125cc. For Eicher Motors, sales were largely in line. Up to 350cc segment continues to see a healthy growth, but above 350cc segment has seen a decline in the month of May. In the passenger vehicle segment for Maruti, it was an all-round bid, strong sales, especially entry-level segment from the low-base company has seen growth of almost 144%. And management believes that current momentum may continue going forward in FY27 as well. For Mahindra & Mahindra, it was above estimate numbers for both tractor and the auto segment. Also, company maintains the outlook for SUV, that is mid to high teens, and for tractor segment, that is mid single digit for FY27. Hyundai was the underperformer in passenger vehicle segment, while it has seen a minor growth of 4%, but sales were largely below expectations. Commercial vehicle, overall it was below expectations. Tata Motors commercial vehicle has reported growth of 17% against our expectation of almost 24%. Ashok Leyland was the biggest underperformer. Company has reported decline of 3%. And if you leave LCV aside, all the other segments have seen a decline. And on the similar line, Force Motors too has come out with the numbers, and company has reported decline. Domestic sales have come in at lowest levels that company has seen in last 18 months. And also we have spoken to Bajaj Auto Management, and they believe that they had a target to hit on export front to hit the target 2.5 lakh units. Company believes that if West Asia war did not exist, they would have hit 2.5 lakh units in the month of April. But here on, they are expecting the export numbers to be at 2.5 lakh units. Now, high-end segment in the motorcycle, they believe that demand remains strong. The segment that is facing the problem is the entry-level segment. From the levels of Q3 and Q4, there is a sharp decline that this segment has been facing. And also, it believes that going forward, that higher end segment will be in the focus, and that will lead the growth. And in the electric two-wheeler, company continues to be at the number 2 spot and has gained market share of 100 basis points. And its market share now stands at 23%.
Okay, all right. Thanks, Sudarshan, for that. Sudeep, what stood out for you?
Well, Bajaj definitely stood out for me because EV definitely is gaining market share. EV two-wheeler, they have a commendable work they have done. They are number 1, number 2, depending on the month we are looking at. The second part, which they are also doing very good, is exports. Leave aside the West Asia related disturbances, but otherwise the exports are doing well. With the currency, the way it's depreciated, I think, Bajaj Auto P&L should be even stronger going forward with the rupee depreciation benefit. So I do like Bajaj Auto. I also like Tata Motor passenger vehicle. I think, again, the EV related tailwind which they are getting should help them going ahead.
Sudeep, we'll leave the conversation here. Thank you very much for joining in. We will get into break. On the other side, Jigar Mistry, co-founder of Buoyant Capital, will join in. Stay tuned. Welcome back. We're up about 0.3%. So we've snapped a 4-day losing streak. But in the last 20 minutes, 30 minutes, we've slipped about 100 points from the top on the Nifty. The high today was closer to 23,550. So we've slipped a tad bit. The mid-cap index is absolutely flat, though the advanced decline ratio is slightly tilted in favor of the advancing stocks. But let's put the spotlight then on the top movers in the market at this hour. Harmis joins in with more.
The day that has been no short of action. Of course, can't not talk about IT in a day like this today. Continuing to go from where it left off in yesterday's session. You look at all of them. Even the market has come off from the highs, but these stocks continue to hold on. 5.5% for Infosys, 6.5% for TCS, almost 4% for HCLTech as well. You take a look at the options front as well. All of them have seen their very active options in their premiums gaining anywhere between 100% to even 300% for the 2500 call option for TCS in the session today. Now take a look at the volumes as well. Now for Infosys, we have had close to well over 3 crore shares that have been traded. The 20-day average is 1 crore. Even from most of these names, the key takeaway is that today's volumes are at least triple their 20-day average. Even for HCLTech, with over 70 lakh shares that have been traded, the 20-day average is around 25 lakh shares. And for all of these names, at least anywhere between 50 to 60% of the shares that have been traded today have been marked for delivery. A small cap name that has done well today is Balaji Amines. Is the top gainer on the BSE small cap, is holding on to gains of around 16% in today's session. The biggest single day gain after the 14th of May. That day the stock was in a 20% circuit. The stock has snapped a 4-day losing streak today, and there was a very sharp spike in volumes after around about 1:45 this afternoon on Balaji Amines, and after which we have had more than 25 lakh shares that have been traded, and that is already 5x its 20-day average, which is around 5 lakh shares. A third of those shares that have been traded so far have been marked for delivery, and the June has generally been kind to Balaji Amines. Over the last 3 years, the stock has delivered returns anywhere between 10% to as high as 30% in the month of June. That 30% return came as early as last year, and the stock too is at a 52-week high in today's session. And lastly, among the top performers within the EMS space, that is Syrma SGS, 5% higher in today's session, among the top non-IT gainers in the broader markets today. In fact, in the last 10 sessions, the stock has gained in 9 of them, and during this 10-day period, the stock has gained around 20%. Has Syrma SGS from 960 odd, the stock has gone up to 1160. In today's session, we have had 22 lakh shares that have been traded, slightly above their 20-day average. So nothing significant on the volume front, but at least 53% of the shares traded so far have been marked for delivery, and the result of this outperformance is that even though most of its peers are negative on a year-to-date basis, Syrma SGS is up 60% so far in 2026.
Got it. Okay, all right. Thanks a lot, Harmas, for joining and giving us that neat list. Well, let's welcome Jigar Mistry, co-founder Buoyant Capital, who joins us on the show. Hi, Jigar. Good afternoon. Good to see you in. What are you all doing right now? Allocating money, or are you all a little bit nervous and waiting by for a better opportunity to get in? What's the current cash holding you're sitting on?
Good afternoon, Nigel. Thank you as always for inviting me to your show. See, cash, frankly, doesn't really, as an asset class and as an active manager, it doesn't really feature at the top for us. I'll give you a very interesting statistic. If you were an investor in the past 25 years, you would have seen close to 6,500 odd days. Of those, the best 10 days have been responsible for 53% of market returns. If you magically happen to miss all of those 10 days, your returns would be essentially half for a 25-year period. So at least as an active asset manager, we think that, a huge allocation to cash, sometimes at the family office level who are our clients, and then within us, leads to double entry and is not really productive. To the first part of your question on, where we are allocating, frankly, I think, 2 themes stand out to us. The first is, and it might be surprising that consumption looks like a very decent space, right? It hasn't done a lot over the past 4 or 5 years, coming from a very high sort of a PE multiple. In the intervening period after COVID, a large part of the government focus was on CAPEX, state, center, and PSU. And over the past 2 years, starting from states and even to the center, a large amount of money, by our count, some 6 or 6.5 lakh crore, which is 1.7% of GDP, has been transferred in the hands of people. Right now, if sort of the concern around IT is getting elevated as well, consumption will not be a bad thing to play over the next year, 2 years or so.
So you said the amount that's been transferred has been 1.3% of the GDP. Is that the amount we've seen with various, say, election-related SOPs, etc.?
Right, Rima. So we total three parts. One is what the states have been transferring as part of social spendings. The central government giving up almost 1 lakh crore of direct income taxes and part of the GST foregone. So we've analyzed the budgets of the past 16 states that went into elections and found that for many of them, the social spending bill is higher than the capex bill. And what has driven the Indian markets in the run-up post-COVID until September 24 may not be the same sectors driving it over the next 2 years or so.
So you would
And
bet
yes,
on the consumer staple companies? Because up until now, the narrative was that in India, the K-shaped recovery is there and it's getting more pronounced. So even when we spoke to Bajaj Auto earlier, he said the top 25% in terms of the top models, price-wise, they continue to sell. It's selling like, I'm paraphrasing here, but it's selling aggressively. So you just get the sense that the K-shaped recovery is getting more pronounced in India. But do you think that thesis might get challenged and it's time now to bet at the lower end of consumption?
Precisely. Just a small clarification, Rima. The number that we calculate is closer to 1.7% of GDP. Okay. But yes, to the second part of your point, absolutely the lower end of the consumption, which has essentially been forgotten for the past 5 or 6 years, is something that can be a theme. See, you look at the total private final consumption expenditure, it's about 204 lakh crores. The total sort of salaries related to IT will impact premium consumption disproportionately, even if there were a slowdown. With 1.7% of GDP getting transferred, the only piece of the puzzle that is missing is how the monsoons play out. If they are broadly okay, and it remains to be seen, El Nino and the IOD is essentially what we are tracking. Reservoir levels are just about okay. So if all of that plays out, then I think consumption can emerge as a very strong theme.
And these would, go ahead.
Yeah, give us some more clarity. What kind of consumption are you talking about? If you would be very gracious if you could go ahead and name stocks, but if you could at least drill it down a little bit with regard to themes that you like within consumption.
So Nigel, stocks are a little difficult, as you know, but see, in terms of granularity in consumption, it initially started with a large part in the discretionary space, right? So you saw auto do well, travel, leisure, that part of the discretionary premiumized consumption. The next round of growth will, in our opinion, be staples. Again, those boring businesses, but, with some amount of volume growth coming in, valuations not cheap, but not as expensive as they were 5 years ago. That is the incremental part which could do much better as well.
What about entry-level cars, two-wheelers, other than consumer staples? Is there any other pocket that you would bet on at this low-end consumption?
Not really, Rima. So, see, what we're getting from the ground is also that part of CV business is under stress. But other than that, I think the personal vehicle segment and the consumption at the staples level look reasonably okay.
For these consumer staples, in the past, when they were in their bull run, what drove the upside, other than the value growth, was also PE re-rating. So from here on, do you expect the upside that comes in from consumer staples only to be indexed to the earnings growth? Or because valuation still, according to many people in the market, is expensive for consumption names, these FMCG staples. So do you see a PE re-rating also?
Right, Rima, because see, one part is that relative to whatever parameter you can call for, and we have run this regression across everything, the SIP inflow is not really reflecting either to 1 year, change in markets, 3 year, 2 year SIP, the change in sort of growth rates, etc. So it looks like that we have arrived at a phenomenon where the percentage of household savings will move to a certain number before it correlates to any other variable that we can think of. Now, obviously, there could be variables we are not thinking of at the moment. But if that were to be the case, then the local money doesn't really have a very large escape, right? If you are an NRI, you can take out like $1 million. If you're not an NRI, then a quarter of that. And everything else must be invested in India. Now, that would, immensely mean that the table waters of valuation across the board will stay elevated, and wherever earnings growth emerges, the market comes back at them with some level of ferocity. So when you're doing those reverse discounting cash flows, you have to account for a fact that some part of it will always be unexplained for.
Got it, Jigar. Thanks a lot. Short but effective chat. Appreciate you joining in and giving us those themes that you like and how you're looking at markets. Look forward to chatting up with you soon. Well, time to slip. No, let's not slip into a break. Actually, Nimish is waiting by. DC Chatter is waiting for us. So let's go across to Nimish. Nimish, what are you picking up?
Hi, Nigel. So a decent recovery from the intraday lows today, and something which I was expecting it should happen. The market looked a little oversold yesterday, and we spoke about the fact that the PCR had fallen below 0.7, and typically around 0.65 the market bounces back. So a decent pullback, largely led by IT names. But for a change, today's IT rally is backed by institutional buying as well. What we saw in the initial stage was more of a short covering rally. Now that's backed by very, very strong delivery-based buying, at least in select IT names by larger institutions today. So that's from a flow perspective. Otherwise, the flows are quite mixed, even in today's market. Even the IT rally had to be put into context of what's happening in the global markets as well. Globally, a lot of the IT names, especially the old traditional IT stocks, have started rallying pretty hard. And that's the reason why even in India, we're seeing a bit of a catch-up rally in the IT stocks. And as I said, there is a bit of buying as well in IT names today. Technically, 23,300 is acting as a very strong resistance. We saw this from those levels. Markets have recovered in today's market as well. So that's the level to watch on the downside. But looks like, after a decent short covering, there is a bit of genuine buying as well into IT stocks in today's market.
Thank you. And what about stocks, Nimesh? What are you picking up?
So the first stock is SGS Enterprise. Well, the stock has been consolidating. It's a thinly traded stock, but there is an anticipation of a large block deal in SGS Enterprises very soon. It's very highly mutual fund owned. The institutional holding is quite high, and the promoter holding is just 21%. But looks like a large block is around the corner in SGS Enterprise. So that's the first name. The second stock, a couple of names where there is delivery-based buying today. I spoke about IT, so Infosys stands out in that IT name, and so is Chennai Petro. So both are buzzing in trade, but expect high delivery volumes on both those names on the back of FI buying. The third name is Star Healthcare. While the stock has seen some bit of selling from larger FI institutions of late, at least from a domestic side, some large mutual funds and some AIFs have been actively accumulating Star Health at current levels. And the last is Excite. Even that's been buzzing in trade today, up 3%, good volumes as well. And for Excite, the street is anticipating some corporate development. A potential tie-up with a leading OEM is the buzz as far as Excite is concerned.
Got it. Okay, all right. Thanks a lot, Nimish, for that. Time to slip into a short break. As always, we'll get you some trading calls, a buy or a sell recommendation from our technical expert. Welcome back. You're tuned in to Closing Bell. Well, Ashish Kayal joins us back to give us a couple of trading strategies. Ashish?
See, overall, from the trading perspective, there are stocks that are buzzing around right now, and I think Exide Industries has shown a very spectacular rise for the past few days, and even today the volumes have been spectacular. So the overall tone for Exide Industries is positive. We can expect the stock to reach towards the prior swing high, which is near the levels of around 425. On the downside, one can maintain a stop loss of around 390 levels. And the next stock on the buy side is going to be data patterns. We can see that the stock has formed a very classic reversal from 3,800, the swing low which was formed yesterday, and today it is managing to form a bullish candle. And we can expect the stock to move towards the level of 4,400 on the upside. As the sector is supporting, I think we can expect much higher levels. And on the downside, maintain a stop loss for the stock at around 3,800.
Got it. Okay. All right. Thanks a lot, Ashish, for that. Well, let's focus on one stock that's buzzing around. That's NTPC. The street seems to be ignoring the near-term concerns and looking ahead, because the EBITDA number that they delivered was little lower than what ICICI Securities had thrown up. The problem was the smaller part of their business, which is the pellets business, delivered an EBIT loss of close to around 100 crores. However, this quarter will be better because they've taken a 500 to 600 rupee per ton increase in terms of prices. And they're talking about 60 million tons of volumes in this year. That compares with around 50 million tons that they did in the past year. That's FY26. Capex guidance as well is close to around 6,000 crore rupees odd. That compares with around 3,300 crores in the past year. So clearly they're upping the Capex guidance. And from then on as well, per annum, the Capex number is only going to move up as they trend towards 100 million tons. But the monthly update was quite disappointing. Production number good, 20% higher. So they're revving it up out there. However, on the offtake front, it was down by close to around 7%. And the miss was because the Karnataka business, the offtake was sharply lower by around 700,000 tons or thereabouts. So sharp downtake out there. But however, the street is viewing it as a one-off because there's a contractor change out there. There were various administration concerns out there. And that's why the street doesn't mind looking ahead. Moving to brokerages, Nuvama, they have a hold rating. Target price has been raised to around 100 from around 85 rupees or thereabouts because they have upped their estimates on volume as well as on pricing. And that's why the EBITDA estimates move up by 13 to around 16%. While Citi maintains a sell rating, target price of 85 rupees, they highlight that domestic prices will remain range-bound post the recent price hikes. And also, they say that Lloyd Metal, a smaller company that had only 10 million tons of capacity, now they've moved to around 25 million tons. So additional supply that could hit the market. Well, that's about NMDC. Let's welcome Jay Bala, the CMT of CashSecures.com, who joins us on the show. Hi, Jay. Good afternoon. Good to see you. What's your take? I mean, I think the last few interactions on Tuesdays, actually the market has been moving lower rather than higher. But you're maintaining that bullish stance?
That's right, Nigel. Good to be on your show. I had mentioned 2 weeks ago about the IT sector popping up from the long-term trend line, connecting the GFC low and the COVID low. And further to that, we've had an inverse head and shoulders breakout on the Nifty IT index. So the key sector that's been a laggard and been dragging for the large caps and has been one of the stumbling block for the Nifty to rally higher. That is actually breaking out. So today's low for the Nifty below 2200, it's an important low, and we still don't have confirmation in the very short term that we have a reversal signature. But if the markets were to close about, need not be even close about, if it crosses 24,090, we have a confirmed low for the markets. And once 24,090 is crossed, we're going to have a powerful move ahead for the markets. Something very likely to be India specific. So watch out for it. See, on a broader perspective, we have the BSE Capital Goods Index hitting record highs, metals at record highs, pharma at record highs, and the mid cap index also at record highs. So these are all healthy signs for the from the broader market saying that this is a very bullish phase. So just wait for the 24,090 cross. The large caps will also start to participate.
So you're basically saying the Nifty is in a range between 23,200 on the downside to 24,090 on the upside. And only if we breach that upside of 24,090 do you see a big up move. Until we are in this range, how do you play it? And is the bias towards a breakout on the upside?
That's right, Rima. See, 24,090 that's for the large caps. But the side markets and the mid cap and small caps, they have been outperforming the Nifty. But there's an interesting statistics that's put out by my friend Akshay Chinchalkar, and he says that from a quantitative perspective, if you buy Nifty at the end of May in a Senate election year in the US, and you come back in November, the markets tend to gain somewhere between 1.5% to 23%, the median being about 8 to 9%. So, this is a very interesting statistics for the medium term for the Nifty. And this ties in well with the medium term projection that I've been putting out for several weeks, that by the summer of 2026, I'm anticipating the Nifty to be about 29,000. So, both the quant and technical perspective tie in for the markets. So what do you do within in the intervening period? I've been bullish on the capital goods space, defense space, and keep your focus on the mid cap space too. So this is where you need to be keeping your focus until the large caps break out.
Okay, got it. Jay, just stay with us. For the time being, let's just get you some market opinion we got earlier today. Lawrence Blanco of CLSA said that they expect the Indian markets to be range-bound due to lack of momentum. They add that mean reversion trade is being played out in IT and that he expects a 12.5% upside from here on. Let's listen in to what he had to say and slip into that short break.
Lack of momentum has left us in this trading range that we've had for going on 24 months. And, that range is defined by the lower boundaries around the 22,000 to 22,300 and the upper boundary at that 26,000 to 26,300. And in the very near term, there is the 8th of April gap, which does give you some near-term support around the 23,200 area. So those are the levels that we're looking at. But in summary, a lack of momentum and if anything, risk towards the bottom end of the range that we've seen over the past 24 months. Yeah, so base case on the Nifty RT is that we've got a mean reversion trade playing out. We did get slowing downside momentum into the May lows. And if you just look at a mean reversion trade back to the 200-day, we still have another 12.5% upside for that rebound trade. Yeah, it's been one of our favorite parts of the Indian market. We did our outlook piece for 2026 in November last year, and we highlighted the Nifty mid-cap space, which had basically been consolidating since its 2024 highs. Punching through the top end of this range, we think the Nifty mid-cap can continue to re-rate and remain a leadership part of the Indian market, and the breakout from the 24 to 26 trading range gives us roughly 30% upside. So that is a place that we would focus on. We would look for pullbacks that we get within the mid-cap space to look to add to exposure. And we think that leadership is intact and should remain in place into year-end. Mid-caps over small caps, as well as mid-caps over the large cap side too. So our focus really is where we're getting the most constructive price action within India remains mid-caps. I might just give you two, Polycab one and KEI Industries being the other. Similar exposure, but both stocks have broken out of their trading ranges from the 2024 highs. We've seen that in leaderships and other stocks we've been highlighting in mid-caps, and we've seen a bit of a pullback in BSC and MCX on the exchange front. We think both those stocks on pullbacks you can look to add to. So those four would be what we've been highlighting previously, and we'd look to buy on pullbacks there.
Welcome back. 3 minutes to close. The Nifty is ending around the 23,500 mark. Jay, you were telling us that while the Nifty has been range bound, so many subsectors have been doing well. The capital goods index, defense, metals, all virtually at highs. And you like the capital goods space. So any stocks or any trading ideas?
Yeah, I have trading ideas from the other space, Rima. We've been bullish on Thermax, RR Cable, and Crompton Grease Power, and those are a little bit late to get in now. But people who are already in, they can hold on to it. And the other picks I have from the broader market is on Exide. Exide has an unfinished price structure from the COVID lows, as well as from its 1996 low. So from its current level of about 400 odds, I'm anticipating it to cross the 2024 high. So that's about at least a 50% move from here on. So this is a medium-term opportunity, not a short-term opportunity, but it's likely to do well in the short term too. The other one is conditional bullish on Wipro. Wipro, if it crosses 213, it will complete a double bottom. And since the IT sector is perking up, and I pointed this out earlier too, that Infosys and Wipro are looking quite good. So if it closes above 213, the double bottom structure will trigger, and it will take the stock much higher from current levels. So a stop loss at about 195 would make sense for Wipro.
You're tracking the tech index, at the index itself. What levels can we look at over there? And also the Nifty Bank?
Yeah. Nifty Bank, the resistance comes at about 53,850. So, and I'm not clear if HDFC Bank has got a truncation at yesterday's low, or it's already got one more low to come through. So that's the key for the Nifty Bank. When it comes to Nifty IT Index, like I've been pointing out that the 26,000 or 27,000 levels is a very crucial level. The markets have turned up from there. So, from 41,000 to 27,000, I'm anticipating the markets to retrace at least half of that move. And from if it's as the markets unfold over the next few weeks, I may even raise it to the possibility of the Nifty IT Index clocking fresh all-time high.
Got it. Okay. All right, Jay. Thanks a lot for joining in and giving us all those calls. By the way, just pull up a few intraday charts. NIIT, I don't know what's gone on there, but the stock has suddenly seen a very, very sharp, intraday move. So NIIT should come up for you, as is the case with Apollo Microsystems as well. Big uptick is what you're seeing on both these two names, and volumes as well bursting away as we speak. So just thought we highlight that. And IIFL Finance is the other one. The stock has been a rank underperformer, but that one as well, it seems there is some supply out there that's gradually getting consumed. So keep an eye on that one as well, currently at the day's high. But time to wind down the markets. Finally, a green day for the bulls. It's been the last few trading sessions have been a little bit painful when the markets have pulled back close to around 500 points. And this morning, we started off with a leg down. However, the bulls fought back, and a couple of technical indicators like the PCR had moved to an extreme. The FI shorts as well had moved to an extreme. And that's why we saw a bit of a bounce from the day's low. Tech, that was the story of the day. TCS 6% up, Infosys 5% up, HCLTech 4% up, Tech Mahindra was up and about. Throw in then Adani Enterprises as well, that did pretty well. On the flip side, NTPC was down close to around 3%, you had Axis Bank that was down close to around 2%, and you had Power Grid that was down 1.5% in today's trading session. What else did well from the broader markets? NIIT, as we said, it came to life in the final hour of trade, was up close to around 12%. Orient Pro, that stock was up close to around 7%. I'm not sure whether or not there was a rub-off that's coming in there, because a couple of large product players actually had talked up the market, and that stock ended high with a gain of around 7%. Remember, the stock is half from the top, but today it made its way back. Apollo Microsystems as well was up in today's trading session. And Sterlite Technologies, after a while, that circuit got released, but it said, no, we want to go back to the circuit. So after pulling back to the lower circuit, that ended higher with the upper circuit, that is Sterlite Technologies. Finiotex Chemicals as well was up close to around 4.5%. Add to the list an HCC that was up close to 5%. On the flip side, the losing stocks was NHPC, because they're coming to raise some money via the OFS route. It got totally lapped up, but it was at a discount to yesterday's close price. So that stock was down. And Z Enterprises as well, after the big run that we've seen, 80 to around $100. Today it's pulled back a little bit. It was down close to around 2% in trade. Well, on that note though, we'll wrap up on this edition of Closing Bell. You stay with us. The team of Markets Forward comes up next. Stay tuned.
A strong recovery on Dalal Street market snap a 4-day losing streak with both the Sensex and the Nifty rebounding more than 1% from the day's low. Nifty reclaims the 23,500 mark.
A rush of share sale lineup after the earnings season ends. The centre looks to divest up to 6% in NHPC. Alchem Lab sees a large block deal while Acme Solar and Ola Electric float QIPs. All these in a day.
The Nifty IT index rallies more than 4% with heavyweight tech stocks bouncing sharply from the 52-week lows amid improving sentiment around the sector.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vinny Motiwala. With me is my colleague Ritu Singh. Ritu, hi. It's been a day where we started off at the day's low, ending almost near the day's high, nonetheless slightly below the 23,500 levels.
That's right. It's been 4 days of pain, so yeah, it's good to see that green back on the screen. And what a recovery we saw thanks to the shining star in trade, the IT pack. That did pretty well. That's why you're seeing the kind of recovery you did. And by the end of the day, of course, even the broader markets have picked up. But within the IT pack index, you had the heavyweights, Infosys, TCS. They were the big contributors to the frontline index as well. Names like HDFC Bank, ITC, HCLTech, all of them doing well in trade. What did see some pressure, though, Vinny, was the pharma sector. A bit of a weakness there.
Absolutely. A bit of a weakness coming in for the pharma pack, but advance decline ratio also a bit more in the favor of advances versus decline through the day. So that saw an improvement coming in as well, and broader end of the market also recovered from the day's lowest point. But, we have a very exciting lineup for you all on the show today. And what is in store? We'll start with the top movers and shakers of the day with Sudarshan. Then move on, talk about tech stocks that continue to stage a smart recovery. We will decode what's fueling this rally, and we will also put the spotlight on the share sale rush that has come in and why First Motors was under pressure in today's trading session. Last but not the least, we'll delve into the key corporate voices for the day as well and what we spoke to. But on that note, let's go across to our first segment. We have Sudarshan joining us to take us through the top movers and shakers from the big wall. Sudarshan.
So for the last 2 days, one sector, one segment that has been bucking the trend despite the move that market has been having. That is IT segment. Today also you can see top Nifty gainers, TCS up more than 6%, Infosys up almost 6%, HCLTech, Tata Elxsi, Coforge. Majority of the IT stocks have seen a huge surge. You know, what could be the reason? Valuation comfort. If you take a look at the median average or median PE of 20 years, Nifty IT, that's 17 times. And current 1 year forward PE is at 17 times. So that might be one of the reasons why you have seen a big surge in all the IT names. Some of the stocks that have continued to see an up move. First one is Exide. Just few days ago, this stock was trading around 340 levels. Now it's up on more than rupees 400 per share. And for the last 1 week, the stock has gained as much as 8 to 9%. NMDC, despite a weak update for the month of May, the stock has seen a huge surge and closed the day with a gain of more than 3%. Angel One, despite other capital market names slipping in the trade, this stock has been moving higher over the last few days, and today also was up more than 2%. Apollo Microsystems, yesterday it has slipped, but again today it has seen a big move, up more than 8%. MTR Tech 2 has seen a similar move, closed with a gain of more than 2%. Some of the stocks that have reacted positively to the management's commentary, first one was Blue Star. Today the company spoke to our channel cnbc TV 18, in which it has said that both in the month of April and May, company has been seeing a strong demand, and because of that closed with a gain of 2%. Yesterday PG Electroplast had come on the channel, that also spoke about the strong demand, and today it has gained more than 2%. Maruti Suzuki is seeing a strong momentum in the entry-level segment. In the month of May, that segment has seen an increase of almost 140%, and because of that, this stock closed 3% off lows. But while we have seen big up move in the market from days low, there are some stocks which have reacted negatively. First one, NHPC. Government is looking to sell up to 6%, including green shoe via OFS, and indicative price around 71 rupees per share. Stock closed with a cut of more than 6%. Force Motors, it was a weak print for the month of May, closed with a cut of 6%. BSC, yesterday fell almost 4%. Today also closed with a cut of more than 3%. And last one, Hitachi, closed 3% lower with healthy volumes.
Sudarshan, thanks very much for that wonderful snapshot of all of the action that took place on Dalal Street. And it was a busy day. Multiple share sales hitting the market, from QIPs by Acme Solar, Ola Electric, to the NHPC offer for sale, and a major block deal in Alchem Labs. Let's get straight to Nimesh for all of the details on all of that action. Nimesh.
Earnings season is over and the fundraising season has started, so no respite for us. We have to keep looking for news and keep reporting. For fundraise in one single day, I'll start with OFS first, which is NHPC. So it's a second OFS by the government in just 1 week. We saw Coal India first, and now in NHPC, government is looking to sell 6% stake via OFS, including a 3% green shoe as well. And the offer price is around 71 rupees per share. So that's the reason why the stock is under pressure today. So this is just a start, I believe, from the government side as well. They've been lagging behind, but it looks like they want to catch up on this fundraising spree. So that's the first one. NHPC down today because of the OFS at 71 rupees floor price. That's the first one. The second one is Acme Solar. That's a big one, a QIP of almost 2,800 crores. But the stock has reacted positively, largely because my sense is that there is a very strong demand for the Acme Solar QIP issue of 2,800 crores. So that's the reason why the market has reacted a little positively. It's up 7% in today's market. The floor price is slightly lower, a 5% discount, but looks like given the demand, we've seen a bit of an uptick on that name. So that's the second name. The third is Ola Electric, a small fundraise, 500 crores, but nevertheless that stock is under pressure. There is a 10% discount in the QIP, and hence a bit of pressure on that name. And the last one is Alchem Labs. Again, a promoter is looking. They've sold nearly 1.5% in a block window today. Again, close to 900 crores that they've raised. But there is a 90-day lockup for the promoter. But the trend of promoters selling or the QIP is coming in, it's only going to increase from here on because the earnings season is largely over. So 4 today, but my sense is there is more lined up in the next 1 month.
Okay, Nimesh, thanks so much for that. A lot of OFS, a lot of selling that's coming from promoter groups as well. But let's take the discussion forward now, and we're joined by Sudeep Bandyopadhyay of IndiTrade Capital as well as Jay Bala of Cash the Chaos. Jay as well as Sudeep, thank you so much as always for joining us on the show. Jay, what a day in terms of recovery that we've seen coming in for the markets, where we started off at the day's low, moving on to near the 23,500 levels. And previously you were talking about that by the end of this year, 29,000 for Nifty 50 is what you're talking at. Jay, right now, is this run-up going to continue, or maybe we'll see a bit of a correction again coming in for the markets?
Hi, Vinny. It might look surprising for now because the large caps have been lagging behind, but whereas the broader markets have been doing extremely well. If you look at the BSE Capital Goods Index, it's at record highs. If you look at the mid-cap index, it's at record highs. The pharma index is at record highs. And metals index is at record highs. This is after the April lows. So the broader market's health is pretty good. So it's just the large caps have been lagged. And there's good news there too. Like I pointed out a few weeks ago, the Nifty IT index, which has been the laggard along with the FMCG index, that's actually turning around. We had a bullish breakout from the long-term trend line connecting the GFC lows and the COVID lows. So this is signaling that the Nifty IT index is coming to at least rally 50% of the move from 40,500 to the 27,000 low it registered in the last 6 to 9 months. So if you look at the US software sector ETF, that's rallied 46% from the April lows. So the Nifty IT index is actually just playing catch up, and the Anthropic scare is probably going away or at least receding. So the laggard Nifty IT index, which has got 4 major stocks within the Nifty IT, that's once that starts performing, we're expecting a breakout to come through for the large caps in the Nifty space. Watch out for 24,090. That's an important resistance. Once that's taken out, I'm anticipating a very bullish move, and that will set the Nifty on course for the 29,000 by the summer of 2026.
Okay, Sudeep, quickly, if you could come in on that as well. The markets, 4 days, we've seen pain today, a bit of a bounce back from there. But broadly, what we've been seeing is lower highs and lower lows. Where do you expect the index to go from here in the near term? Sudeep,
I think the market to a great extent will depend on what's happening. Yeah, I could hear it. I think market to a great extent will depend on what's happening in West Asia. I think if we find a resolution to that conflict in the near future within the next couple of weeks, I think things will start improving, and we will see the market move up very fast. But having said that, I will urge on the side of caution. And I think we have a lot of internal challenges, particularly with monsoon not being expected to be normal or above normal because of El Nino impact. So, and that has a significant impact on Indian economy and Indian companies. So, by and large, my reading is that we definitely need to get over this West Asia challenge. And once we are over that challenge, we will start worrying about our internal issues, particularly monsoon and related challenges.
Okay, point taken there, Sudeep. But let's move on and talk about the IT pack that's leading the charge, right? Not only today, but in the last few trading sessions as well. And it surged over 4% over several heavyweight names, bouncing nearly at their 52-week from their 52-week low. Rima is here to tell us what's driving this recovery for the IT pack. Rima.
Well, a couple of factors driving the up move today, but largely it seems to be global rotation. Money globally is moving back into software names because the results of many of these SaaS companies were strong. Some of them upped the guidance. So basically that fear of a breakdown in business, the SaaS apocalypse for now, seems to be on the back burner. Not to forget, the INR is still weak, and that's a direct earnings tailwind, and then the valuations. The sector was beaten down hard, and relatively it was much cheaper. So across yesterday and today, TCS, for instance, up 8%, Infosys up 9%. But to put it in context, year to date, these stocks are still down 20 to 25%. So basically what we're seeing is a bounce and not perhaps a big recovery. Also, what's actually stark in the data is that, remember, most of these IT companies hit their lows, 52-week lows, in March of 2026. And since what stands out is the mid-cap recovery. So large caps have also moved smartly. So TCS has recovered 10% from 52-week low, and Infosys up 16%. But look at that mid-cap recovery from lows, 52-week lows. We're talking about 30, 65% from their March low. So the divergence is very stark. Some numbers: Oracle Financial Services, 66%, Coforge, 50%, Tata Tech, 45%, Hexaware, First Source, all have moved up nearly 30% from their recent lows. So what's the key takeaway? IT for now seems to be providing leadership, but it's coming in on a very low base. Globally, there is that rotation taking place, and mid-caps are recovering faster. Now, what to watch going ahead? Accenture reports numbers on 18th of June, so the guidance is going to be very crucial. But for now, let's see whether this rotation, this up move in IT has more legs to go.
Sudeep, Rima, thanks very much for joining in with that. Sudeep, quickly then, on the IT pack itself, the commentary we've heard from especially some of the large peers in the, at the close of the fourth quarter for the year ahead has not been particularly strong. Some of the, smaller IT companies, of course, has been better. But do you think, as Jay seemed to be referring, if I heard him right, that these AI worries, they seem to be a bit behind, at least for now. Are you of the view that we've seen the bottom as far as, the IT pack is concerned, or is there more pain ahead?
Well, I think I'll be, very cautious. I think the AI-related disruption is real, and it's probably we are seeing the beginning of it. There is a long way to go before we have, confidently say that we have seen what AI can do and can't do. So we have to be cautious. Also, I think, Indian IT companies will take time to adjust to this new AI-led and AI-related environment. Having said that, I think we have to also realize that both the leading AI players, whether it's OpenAI or Anthropic, they have launched their own services companies. So obviously there is a role for, SaaS, software as a service. So somebody needs to service the model. Somebody needs to implement the models which AI companies are releasing. And Indian IT companies can have a role there. But to adjust to that mode and to play that role effectively, I think it will take time. The nimble and more, more agile mid-tier IT companies and people and the companies who have already moving towards AI, like a Coforge or even Persistent or KPIT, they are better bets at this stage compared to the large IT companies. That would be my thesis. And at this stage, I will probably still recommend staying away from large cap IT companies.
staying away from large cap ITs. That's the word from Siddhi. But, Jay, what's your thought on the IT names? Would you stay away from large cap IT, look at mid and small cap? Technically, what is looking nice, right? Valuations aren't too expensive. Even if I look at a large cap name, just the last week we've seen that run up coming in. Your thoughts on the technicals?
Yeah, hi, Vinny. See, like I mentioned a few weeks ago, or a few months ago, actually, I said that the rally will first come on to the Nifty IT large cap names, but it will be led by the mid cap names. But it seems to be doing slightly differently. The small caps and the mid caps are going off the block straight away, and they are outperforming the large cap names. But a little bit of wait and watch is required for the large cap IT names. But I'm very bullish on Infosys and Wipro, waiting for confirmation to come through. Once Wipro closes about 213, it'll confirm a double bottom in place, and I'm anticipating it to rally much higher. And the Nifty IT index itself, I'm anticipating it to rally to about 36,000, even if it's a corrective move. But looking at the US software sector, it's very probable that the Nifty IT could rally to fresh all-time highs. So let's watch for it. Let's not get too ahead of us. We'll take this as a short-term bounce. But as the markets provides more evidence, we can get more bullish on the markets. But yeah, it is looking very promising because it was already, we are anticipating the markets to bottom around the 27,000 to 26,000 mark. The markets have turned around from 27,035. So that's a very important support. And the short-term breakout of universe head and shoulders pattern, that's also reiterating the bull case for the Nifty IT sector. So, and we've seen the US software sector rally 46%. All this is signaling and providing more evidence that it is a bullish posture that we need to take for the IT sector.
All right, Jay and Sudeep, both of you, thanks very much for joining us here and helping us decode some of those moves. Now, moving on, shares of NMDC hit 52-week high after iron ore output increased by 20% in May when compared to the same period last year. The rally was also supported by strong production outlook and capex plans. Nigel D'Souza joins in now with the details on this one. Nigel.
Well, that's right. NMDC, the street seems to be looking ahead and they're ignoring the backdated data. The reason I say that is because they came out with the results a couple of days ago, and that was clearly a miss with regard to the operating profit as well as the margins. The problem was the smaller part of their business, which is the pellets business. It delivered an EBIT loss of close to around 100 crores. However, the reason I say the street is looking ahead is because in this quarter, that's quarter 1 FY27, they've already increased prices by around 500 or 600 rupees per ton. So that will reflect in the first quarter. Besides that, the management, on the con call, they guided that the volume should be at close to around 60 million tons in the coming year. That compares with around 50 million tons in the past year. So that's a big growth that they're guiding for. And by 2030, they're talking about around 100 million tons. Though they'll be incurring a big capex of around, close to around 5,000 crores in the coming year, 6,000 crores. And this will gradually increase over the next few years as they move towards 100 million tons or thereabouts. The near-term trigger ball, it didn't look too good. They came out with their operational update yesterday, and production number was up by close to 20%, which is good, but dispatches were down by 7%. The reason is Chhattisgarh did well, but Karnataka out there was a degrowth of close to around 700,000 tons. The problem I understand is that the vendor change over there is a bit of change on the administrative front. So the street is viewing it as a one-off, and things will recover in the coming months itself. Brokerages, well, you are split down the middle. Nuvama, they have a hold rating. Target price, they have up to around 100 rupees, and they're up their EBITDA estimates as well, factoring in higher volumes and prices. While Citi maintains their sell call with a target price of around 85 rupees. They highlight that Lloyd's Metal as well is ramping up capacity from around 10 million tons. Now they have permission to mine close to around 25 million tons, which will result in additional supply into the market. So that's about NMDC for the time being. Street looking ahead. Back to you guys.
Thank you so much for that, Nigel. And NMDC managed to close with good gains in the trading session as well. But a stock that was not doing well and was under pressure today is Force Motors. Why? They came out with their May print and May auto sales numbers, weak sales that came in over here. Domestic sales came in at around 18-month low as well. Stock closed with cuts of around 5% that we could say. Sudarshan is here to take us through those details. Sudarshan.
So it looks like the company did not get the needed force in the month of May, and in resultant, the stock fell and closed with a cut of more than 5%. Remember, yesterday the numbers of Ashok Leyland and Tata Motors commercial vehicle had come, and numbers of both those companies were much below expectations. So we did expect Force Motors to report the numbers on a similar line, and that's exactly what happened. So numbers came, total sales have decreased or declined by 15%. Because of that, both these segments, you talk about domestic, there the decline was 15%. You talk about the exports, of which the contribution to total sales of exports is very negligible. But nevertheless, the decline there was 37%. And because of that, there is a sharp fall in the stock price. And also on the domestic front, the sales number of 2,560 units, it was the lowest levels or lowest number of units that company has sold that we have seen in last 18 months. So considering all the factors, we have seen a sharp fall in the stock price. We'll have to see how exactly the CV cycle pans out. But it seems that supply chain issue has impacted the CV sector the most amongst all the auto segments.
Okay, May saw the slowest sales in 18 months. So Darshan, thanks very much for joining in with that. And we have to slip into a short break on that note, but don't go anywhere. When we get back, we'll get you all of the top corporate voices to watch out for on the other side.
Welcome back to Markets Forward on CNBC TV 18. Now getting you some of the top corporate voices that we had through the day on the channel. First up is Maruti Suzuki, right? They tell CNBC TV 18 that export growth remains healthy despite disruptions linked to the West Asia crisis. The company expects FY27 exports to be broadly in line with FY26 levels. And on the domestic front, the management sees recent momentum in the entry-level segment continuing and says that the segment has undergone a structural shift in demand. That's an exclusive.
And Bajaj Auto says exports would have touched 2.5 lakh units in May if not for supply chain disruptions. The company expects export volumes to remain around the 2.5 lakh unit mark going forward. Now, while domestic growth has moderated sharply from March levels, the management is confident of maintaining its margin outlook.
We also had the management of Wockhardt because they expect to launch the Xenic in US within 4 to 6 months. Speaking to CNBC TV 18, the management said that Xenic opportunity is around $1 to $2 billion globally, with US contributing nearly 40 to 45%. And the company added that Xenic remains protected by patent until 2038, providing a long-term growth runway.
And finally, we had Blue Star's management telling us that primary sales have grown to 30% in terms of value and up to 25% in terms of volume in April and May. The company said another 10% hike may be needed to offset the rising costs, but cautioned that fully passing on the increase could impact demand as well.
Those were the top corporate voices that we had today. But with that, we're absolutely out of time on this edition of Markets Forward. Thank you so much for tuning in. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines you're tracking. Attacks continue in Lebanon despite US President Donald Trump's claim that Israel and Hezbollah have agreed to stop all shooting. Iran threatens to halt negotiations and close the Strait of Hormuz if Israel continues to strike Lebanon. President Trump tells CNBC he does not care if Iran pulls out of negotiations.
It will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process.
International Energy Agency head Fatih Birol warns the oil market could enter a red zone if the Hormuz Strait doesn't reopen by June, adds that oil markets will continue to be rocky and volatile even after the war ends. When asked if the IEA was considering releasing another tranche of emergency release, the IEA said not there yet. Sensex and Nifty snap a 4-day losing streak. Nifty moves back above 23,500. Mid-caps underperform. Rupee weakens over 27 paisa against the dollar and remains above the 95 mark. India seeks competitive advantage over Asian peers amid trade negotiations with the US. Government sources say negotiations will focus on getting relief on new tariffs under Section 301, which are expected to be announced by the end of July. Tata Trust Chairman Noel Tata questions the 7,000 crore funding proposal for Tata Digital businesses during the May 26 board meeting, raises concerns about the growth outlook for the company. Noel's daughter Maya may exit Tata Digital and head to Trent. Kumar Mangalam Birla is on the prowl. Aditya Birla Group emerges as the likely frontrunner to acquire Shell's India renewable unit, Spring Energy. Sources say the deal is likely to be valued around $1.7 billion. That's a money control exclusive. Enforcement Directorate searches the premises of Anil Agarwal's Vedanta Group in Mumbai and Delhi. Searches relate to alleged foreign exchange law violations over royalty payments to parent Vedanta Resources. The company says it's extending full cooperation to authorities. Anthropic files papers confidentially to go public in what promises to be a blockbuster year for IPOs on Wall Street. The company was recently valued at $965 billion. Elon Musk's SpaceX has already filed for an IPO, and Sam Altman's OpenAI is expected to follow suit. At least 16 people have been killed in Russian missile and drone attacks across Ukrainian cities. 2 children are among those killed in one of Moscow's largest assaults in recent months. CBSE student Sarthak Siddhant, who flagged alleged irregularities in the tender process for the new on-screen marking system, appears before a parliamentary panel. National Students' Union moves Delhi High Court seeking an investigation into lapses by the CBSE. All right, the top story that we are tracking is the West Asia update. Attacks in Lebanon continue despite Trump's claim that both Israel and Hezbollah promised to cease hostilities as Iran stops exchanging messages with Washington. Here are the latest developments. At least 4 people have been reportedly killed in Israeli Army's latest attacks in southern Lebanon. The president of US, Donald Trump, said that Israeli Prime Minister Benjamin Netanyahu agreed to pull back any troops preparing to attack Beirut. He added that Hezbollah, through intermediaries, had pledged not to attack Israel. Talks between Israel and Lebanon are scheduled for Tuesday and Wednesday in Washington, D.C. Meanwhile, Iranian media has said that Tehran has not yet responded to a proposed framework agreement from the U.S. Discussions on the final are underway. The text is underway. Iranian officials are reportedly reviewing the proposal cautiously because of what they see as a history of the U.S. of not honoring agreements. This comes amid reports that Iran has stopped exchanging messages with Washington and threatened to close the Strait of Hormuz, a claim that Trump has since refuted. The US president's claim that talks are still underway helped crude prices cool off. The president made the claim on social media soon after telling CNBC's Iman Javers in a phone interview that he doesn't care if talks with Iran are over. But tensions remain high in the Strait of Hormuz. The IRGC claimed responsibility for what it described as a retaliatory strike on a vessel near Iraq. The Panama-flagged vessel was hit yesterday while transiting waters near Iraq's main port. All right, so that was as far as the West Asia tensions are concerned. Now, International Energy Agency head Fatih Birol has warned that the oil market could enter a red zone if the Strait of Hormuz does not open unconditionally by June. In an exclusive conversation with Shireen Bhan, Birol said that oil markets will continue to be rocky and volatile even after the war ends. When asked if the IEA was considering releasing another tranche of emergency release, he said, not there yet.
I think it is rather naive to expect that the Qatar LNG terminals will go back very quickly where they were just before the war. So if it is, to sum up, if the Hormuz Strait is open, if there is a peace, it is an agreement, it will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process, volatile markets for some time to come. This 400 million barrels is big, but it is only 20% of the reserves we have. 80% is still in the pocket. And we will see, we will assess the market conditions, and if we think it is necessary, we will be ready to act immediately. Now, I don't think that we are at this stage yet, but we are monitoring the markets momentarily and very closely. If we believe it is the time, we will definitely go for it. But at the moment, we are not there. If we are not able to see fully an unconditional open of Strait of Hormuz by end of June, July and August, the travel season around the world in many countries are starting. The flights and the cars and the buses, we may be entering the red zone for the global economy, especially those in Asia.
Right, let's talk about the markets now. The Wall Street snapped its four-day losing streak with the Sensex and Nifty recovering nearly 1% from the day's lows. The Nifty closed near the 23,500 mark, supported by strength in banking and IT stocks. The IT index extended its winning run to a third straight session, with every constituent ending in the green. Broader markets underperformed the benchmarks but still managed to close with modest gains. Nigel D'Souza is here with the day's market action. Nigel, please take us through the big intraday recovery.
Well, today was an interesting trading session. A little bit for the bears, but a lot for the bulls. Because the bears, they managed to protect the higher levels. However, the bulls fought back. And today, the reason for the fight back was we saw a very sharp drawdown in the last few trading sessions. And there were a couple of technical indicators, like the FI shots in the system, as well as the PCR. Both of them went to extreme levels. But the index that really led the way today was the tech index. That was rock solid in today's trading session, putting on massive weight. Well, SaaS companies globally have done well. There's been a stark underperformance from the tech companies here in India, and valuations are relatively better. That's why from the recent low, you've seen close to around 8 to around 10% increase on the IT index itself. And TCS, Infosys, HCLTech, as well as Tech Mahindra, all of them were the top gainers from the Nifty pack itself. On the flip side, NTPC, Dr. Reddy's, Axis Bank, all of them did come in for some profit taking from the Nifty pack itself. Well, there were some big outperformers in the last few trading sessions that actually, they came in for some profit taking. You had Force Motors. Remember, the stock has moved one way, but the main update was a little bit disappointing, so that came in for some profit taking. And BSE, what a stock that's been, a wonder stock of the last few years. But in today's trading session, some money was taken off the table. I'll tell you what, the fundraising is live and kicking. Today, we had quite a few companies that came in there and they raised some money, whether it was NTPC, where they launched their OFS and it got lapped up. Alchem, well, reports indicate that the promoter entity sold some stake. Acme Solar, well, close to around 2,500 crores of QIP is what they launched, as is the case with Olar as well. So a lot of fundraising was announced over the last 24 hours or so. Well, in terms of the Nifty, it faces resistance at around 23,800. The bulls will fancy their chances of getting past that if geopolitical tensions cool off and crude as well as rupee remains well behaved. But for today, the bulls will be happy to see a good green day, a relief rally, so to call it.
Right, thank you, Nigel, for that. Moving on, a strong rally led by artificial intelligence stocks helped South Korea overtake India to become the world's 6th largest equity market. The combined value of South Korean listed companies has climbed to about $5 trillion. Two companies, Samsung Electronics and SK Hynix, account for over 50% of the South Korean equity market's valuation. Now, Blackstone has raised $13.1 billion for its largest ever Asia-focused private equity fund, more than double the size of its previous fund for the region. The firm has deployed over $7 billion across 12 deals in Asia over the past 24 months and continues to strengthen its presence in key markets, including India. Now, Blackstone has also benefited from improving public market conditions, completing 15 exits across the region as capital markets activity picked up. Now, India is seeking competitive advantage over Asian peers amid trade negotiations with the US. Now, government sources tell CNBC TV 18 that negotiations will focus on getting relief on new tariffs under Section 301, which are expected to be announced by the end of July. Abhimanyu Sharma has more. Abhimanyu.
Preferential market access for Indian products into the American market and relief from Section 301 probes are likely to remain the focus of the Indian negotiating team in talks with their American counterparts who are currently in India for negotiations with the Indian trade delegation. It remains to be seen how early both the sides are going to conclude negotiations for an interim trade deal. Last week, US Ambassador to India had indicated that only 1% of talks were left for an interim trade deal between both the sides. Yesterday, Commerce and Industry Minister Piyush Goyal too had indicated that both the sides were already on the verge of finalizing an interim trade deal, and only a few commas and full stops were being taken care of as far as the current talks are concerned. Now, earlier this year, the Indian trade delegation had visited the United States in April, where they spoke to their American counterparts, which was preceded by the joint statement released by both the sides on 7th of February 2026. Now, the joint statement had indicated that India and the US had agreed on a framework for an interim agreement on reciprocal and mutually beneficial trade. The framework had also reaffirmed a commitment to broader India-US bilateral trade agreement negotiations. Now, in the current spate of talks, several issues like market access, investment promotion, economic security alignment, tariff measures, and customs and trade facilitation are likely to be discussed. All eyes, of course, would be on how early both the sides are going to finalize the interim trade agreement.
Right, thank you for that, Abhimanyu. And while we are on the issue of trade with the US, Venezuela's acting president, Delcy Rodriguez, will visit India tomorrow. A meeting with Prime Minister Modi is on the cards on that front. Now, US President Donald Trump has signed a proclamation amending national security tariffs on some aluminum, steel and copper imports to 15% from 25% previously. The proclamation also lowers tariffs on certain types of agricultural machinery and residential heating, air conditioning and ventilation equipment. The order also allows foreign companies to qualify for 10% tariff if their capital equipment includes at least 85% US steel or aluminum by weight. The UK Business and Trade Secretary Peter Kyle met Commerce Minister Piyush Goyal in New Delhi. Both the ministers are expected to discuss the implementation of the free trade agreement between India and the UK. Both sides are also expected to address unresolved issues pertaining to the trade deal. The European Parliament panel has approved to remove import duties on many American goods. This approval has come 2 days before Trump's deadline to comply with the deal. Under the agreement signed last year, Washington committed to a 15% tariff cap on the most EU exports. The Trump administration sequentially expanded the list of products containing steel, aluminum and copper that are subject to higher tariffs. Now, Tata Trust Chairman Noel Tata questioned the 7,000 crore rupee funding proposal for loss-making Tata Digital during the board meeting last week. He also raised concerns over the firm's growth outlook. We learned from sources that Noel Tata's daughter Maya is also looking to exit Tata Digital and explore opportunities in other group companies. Hormaz Patakia joins us now. Hormaz, please take us through what you're picking up.
Some developments, a couple of them actually from the Tata Group. And the first one, of course, is this money control exclusive where Noel Tata has actually raised concerns with regards to growth at Tata Digital. And the management of Tata Sons during the board meet had sought an equity infusion of around 7,000 crore rupees into this digital consumers business. Now, that includes companies like Big Basket, Tata Click, and a lot of these consumer-facing digital companies as well. And the projections that they put out there, they show that these businesses could continue to report losses over the next 3 financial years, and those losses could amount to well over 9,000 crore rupees. And Noel Tata in that regard has raised questions with regards to the growth projections being used to justify the investment that was sought, and he believes that the group now has to review and prioritize their investments as per the growth outlook. Now, sources are telling all of this to Money Control, and they also went on to add that the concerns that were raised on funding into a business that is yet to demonstrate a clear path to profitability. And so that is what the sources are telling Money Control. And aside of that, the second development is that sources now that are telling CNBC TV 18 that Noel Tata's daughter, Maya Tata, is going to be exiting Tata Digital and will head to a role at their group company, which is Trent. So that's the second development that has come in. But some concerns being raised by Noel Tata. That's the Money Control exclusive, and a management reshuffle also in the offing, possibly at Trent. That is what sources are telling CNBC TV 18.
All right. Thank you, Harmas, for that. Former Tata Sons directors Ishat Hussain and R. Gopal Krishnan have made a strong case against taking the conglomerate's holding company public. In an article published in the Indian Express, the former directors argued that an IPO should be the decision of the company board. They contend that Tata Sons already behaves much like a listed company, maintaining governance standards comparable to those of listed entities. Now, shifting focus, Aditya Birla Group has likely emerged as the front-runner to acquire Shell PLC's Indian renewable energy platform, Spring Energy. Sources told Money Control that the deal has reached the final leg and Birla Group has the edge over other suitors, including KKR and Actis. Ashwin Mohan joins us now. Ashwin, what are your sources telling you?
This is by far one of the biggest ongoing deals in the super active renewable energy segment in India. What we are given to understand from our sources is that the Aditya Birla Group has in fact emerged as the likely frontrunner to acquire Spring Energy, Pune-based Spring Energy, which is the clean energy platform of British energy giant Shell PLC in India. Our sources are telling us that in the final leg, post the submission of the binding bids, the Birla Group has edged ahead of rival suitor private equity firm KKR. There were 2 other suitors, a consortium of Temasek and NIF and Actis. Valuation-wise, our sources are telling us that Spring Energy could be valued upwards of $1.7 billion. What's the rationale from the Birla Group's point of view? Well, Aditya Birla Renewables is the vertical that looks at this particular segment. It's housed under the listed parent Grasim Industries. It has ambitious expansion plans to increase its capacity upwards of 10 gigawatts in the coming years. Kumar Mangalam Birla is betting big on the renewable energy segment. He sees it as a big and important growth driver for the diversified conglomerate in the years to come. Also, don't forget that sometime back, we had BlackRock-backed GIP that had pumped in 3,000 crore rupees into Aditya Birla Renewables, valuing it around 14,600 crore rupees. In terms of official responses, Shell confirmed that they are indeed in talks with potential suitors, but said it's too early to comment on the outcome of the negotiations. Email queries to Birla Group and KKR remained unanswered. As far as the investment bank is concerned, it's Barclays that is advising on this big bang trade. Let's wait and watch to see how it progresses in the days to come, because remember, no final decision has been made as of now. Talks can still fall apart, but as of now, the Birla Group seems to have the edge. Back to you.
Right. Thank you, Ashwin, for that. Now, a beverage giant, Coca-Cola, is exploring a potential initial public offering in India for Hindustan Coca-Cola Holdings. HCCH is the parent company of the largest bottler in India. Coca-Cola has said it's preparing to list the bottling unit in 2027 and is exploring stake sale as well. It currently holds 60% in Hindustan Coca-Cola Holdings after Jubilant Bharatiya Group completed the purchase of 40% stake in the bottling company in 2025. Shares of Vedanta slipped over 4% in trade. This after the Enforcement Directorate conducted search operations in Vedanta's Mumbai and Delhi offices. Sources have said ED was conducting the raids as part of an investigation under the Foreign Exchange Management Act. Sources further highlighted that the operation was in relation to royalty payment by Vedanta to parent company. The company said that it's extending full support to the authorities and remains committed to compliance with all applicable laws and regulations. And time for a short break. Coming up next, Anthropic files papers confidentially to go public in what promises to be a blockbuster year for IPOs on Wall Street. That and much more when we return. Welcome back. Russia killed at least 18 people in major missile and drone attacks on Ukrainian cities, including Kiev. This comes after days of warnings that Moscow was planning a major attack. Russia's defense ministry said it struck Ukraine's defense industry facilities. President Zelensky said civilian infrastructure and energy facilities had been targeted across the country. AI major Anthropic has filed confidentially for an initial public offering as it aims to list as early as October this year. The company said that it has submitted a draft S1 registration to the US SEC for the proposed public listing. This comes after the company raised $65 billion last week, taking its valuation to nearly $1 trillion. Back home, Godrej Industries will enter the wealth management business under its financial services segment. With this, the group will expand beyond its existing lending operations housed under Godrej Financial Services. This comes days after the firm unveiled plans to raise up to 1,500 crore rupees via debt instruments. It also approved an investment of up to 1,000 crore rupees in its wholly owned subsidiary Godrej Investment.
You know, we're of course building this for the long term. So I think we're thinking about this business as a major part of our financial services portfolio, and our financial services portfolio is a major company within the Godrej Industries group. So we are thinking about it of creating value here for decades. That said, we would much rather be starting the business at a time where there is a little bit of uncertainty in the market, where valuations have corrected, because we do think it'll make early investing for our customers much easier and much more lucrative. I think, you know, of course, mindsets are that it's very challenging environment and that returns aren't being generated, but those are exactly the times when fear is at its most, that investment returns are typically the best. So we're ready to onboard customers already. We will, of course, scale it by geography. So we're immediately starting in 4 markets. From there, we will grow to 8 by the end of this calendar year. And we hope in the next 5 years to take that to about 35 to 50 cities within India that we're present in.
Right, let's talk about the big national story. CBSE student Sarthak Siddhant, who had flagged alleged irregularities in the tender process for the new on-screen marking system, appeared before a parliamentary panel today. More than 4 lakh Class 12 students have sought revaluation and the CBSE is facing a crisis of credibility. In a blog post, the student claimed the tender process was biased to allegedly favor Hyderabad-based company Crude EduTech. After reviewing the tender documents, the student claimed that rules barring blacklisted companies and many other rules were diluted. Both the CBSE and Crude EduTech have denied any wrongdoing. The National Students' Union of India has moved the Delhi High Court over the CBSE controversy. The Congress Party student wing is calling for an independent investigation into the lapses. It's also seeking physical verification of the disputed answer sheets. 18 lakh students appeared for the class 12th exams, and out of those, 4 lakh students have sought revaluation. All right, the Maharashtra government will provide a one-time waiver to ineligible women beneficiaries who wrongfully availed benefits under the Ladki Behan scheme. Now, Santya Gora brings us more details. Santya, please take us through the state government's plan.
So Maharashtra's Chief Minister Devendra Fadnavis has announced a one-time waiver for women who were found ineligible but received benefits under the state's flagship scheme Ladki Behan Yojana, a decision that puts nearly 4,500 crore to 5,000 crore rupees of public money at stake. According to Maharashtra Women and Child Development Department sources, around 2.46 crore beneficiaries were initially registered under the scheme. However, only 1.66 crore women received the last 2 installments, leaving around 80 lakh beneficiaries without payment. WCD sources told CNBC TV 18 that out of these, 25 to 30 lakh beneficiaries have been removed after being found ineligible. This includes income tax payers, four-wheeler owners, 2,300 government employees, beneficiaries of other government schemes, and even 14,000 men who fraudulently enrolled under the program. Speaking at a media conclave on Monday, Devendra Fadnavis said the scheme was launched on a self-certification model and that beneficiary verification began later. He confirmed that money would be recovered from the 14,000 men who enrolled fraudulently. However, the government does not plan to recover payments made to the 25 to 30 lakh ineligible women beneficiaries, a number that could rise further. Fadnavis said a one-time waiver would be provided to these women. So at 1,500 rupees per month, these beneficiaries received payments for over a year and many for even longer, translating into an estimated amount of at least 4,500 crore to 5,000 crore rupees. This amount, based on the Chief Minister's statement, will now effectively be written off. Meanwhile, another 50 to 55 lakh beneficiaries have their payments on hold after failing to complete the mandatory eKYC process. The Chief Minister has indicated that the government may consider reopening the eKYC window for eligible women who missed the deadline for genuine reasons.
All right, thank you, Santya, for that update. And with that, it's a wrap on this edition of Business 360. News and updates continue right here.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, the India Meteorological Department has revised its 2026 monsoon forecast downward to 90% of the long period average. It has also indicated an 84% probability of a below normal or deficient rainfall across the country. If the forecast holds, India could be looking at its driest monsoon in 11 years. The country is already witnessing a delayed onset of the southwest monsoon. The IMD had earlier projected the monsoon to reach Kerala on May 26th. But it is now expected that the onset over the parts of Kerala and Tamil Nadu around June 4th is what you could be looking at. The IMD has also warned that El Nino conditions are likely to develop during the monsoon season and could intensify in the second half of this season, raising concerns over agricultural output. A weak monsoon can hurt Kharif sowing, deplete groundwater levels and reservoirs, and force changes in the cropping patterns. That in turn could impact the Rabi season as well. The government says it has already put measures in place to safeguard the upcoming Kharif season. Officials say that the Agriculture Ministry has set up crop monitoring and crisis management teams, while states have been asked to maintain adequate seed reserves and prepare contingency plans to minimize any impact on farm output. Joining us now to discuss this and more is Rajesh Paharia. He's Chief Manager Business Development at Cribco Agribusiness. Sandeep Bajoria is CEO Sunwin Group, and Somnath Chatterjee is Head of Procurement at ITC. Gentlemen, hi, thank you so much for joining in. This is a year that has started on a difficult note and perhaps continues to be so. We have been facing the West Asia conflict, and now it's about monsoon, El Nino. So agriculture as a commodity or as a segment clearly seems to be taking it on the chin there. Ms. Chatterjee, this one is to you, and I'll of course talk about Kharif crops as well, but the markets do believe that the weak monsoon could have a rippling effect on the Kharif as well, on Rabi as well rather. How are you looking at, or are you concerned, or is it still early days when it comes to monsoons?
Good afternoon, Manisha ji, and indeed, we have cause for concern. In fact, my team and I, we were researching El Ninos, and the last one we had was 2023-24, which was not so bad. The super El Nino phenomena last happened in 2015-16, which was concerning because the WPI index shot up by 11.2% in that year. So we were researching, we went back a little bit, and what we found was that El Nino of this magnitude, which is expected in 2026, this year, was last probably seen in the year 1876, 1877. And that killed 50 to 60 million people, probably more than all the wars have killed in human history. And at that point in time, the temperature difference on the top of the Pacific Ocean was, it had increased by 2 degrees. At the moment, we are sitting at 1.1 degrees. So you may ask me that why the worry? It's still less than that. But ma'am, there is this huge body of water which is coming southwards, and that at a 50-meter depth seems to have a temperature which is 6 degrees higher than normal. I repeat, 6 degrees. And we have not yet entered official El Nino territory yet. It's going to be another few weeks. So at the peak of the 2026 El Nino, it is quite likely that that 2.8 threshold of 1876 is broken. And if that is so, then today, we have a reason to be a little worried. However, last 2 to 3 monsoons have blessed India. We are currently blessed with abundant food stocks in terms of rice and wheat. Pulses also okay. So in the short to medium term, we have nothing to worry about.
Okay.
But yes, should this monsoon fail, and we are seeing early signs of that. Initial prediction by the Met Office was that it will be early onset of monsoon. It will hit Kerala by 26th of June. And today they have released a new statement saying that it's going to be probably 5th or 6th of July. So we already see the initial impacts. If this hits us badly, then I'm worried about the reservoir levels. And please, we must remember that Rabi, which is the winter crop, is 55 to 57% irrigated in India. So if our reservoir and dam levels are low, then yes, the next Rabi crop is something which we need to watch out for.
Oh, absolutely. And the irrigation doesn't come free, does it? It consumes diesel, and the way we've seen price hikes in sense of fuel is an added input cost there as well. Mr. Paharia, how would you look at this? Because from 108% of rainfall in the last year to 90% this year, and we've seen a downward revision come in as well. Are you concerned? I mean, you look at rice more closely, and are you looking at that as a concerning factor? Clearly, the IMD also has said that when it comes to overall monsoon, northeast and perhaps some parts of Konkan, Goa is where you're looking at better monsoon, and both of these areas are clearly not rice growing areas.
Absolutely. Thank you, Manisha ji. What Mr. Chatterjee also has stated, that this is going to be the second worst El Nino effect which we all are going to face. And apart from that, the geopolitical situation, which has been another, you can say, bitterness, which is increasing the prices of the other raw materials of fertilizer and everything. So that is also going to be affecting our entire next crop. Rice is a major concern, where we are seeing that the crop, the monsoon, where we are expecting that it will be more than the normal or it will be normal, there we are not growing rice. The eastern part of India, where we are growing more of rice, like Andhra, Telangana, Chhattisgarh, and West Bengal and Odisha, there we are expecting that there can be a threshold of almost 15 to 20% in the cropping size. Absolutely, it's a miracle for us also. It's a blessing in disguise. The stocks which we are carrying forward for with FCI, those stocks are ample enough to feed for next 2 to 3 years. But any downfall, we will be losing our international market in the for the rice and other things. So it is going to be a very major effect. In case if we miss any kind of numbers, we'll be losing the global share, which is almost equal to the 46%. We might go down to any levels.
So there are concerns not just in Kharif but in Rabi as well. The yields are an issue this time around. Heat waves have been longer. We're looking at lower monsoon, and then of course it's an El Nino year. The second half of monsoon is expected to be on the weaker side in any case. Mr. Bajoria, that's about grains, but when it comes to edible oils, we import 60% of our requirement. Even as the origin countries have enough and more oil, it really has been about depreciating rupee as well. So inflation is something that seems to be supporting edible oil prices much higher, top on the charts, by the way.
Good afternoon, Manisha and the viewers. My friends Somnath Chatterjee and Rajesh Paharia here in the panel. You put a very strong panel today. And I must tell you this vegetable oil situation, as you know, we have 26.5 million ton consumption in the country, and 16.5 million is imported and only 10 million is locally produced. So with this kind of a super El Nino, which is coming in now, I believe the 10 million production of veg oil, which is from India, can come down to something around 8.5 million. So we will have a shortfall in domestic production of 1.5 million tons, and that is quite a high shortfall. And if we go to world markets to buy this quantity, the world markets will catch fire. So that's the biggest concern right now. And howsoever, I can tell you there is enough oil in the world. So it's not a problem that if we go to the world market and we will not get the oil. It's only the price which we'll have to pay through. That is going to be the important thing. And as we have seen, the rupee is depreciated to level of 95 to 97. And so this has called the consumer prices going high. Alone by rupee depreciation, the prices have gone high by 7-8%. And because of the crude prices going so high world over, and many of the origins countries are putting veg oil into biodiesel more and more, like America is doing, Brazil is doing, Indonesia is now going to B50 from 1st July. So I think all these things are also putting prices upwards. So we have seen this, and these are the reasons consumers have to pay higher price. But it's okay now. Once in a while, these prices are what they are. Freights are also higher. But anyhow, we have to be mainly concerned about crops and agri production. This is our main concern. We are in this business. But with this kind of El Nino, with kind of heat, temperatures going high, 45, 50, 52 degrees, availability of water coming down, this is a human problem as well. So we have to think from that point, as Mr. Chatterjee already said, that this can be a really dangerous thing. I'm not getting, right now, I don't dare to think too much into what Chatterjee said because it's very scary.
It
But
is.
anyway,
And-
yeah,
And the kind of numbers
Yes.
that we are showing also tells you that the major growing areas is where the concern is, because Northwest is going to get 92% of a rainfall, which is below normal. And when you look at central India, southern peninsula is looking at 94%. Again, just about normal monsoon there. But what months do you get it? And if there's an El Nino that comes in on July, August, September kind of months, then we are looking at less rainfall during the most critical period there as well. But it's not just agriculture that the El Nino or below normal monsoons impacts. Ms. Chatterjee, it does impact labor, as Mr. Bajoria pointed out. It also impacts rural income and rural buying as well, something that most of the FMCG companies anyways has been dealing with in sense of lower demand for the last couple of years. Does that year make that problem more difficult?
Yes, indeed, Manisha ji. In fact, the government has been doing an excellent job in procurement of wheat, rice, pulses, particularly chana, oil seeds. So they didn't have to intervene too much because soybean went up way beyond MSP. But having said that, so on the one hand, government's intervention has ensured our food security as a country. Also, it has channeled a lot of money into the rural hands, and that has led to the resurgent rural demand. In fact, over the last 18 months or 2 years almost, we've seen that as a trend, rural has been stronger for FMCG than urban. Okay. So this was the happy scenario which we were presented with for the last 2-3 years. However, should this El Nino be really as bad as anticipated, then we have a problem going forward in terms of rural, in terms of yields, and therefore in terms of rural income and demand. Incidentally, so far only typhoons, etc., had been used to be given names. Interestingly, this El Nino 2026 has been given a name, and it's called the Kraken. It's a mythological creature of the sea which swallows up entire ships. So yeah, we are looking forward to the, not looking forward rather, to the Kraken El Nino and resultant demand destruction.
Oh, well, absolutely. This year hasn't started well, as I said earlier, and the way it seems to be going, especially for India, where monsoons is a very critical period, those 4 months. If it indeed is 90% that is deficient or a drought of a year, it would make things quite difficult going forward. But gentlemen, stay on with us. We have to take a very short break. When we come back, we'll of course talk about the lower monsoon impact on GDP, inflation, and if there's a rate hike, what does that mean for agriculture after this break? Welcome back. You're watching Commodity Champions, and we have an eye on the sky, which is a bit concerning this year around, with expectation from IMD that the monsoon is going to be in just about 90% of long period average. Mr. Padia, Mr. Chatterjee was making a point before we went for a break, and that was that there is support from the government. There is money in the rural hands. This year, of course, could be slightly different. But the concern about inflation still stands tall, because we're looking at higher petrol, diesel prices, and the imported commodities, especially the exports, have been facing a bit of a concern as well. How are you looking at this year going forward from here? How much are you prepared?
Manisha ji, as last time also when I told you, like apart from the El Nino, most of the agriculture things are also dependent on the imported items, which is majorly a fertilizer, diesel and everything. So the effect will be there when the prices of the fertilizers, which has gone upside, soon almost 50 to 60% high. And that is a major input also. For rice, which is going to be a major commodity for the coming season, wherein we will be facing difficulty in the numbers. But fortunately, as I stated earlier also, that we have a good handsome amount of quantity in the central pool. So inflation will not be an issue with regard to the wheat and rice. The prices will be within the limit. Government has to absorb a lot of cost, which they will have to do in order to control the inflation. But the external forces, the raw materials like diesel, oil, and the fertilizers, they are going to be a breakthrough for that. So they are going to affect, and this will be giving them a hike in the inflation. But concerning to the non-basmati rice, and even for the wheat also, which is a major stocks lying with the FCI, they are not going to allow to get the inflation to those levels which other commodities has been.
Mr. Padia, I mean, this is a question I want to ask each one of you on. How are you looking at this year in sense of trade, in sense of agriculture, and in sense of global business as well? What are you prepared for?
I think Sandeep sir should take it forward first.
Okay, Mr. Bajoria, to you then.
Okay, I believe, physically crude oil prices are going to remain very high. This war situation, whatever statements come and go, but it is not going to cool off very easily till the end of 26. That we have to be ready mentally. And inflation in such a situation when your main agri commodities are going to be producing less, we are lucky that wheat and rice, as Rajesh Bhai said, is enough with the government. So government might try to push it out at a reasonable levels.
Okay.
But other commodities, no control. Definitely they will go higher. Prices will go higher, and that will have to bear the brunt. And I believe in such a year, it's quite natural that you have to face the inflation. And but at the same time, because rural demand is going to get affected, farmer is also consumer, so that consumption also will be a little lower. So that somehow the situation will take care. As far as international trade is concerned, I said that Strait of Hormuz is mainly the fertilizer, gas, and crude oil, petroleum oil. But other products are not traveling through, coming through those. They are coming through other channels and other sea routes. So availability of those is not a problem. There is enough things are available in the world, and we can get veg oil also. As I said, enough is there. Soybean biggest crop is there, 194 million tons in Brazil, 50 million tons in Argentina. So I just met one of the world head of the biggest oilseed processor in the world right now today over lunch, and he was telling me there is enough soybean oil they can give. So even if because of El Nino in Indonesia, the palm production falls by 2 million ton as their association had said. So that much more we can get soybean oil from South America and other destinations. So what Manisha, one thing is very interesting is if Indonesia goes with B50 and Indonesia also has lesser production, it can just happen like that, our imports of palm oil can come down to 7.5 million and our imports of soybean oil can go up from 5.5 million to 7 million tons.
Okay.
And sunflower oil can remain about 3.5 million tons. So this is going to be a very interesting change in the with the various edible oils.
Mr. Bajoria, are you at all concerned that the government could come out with measures when it comes to edible oil as a sector, or is that something that the industry is discarding right now?
No, as far as measures are concerned, you see in this situation, in this scenario, government, I believe they have long-term measures to increase productivity. They've initiated a lot of plans for that, oilseed mission and all that, palm mission and all that. But in short term, I don't think so they have any measures or anything in their hand as buffer stocks in wheat and rice. So it's all game of international market, and we have to play the international market accordingly. And let the trade and industry, whatever is needed in the country, let them import quietly, process and give it to consumer every corner of the country. I believe if in oilseed and oil sector, the lesser government intervention, the supply chain can be maintained better.
All right.
If there is a government intervention comes in this, then I think supply chain can disturb and it can have different effects.
All right.
So I think most efficiently let trade and industry handle this situation.
All right. So measures is something that you don't see forthcoming and wouldn't want as well. Ms. Chatterjee, you head procurement for ITC, and it's not just about wheat. We keep talking to you more about wheat, but there are various other commodities as well. How are you readying yourself for strategizing this year, given the fact that there's just so much to deal with?
So, ma'am, 2-3 years back during COVID, we used to use a word called VUCA quite a lot. Okay, we used to use the word VUCA, which is volatility, uncertainty, ambiguity, and chaos. But now we've stopped using that. We use something called perma crisis. So we seem to be going from one crisis to the other. Am I audible?
Yes, you are. We can hear you.
Yeah, all right. So we seem to be going from one crisis to the other. For a procurement manager like me, it's not only about the cereals or the oil, like Sandeep ji said. It's also about other petrochemicals. And here, we've enough said about diesel and the escalating cost of fuel. We are also concerned with petrochemicals with which we make our packaging. For instance, the cost of polymer has gone up, and there is a real crisis there, because that is made with ethane gas. And there we know the Gulf of Hormuz crisis, West Asia crisis has caused a shortage. Prices have shot up quite significantly. Prices of solvents, inks, adhesives, all of these are high. Coming back to agri, we get sleepless nights thinking about what is going to happen to the dairy sector, for instance. Now, this kind of high temperatures and lack of water is going to impact that. There are going to be so many other fruits and vegetables, etc., which we procure, which are going to get impacted. So yeah, we have to keep, we have many balls up in the air, and we have to do the juggling act regularly. But I'm sure with our capable team and with the help of AI now, we will be able to manage. We don't have a choice. We live in perma crisis, as I said.
Perma crisis it is. Mr. Faria, final word from you, and both the other gentlemen have spoken now. So what is the strategy for this year? As Ms. Chatterjee said, it is about dairy, horticulture, packaging, you name it, and there's a concern in that sector. How are you readying yourself?
Absolutely, absolutely. I cannot disagree with both the gentlemen. They are guide and mentor to the whole trade, and I've been learning a lot from all of them. It is real unfortunate that even a small thing like a packing material, which we used to procure, say 22 rupees or 20 rupees a 50 kilo bag, now we are paying almost 30-35 rupees. So that is a smallest hike in any of the prices. Apart from that, the global trade is also being affected, because maybe the weaker rupee is giving exporters a little bit benefit. But in the importing side, like African countries, they are facing a crisis of buying Forex to make the remittances. They are offering that you take the money in CFA or maybe in their local currency. But what we will do with that money? So that particular disbalancing of the financials also are getting affected. So a lot of things are chasing around and we are running into the odd side of the subject. The boxes are arriving, the diesels are not being fed to the local transport companies at the destination. They are facing the diesel shortages. So the movement of the cargo from the port to their warehouses also is getting affected. In bottom line, we have to play safe. This is a year of crisis, and I'm 100% sure that we will always have been facing all these kind of situation, not in that kind of a degree, but maybe with a little stronger degree we are facing this, but we have to work out together. And as Chatterjee sir and Sandeep sir has said, we have to work out with all the options in the odds so that we can overcome this situation.
All right. Ms. Chatterjee has put out a new word as well, perma-crisis, and that's exactly what we seem to be dealing with. And in the conversation with all three of you, one thing is very clear, right? From the input cost to the final commodity or the final product, that is, there are various issues that the street seems to be having at this point in time. But as you said, there's no choice really as we go ahead from that on how much does government do in sense of subsidies, help, and how the monsoon actually is something that we will, of course, be watching out for. But as always, thank you so much for joining in. Thank you for making sense of the kind of concern that is and how the industry really seems to be dealing with that. But with that, it's a wrap on this segment of Commodity Champions. Thank you for watching.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, India and the United States are expected to soon finalize the first tranche of a bilateral trade agreement. President Donald Trump has sent a team to India for trade talks beginning today. The American delegation is being led by Chief Negotiator and Assistant U.S. Trade Representative for South and Central Asia, that's Brendan Lynch, while the Indian side is being led by Darpan Jain, Additional Secretary in the Department of Commerce. Now, yesterday, Minister Piyush Goyal said that most elements of the first phase have been finalized and that only small issues, commas and full stops remain to be ironed out. Last week, the U.S. Ambassador to India, Sergio Gore, said that both sides are working to finalize the last 1% of this agreement. He also said that an Indian delegation visited the U.S. in May and that India and the U.S. had reached an initial understanding in February. But the trajectory of these talks shifted after the U.S. Supreme Court ruled against certain tariffs. Government sources say that tariffs levied under Section 301 may be discussed this week, with India likely to seek relief from actions taken under the provision. Section 301 gives the United States broad authority to investigate foreign trade practices and impose retaliatory measures without waiting for formal adjudication. And well, joining us now to discuss this is with us Ajay Dua, former Commerce Secretary. Also with us is KP Fabian, former diplomat. Both the gentlemen, thank you so much for joining us. Mr. Dua, coming to you first. Now, the fact that they've been building, the momentum has been building from both sides, India and the US, towards a trade deal is well known. However, last week was the first time we saw Sergio Gore, the US ambassador, say that only the last 1% remains. This, of course, comes on the back of a lot of pleasantries that were exchanged between India and the US during Marco Rubio's visit. How are you seeing this? Is this a sign of perhaps urgency being shown by the United States?
Thank you for having me in this discussion, Ashwin. I think it is, the US seems to be now more keen than ever before to be able to enter into a trade deal with India. The fact of the matter is, what was announced in February, what you refer to, there was a framework agreement, and it was probably made quite obvious in that itself that the agreement is going to be signed in two tranches. It's the first tranche about which Sergio Gore talked about and which the Commerce Minister also referred to, saying we are more or less ready to kind of finalize it. But still, if you would recall, the Sergio Gore had said that it will take a few weeks, if not months, to sign the agreement. And that's being kind of contexted in the context of the American Supreme Court and the other courts' decisions to rein in President Trump's powers to levy tariffs. So I'm willing to grant that the delay is on that account, but at the same time, the 1% issue which remains could also be substantive.
Right. Mr. Fabian, coming to you, same question. Marco Rubio visited India recently. Sergio Gore hosted a dinner at the US Embassy where he dialed President Donald Trump, who was put on speakerphone. And he had a lot of pleasant things to say about India, about his partnership with Modi, about how they're great friends. Also going on to say that as far as India is concerned, it can always count 100% on the United States, on the US president. Does this indicate to you some urgency being shown by the United States?
Thank you. Good afternoon to both of you. I was listening very carefully to my good friend, Secretary Ajay Dua, and I do agree with him. Now, it's like this. Let us get the facts right. President Donald Trump committed an economic aggression on India by imposing tariffs on India as part of the tariffs he imposed on the rest of the world, and later an additional 25% for buying oil from Russia, which India was not the only one buying. Okay, so there was an economic attack. And then what happened? India slowly, I repeat the word slowly, started looking at other options. Instead of putting most of your eggs in one basket called the United States, India started looking at other baskets, and India has had some success, EU, UK, New Zealand, and others. Now, it seems President Trump has realized that he did make an error in committing that aggression on India. So they want to sort of, have a deal. But I should share with you the speculation in Delhi and the fear entertained by some of us that Ambassador Gore has been working very industriously for, compelling us to agree to some of the terms which they wanted, whether it is agricultural goods or other goods, and all that, and also investment by India. So I have to see the actual text before I make any comment. But it is my belief that Indian diplomacy can navigate these difficult waters and arrive safely at the port.
Well, it's arriving safely at port. Speaking about that, let's also talk about the elephant in the room, Section 301. Mr. Dua, let me come to you. This is, again, a question that many experts have been asking. What's to protect India from signing a deal and then being subjected to 301 tariffs even after signing a trade agreement?
You're absolutely right on that. Because 301 gives the United States administration powers under the 1974 Trade Act of the United States to investigate alleged kind of concerted efforts, conscious efforts made by countries to promote their exports. In the case of India and 60 other countries, right now the investigations which are going on are not just against India, but in all 60 economies of the world. And the case against India, which is being made, is that we have made structurally created excess capacity so as to have advantage in foreign trade. And also, we are not enforcing labor standards against forced labor in the country. We deny the latter, and in any case, our defense in the case of a trade surplus is that many countries of the world had trade surplus. There is nowhere in the world that every bilateral trade is a balanced one that imports invariably. Otherwise, there is no advantage of trade. Free trade is based on comparative advantages. You may have advantages on one, and other countries may have advantages in some other, and that's why the trade takes place. And the trade takes place because it is benefiting both sides. The fact is that if we have access trade exports to the United States compared to its imports, we have already committed in the framework agreement that the U.S. has, as it had been pointed out by the U.S. president and then by his officials, that India should try and import more from the United States. And a figure was bandied around that up to $500 billion of technology, as well as oil and agriculture products, energy, oil meaning energy, that if we were to import more of these, we could reach a figure of $500 billion of trade with the US in the next 5 years, and we are open to it. We have not denied it. Now it depends upon what is the price of the US energy imports to India, what is the price of comparative ones, and similarly the technology and the agricultural goods. Though in a case of agriculture, it is for us not merely a commercial transaction, since it is in India, agriculture is a vocation.
Right. Let me just bring in an interesting conversation that I had with the renowned economist and commentator, Professor Jeffrey Sachs, just yesterday. Jeffrey Sachs, what he essentially said is that we're negotiating with Donald Trump at a time when he has no cards. He was essentially referring to the February ruling by the U.S. Supreme Court, which struck down the tariffs altogether. Subsequently, lower courts have come out in their verdicts, even against the 10% baseline tariffs that the U.S. introduced post that. Again, I just want to get your thoughts. How much of a factor will that be as far as India-US negotiations are concerned, or is that something that a hurdle that we've already crossed and won't look back at?
I'm not sure that it wouldn't revisit us. It is easily possible that if we recall, let me just go back to the February 26 framework agreement, where a figure of the export tariff on India of 18% was talked about. And thereafter, we did get monthly waivers on imports of oil from Russia, and the additional 25% which was being imposed, those were kept in abeyance.
Sure.
The question is, the US does keep with it all kinds of handles, including universal application of sanctions, merely because the dollar is I shouldn't call it merely and not underplay it, that dollar continues to be the reserve currency of the world, and the US can impose a whole lot of sanctions. because on trade in dollar currencies. So we have the apprehension is not altogether removed. The BTA, whether it's the first tranche or the later tranche, also is amenable to the other US laws, including the Trade Act of 74, which gives the president and his administration a wide number of powers to kind of go around the agreements or the agreed tariffs.
Right, so the US president not short of firepower. Speaking of firepower, Mr. Fabian, let me get your thoughts. One of the issues that Mr. Dua had referred to was greater energy imports. Latest data by Kepler indicates that gradually US oil imports, as far as India is concerned, is inching higher. Just give me a sense. What is your understanding? How critical are greater energy imports from the US as a part of this trade deal going through?
Well, Secretary Dua, quote, very diplomatically, unquote, raised the question, it depends on what is the price of the US oil or LNG. Now, let us be less diplomatic. Fact is, when we buy oil from others, the price is determined based on the market value. When we buy from the United States, it is determined politically, quote unquote. In other words, we are paying much more for oil from the United States. This has to be kept in mind. Secondly, why is it so? That is because the philosophy of President Trump is what I call mercantilist, which is something which is it goes back before modern economics originated. And America under Trump believes that other countries should invest in America. American, the payment for the workers or the maybe high. That doesn't matter, but you should invest. So Trump has a rather distorted, I'm putting it mildly, idea of international trade. And that is the problem, but we have to handle him with patience and with skill. And one more point let me make. Because of the delay in this trade deal, foreign investment has dried up and rupee has been falling. So it is necessary for us to have a trade deal. But that doesn't mean we should sign on the dotted line.
So not at any cost. We have to be guarded. We have to have a deft touch as far as these negotiations. I'd like to thank both Secretary Dua as well as Mr. Fabian for being a part of this discussion. I'd also request Mr. Fabian to stay on for the next segment of this show, which is, of course, on Iran. We're taking a very short break, but coming up next, US President Donald Trump has claimed that Israel and Hezbollah have agreed to de-escalate, but the strikes still continue. We'll discuss that and a lot more after this short break. Welcome back to News Center. Now, hours after Iran suspended talks with the United States over Israel's expanding military operations in Lebanon, U.S. President Donald Trump told CNBC that he was unconcerned by Tehran's decision. Trump also claimed that Israel and Hezbollah had agreed to de-escalate the conflict. He further said that he had asked Israel to pull back its troops from the Lebanese capital, Beirut. The remarks came after a phone call between Trump and Israeli Prime Minister Benjamin Netanyahu. According to Axios, Trump expressed strong displeasure over Israel's military actions, reportedly telling Netanyahu that the offensive was hurting Israel's global standing. U.S. officials described it as one of the most tense exchanges between the two leaders. Despite the call, Netanyahu's office said that Israel will continue its operations in Lebanon. Subsequent strikes, meanwhile, in southern Lebanon reportedly killed more than 8 people on Sunday. Netanyahu has ordered the Israeli military to expand its operations inside Lebanon. Although Israel had threatened a major strike on Beirut, it has so far refrained from carrying out any such attacks. Meanwhile, International Atomic Energy Agency Chief Rafael Grossi has said that any future nuclear deal with Iran will look very different from previous agreements, given the significant advances in Iran's nuclear knowledge, technology, and capabilities. And well, joining us now to take this discussion ahead is with us former diplomat, Mr. K.P. Fabian. Also joining us now is Deep Pal, Director of Geopolitics and Policy at Coan Advisory Group. To both our panelists, thank you once again. Mr. Fabian, coming to you first. Give us a sense, Donald Trump trying to impress upon Prime Minister Benjamin Netanyahu to not push forward with the Lebanese offensive. The Prime Minister, however, has a very different perspective. He's come forth and said that Israeli military operations, at least in southern Lebanon, will continue. Tell us, tense exchanges between the two leaders, will it yield any result, at least in terms of a ceasefire?
Yes. As you mentioned, the exchange between the two was rather tense, and Times of Israel and others have pointed out that President Trump told Netanyahu, "I saved you from jail." And then Trump uses a 4-letter word and a 3-letter word. I will not mention them. So the exchange was tense. And then what did Netanyahu do? He put out a post saying that he had a conversation and that he had told Trump that Israel has the right to defend itself. So we do not know what Netanyahu might finally do. But I think it is more important for us to figure out why Trump did what he did. That is because President Trump finds himself in a dilemma. It is my view that he has no option to resume the war because Iran can withstand a war for weeks and even months. And people talk about the midterm elections in November. I'm coming to it. But let us not forget there is a 4th of July. Do you mean to say that on the 4th of July, when he is celebrating the 250th anniversary, Trump can receive body bags? So he cannot resume the operation before the 4th of July. And if he starts after that, Iran can withstand it till November. So President Trump has no option. He has to have a diplomatic resolution, but he is not going about it in the best possible way. But that is President Trump.
Sure. Let me also get in Mr. Deepal. Mr. Deepal, Iran says that, look, I don't want to be a part of these talks. The ceasefire very clearly mentioned Lebanon as well. You're not respecting the ceasefire, and therefore I'll stop the talks. And as soon as that happens, we see Donald Trump then applying pressure on Prime Minister Benjamin Netanyahu. Now, whether or not it works, the fact that it got Donald Trump to come on board and start applying pressure on Benjamin Netanyahu, does that indicate that Donald Trump is against the wall as far as this negotiation is concerned? And does it strengthen the hand even further as far as Tehran is concerned?
Right. Thanks for having me. I mean, the fact that President Trump has felt that he's been pushed against the wall has been apparent for quite a while. I mean, there is obviously the issue of midterms that are coming up. At the same time, the numbers have shown that he is entering a deeply unpopular period with the people of his country. as well as issues on inflation that have finally reached the American people. So there are various reasons why President Trump has been wanting to find a way to get out of this war. We have heard him and other people in his administration talk variously about what their objectives are and whether they believe they have been met, or whether the Iranian capabilities have been decimated, all of which have been proved to be wrong multiple times. So they do really need to find a way to get out of it. And as far as Iran is concerned, their leverage for quite a while has now been twofold. One, obviously, is their ability to decide who gets to, which vessels get to cross the Strait of Hormuz, as well as the fact that they have nuclear material, which they are in a position to decide what they're going to do with, if they're going to allow it being moved to a third country, or if they're going to keep it. Those are the two levers with which they have been playing for a long time. And those are the two things that that have been bothering President Trump. Now, obviously, the blockade that the US Navy has instituted in the Strait of Hormuz has had some effect on Iran's economy. So there is definitely a clock that is running out for both sides, but it is possible to argue that Iran may manage to push through for slightly longer. Yeah.
You've mentioned two issues. Let me just get your thoughts on each of them. First, as far as the Strait of Hormuz is concerned, we were speaking to Jeffrey Sachs just yesterday, the renowned economist and professor. He's of the view that if there's going to be any interim framework, it will need to have some kind of tolling mechanism that allows Iran to collect money off the shipping tankers passing through the strait. Is that a feasible reality? I ask you that because most countries have opposed it.
Absolutely. Most countries have opposed it. We know European countries such as the UK and France and others have decided to come together to have a mechanism wherein they can ensure free movement of traffic through the Strait of Hormuz. But at the same time, what Iran has exhibited over the last 4 months is that they are in a position through their mines and through their armed speedboats and other means available to them, ensure that they control who gets to crosses. The IRGC has been using this as a very strong mechanism right from the outset of the war. So this is definitely something that they will want to continue to do so as long as they believe that they are at risk of not finding favorable conditions as a result of the negotiations. Now, obviously,
Mr. Pal, just let me word it differently. Do you see a deal happening with Tehran agreeing to not having a toll as opposed to having a toll? Do you see an interim framework without the toll?
That would obviously depend on what else Tehran manages to get out of the negotiations. There is the question of having their funds unfrozen, sanctions lifted, the nuclear materials. Now, it is possible that you put all of those on one side, then Tehran might agree to a situation where the tolling does not happen. I think more important than the tolling is to understand that this is one of the very strong levers that Iran has been using from day one, and they will continue to do so as long as they feel that the ultimate end of this negotiation, what they get out of this negotiation is not completely favorable to them. The primary thing that they're trying to get out of this is some kind of an assurance, an unbreakable assurance, if you please, that they will not be attacked in the way they have been in the course of 2025 and 2026 twice by Israel and US. If they feel that that assurance has been sufficiently strongly achieved or received, then they may agree to a situation where they're not tolling the Strait of Hormuz. Please understand, the tolling is not the issue here. The issue is Iran showing that it is in control of letting ships in and out of the region.
Sure. We're running out of time, Mr. Fabian. I'll come to you for another quick comment, almost in the press as far as this issue is concerned. What many have proposed is that perhaps this is an issue best left for more detailed discussions to a later date. Is that something do you see happening, that perhaps some interim framework is reached minus the nuclear clause while the negotiations continue, perhaps stretching on for a few months, years, until more clarity is reached?
Well, just a word about Hormuz. It is not international waterway, as Secretary Rubio has been saying. It falls within the territorial waters of Oman and Iran. And the only thing is that these two countries are obliged under the United Nations Law of the Seas to give a transit passage. Now, second thing is there should not be any confusion between toll and an administrative fee. Well, if the Iranians say that, oh, you're carrying 2 million barrels, please pay us $1 per barrel, that will be a toll. But if they say that you have to pay an administrative fee for the passage, that's a different matter. Now, having said that, coming to the nuclear matter, Iran has said 1,000 times that it has no intention to make a bomb. And the 2015 Obama deal made it very clear that Iran will never make a bomb because IAEA had full access. Now, President Trump's problem is something like what happened in Macbeth. You know, Macbeth killed Banquo, and then Macbeth was hosting a dinner, and he, wickedly said, Banquo is coming. Banquo came and sat in his chair. Now, whatever deal which Trump wants will look very much like the 2015 deal. So why did he walk out of it?
Right, so interesting questions that, of course, one can hope for answers, but not guarantee if Donald Trump and Tehran and the leadership in Israel will arrive at that with time to spare. We'll, of course, continue to follow all the action out of West Asia. Mr. Fabian, Mr. Pal, thank you so much for joining us. With that, it's a wrap on this show. For more news and updates, keep watching CNBC TV 18.
Hello and welcome to the Global Dialogues. I'm Shireen Bhan. The on-again, off-again nature of the Iran-US peace talks and continued uncertainty over the Strait of Hormuz have kept the crude oil markets on the edge. Crude prices have seen some wild swings as the US and Iran continue to clash despite the ceasefire, and there appears to be no consensus on an agreement to end all hostilities. The Strait of Hormuz remains one of the world's most critical energy choke points, with nearly a quarter of global seaborne oil trade passing through it. The head of the International Energy Agency, Fatih Birol, had warned a few weeks ago that oil markets could soon enter a red zone as global inventories decline and demand strengthens during the peak summer travel season. He's also warned of the worst energy crisis the world has ever seen. Joining me now to discuss all of this and more is the man himself, Fatih Birol. Mr. Birol, many thanks for joining us here on CNBC TV 18 on the Global Dialogue. Let me start by asking you about the signals that you're picking up from the oil markets at this point in time. The Strait of Hormuz continues to remain blocked. There is no consensus as of today. Oil markets have, of course, been reacting today under $95 a barrel. What gives you hope, if anything at all, and what do you fear the most today, Mr. Birol?
Thank you. Greetings to India from International Energy Agency headquarters in Paris. We are facing a major problem in the energy markets, and as I said almost 2 months ago, this is the largest energy crisis in the history. We had 3 major energy crises in the last half a century. 1973, a major oil crisis. 1979, another major oil crisis. And 2022, after Russia-Ukraine war, a natural gas and oil crisis, especially in Europe. So the amount of oil and gas the world has lost, combined in this 3 major crises, is less than oil and gas we lost in this very crisis of Iran war. So we lost huge amount of oil, huge amount of natural gas, and this would have major implications for the global economy, especially in Asia, and within Asia, developing economies. So my biggest worry is the following. When we enter this crisis, we had buffers. The IEA has said that before the 28th of February, there was a lot of surplus, there was a lot of oil in the markets, pushing the oil prices down. And after the crisis started, we have been using this surplus plus the inventories, the stocks that the governments and companies have, and all this gas, oil we have already is now diminishing. The inventories, the stocks, the money in the pocket is diminishing, and not new money is coming in. We are coming at the bottom of those. And as I said, if we are not able to see fully an unconditional open of Strait of Hormuz by end of June, July and August, the travel season around the world in many countries are starting, the flights and the cars and the buses. We may be entering the red zone for the global economy, especially those in Asia.
You know, you talk about entering the red zone in July and August, which is when you expect travel demand to rise. And you talked about an unconditional opening of the Strait of Hormuz. As things stand today, Mr. Birol, how likely is that scenario? We've seen Iran and Oman talk about a mechanism being put in place. They refuse to call it a tolling structure. But do we now need to grapple with the reality of that new mechanism coming into place? And what will that mean for the oil markets?
So what the oil markets want to see, what the energy actors, players want to see, that a state is open fully and unconditionally, which means that the tankers can travel without having any questions about security and without paying any fees, because the international law, the maritime law, tells us that the international travel in the waterways is free. So, of course, it's up to governments to decide what they are going to agree, under which conditions this agreement will be made between the different parties. But it is important to give the markets the confidence that the tankers can travel without any security questions. And this is, of course, not an easy task. Many people think, I talk with all the actors, both governments and the industry, many people think if it is closed once, it may be closed again. So this is something that I think the countries around the world need to give it good thought. What are their energy strategies, priorities in the future, and what kind of lessons they need to draw from this very situation.
I'll come to the lessons in just a second, but if I can talk to you about immediate next steps, Mr. Birol. You know, the 400 million barrel emergency release was the IEA's largest ever. You've said that it reduces the pain, but it is not the cure. We've also seen strategic reserves, for instance, for America being drawn down quite significantly. Now, are we looking at the possibility of another tranche from the IEA, and what will that mean in terms of the oil markets if, in fact, you go through with that?
So when I announced on 11th of March that we are releasing 400 million barrels of oil to the markets, it is historic. It is we have made several releases, but this is the largest by a big margin. We have seen that as soon as the markets saw that this oil is coming to the markets, to calm the markets, the prices went down by about $20 US. It provided relief. It was very good. And it was a unanimous decision of our member countries and many countries who are the accession countries to IEA to be a full member, such as India, gave a strong support. And here I want to thank Minister Puri for his strong support. Now, this 400 million barrels is big, but it is only 20% of the reserves we have. 80% is still in the pocket. And we will see, we will assess the market conditions, and if we think it is necessary, we will be ready to act immediately. So it is up to markets, up to market conditions. If we think there is a need for that, and we are ready to act immediately and swiftly.
If I may double down on that, Mr. Birol, you said that you will act immediately if the conditions so arise. What could trigger the move on the second tranche of the reserves being activated? What could those conditions be that will force your hand in some ways?
Now, we are discussing this in the last few weeks, few months, almost on a daily basis with our member governments. We need to come to a conclusion that the disruption came to such a level that it is now time to go ahead. But as of now, as we speak now, I don't think that we are at this stage yet. But we are monitoring the markets momentarily and very closely. If we believe it is the time, we will definitely go for it. But at the moment, we are not there.
understand what the process of rebuilding will look like and what timelines we're talking about, Mr. Birol. Assuming that an agreement were to be reached between the US and Iran, that the strait were to reopen, in the next few weeks, what will that mean in terms of rebuilding, in terms of what is already stuck, the oil that's stuck at the Hormuz? What will it mean in terms of rebuilding infrastructure in key markets like Qatar, etc.?
It will be, in some cases, in some countries, it will be easier. Those countries who are able to store the oil in the major storage facilities, and the countries who have strong financial muscles and technical capabilities. For example, Saudi Arabia, I think, will move very fast. Emirates can move also fast, and some others. But some countries such as Iraq, I am worried about Iraq because Iraq's oil storage facilities are not as big as the other countries in the Gulf region, and there are many shut-ins of the fields. It may take some time, and also as I said, the financial capabilities of the countries are important. And it will be also depending on the damage that the facilities have witnessed, such as the ones in Qatar. I think it is rather naive to expect that the Qatar LNG terminals will go back very quickly where they were just before the war. So if it is, to sum up, if the Hormuz Strait is open, if there is a peace, it is an agreement, it will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process, volatile markets for some time to come.
If you're saying that it will be a rocky process, it will continue to be volatile even if the strait opens and there is an agreement, what does that mean in terms of oil prices? We've seen wild swings from 144 now down to about 95. What do you see as the possible ceiling? What do you see as the possible floor?
So I will not mention any specific price levels, but first of all, I would like to remind all of us that some observers say the oil prices are low, but they are not low. They are, let's remember that they are at least $30 higher than where they were just before the war has started. And it is already being a major pain on the economies of many oil importing countries, especially developing countries, and we will see they are going to push the inflation numbers up in several countries, especially when the currencies are not so strong. Looking at the next few weeks and months, I believe it will be rather a transitional period, and it will be not easy to get all the Middle East oil, which exported more than 20% of the global oil to the rest of the world, to see that everything will be easy and the prices will come down the next day. I think we need to expect that the prices will be at these levels for some time to come. And I am only worried, once again, that the Strait of Hormuz is not open before the end of June, before the inventories are going completely to the bottom, and before the travel season in many parts of the world starts. Otherwise, we may well see even higher prices than today.
Let me end, Mr. Birol. I know you're out of time, but let me end by asking you about the future as far as the OPEC is concerned, especially with UAE exiting the bloc. What do you see as the future as far as the oil bloc itself is concerned?
I mean, it is, of course, it is up to OPEC countries to decide what they are going to do. And I have recently, when I was in Vienna, meeting the Prime Minister of Austria for several issues, I had the opportunity to visit the OPEC Secretary General, and I think it is important that all the parties in these difficult days have a good, sincere dialogue, because this is a situation that we don't have the luxury to have tensions between the producing countries, consuming countries, and I think that it requires a good communication, good dialogue among the parties around the world. Emirates, they made their own announcement. The colleagues from the Emirates, both the minister and the other authorities, that they chose this way, and they are going to increase their production in the next years to come. And I also have good contacts, good coordination, and good dialogue with the authorities and the government of United Arab Emirates.
Well, Mr. Birol, always a pleasure. Appreciate you joining us. We hope it doesn't get to that scenario of the red zone that you spoke of. And we hope that there is a breakthrough in the talks that are currently ongoing. But appreciate you joining us this afternoon to talk to us about all things energy. Always a pleasure. Thanks very much for joining us on the Global Dialogue.
Thank you.
Well, that is Fatih Birol of the International Energy Agency. Telling us very clearly about what the possible pain points are likely to be. In his words, it would be naive to imagine that even if there were to be an agreement between Iran and the US, that oil prices are going to drop significantly, as is being claimed by President Trump. But of course, also highlighting that there needs to be safe, secure and unconditional movement through the Strait of Hormuz. The red zone that he talks of is the July to August period, when travel typically is expected to pick up, and that could put pressure on demand. Supply already constrained. Importantly, the IEA is not looking at releasing the second tranche of the strategic reserves. Remember, they've already done a tranche, the first tranche of a historic 400 million barrels, but they don't feel the need to act on the second tranche just yet. We will take a break here, but there's a lot more coming up for you on CNBC TV 18. Stay tuned. We're back with more right after this.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines you're tracking. Attacks continue in Lebanon despite US President Donald Trump's claim that Israel and Hezbollah have agreed to stop all shooting. Iran threatens to halt negotiations and close the Strait of Hormuz if Israel continues to strike Lebanon. President Trump tells CNBC he does not care if Iran pulls out of negotiations.
It will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process.
International Energy Agency head Fatih Birol warns the oil market could enter a red zone if the Hormuz Strait doesn't reopen by June, adds that oil markets will continue to be rocky and volatile even after the war ends. When asked if the IEA was considering releasing another tranche of emergency release, the IEA said not there yet. Sensex and Nifty snap a 4-day losing streak. Nifty moves back above 23,500. Mid-caps underperform. Rupee weakens over 27 paisa against the dollar and remains above the 95 mark. India seeks competitive advantage over Asian peers amid trade negotiations with the US. Government sources say negotiations will focus on getting relief on new tariffs under Section 301, which are expected to be announced by the end of July. Tata Trust Chairman Noel Tata questions the 7,000 crore funding proposal for Tata Digital businesses during the May 26 board meeting, raises concerns about the growth outlook for the company. Noel's daughter Maya may exit Tata Digital and head to Trent. Kumar Mangalam Birla is on the prowl. Aditya Birla Group emerges as the likely frontrunner to acquire Shell's India renewable unit, Spring Energy. Sources say the deal is likely to be valued around $1.7 billion. That's a Money Control exclusive. Enforcement Directorate searches the premises of Anil Agarwal's Vedanta Group in Mumbai and Delhi. Searches relate to alleged foreign exchange law violations over royalty payments to parent Vedanta Resources. The company says it's extending full cooperation to authorities. Anthropic files papers confidentially to go public in what promises to be a blockbuster year for IPOs on Wall Street. The company was recently valued at $965 billion. Elon Musk's SpaceX has already filed for an IPO, and Sam Altman's OpenAI is expected to follow suit. At least 16 people have been killed in Russian missile and drone attacks across Ukrainian cities. 2 children are among those killed in one of Moscow's largest assaults in recent months. CBSE student Sarthak Siddhant, who flagged alleged irregularities in the tender process for the new on-screen marking system, appears before a parliamentary panel. National Students' Union moves Delhi High Court seeking an investigation into lapses by the CBSE. All right, the top story that we are tracking is the West Asia update. Attacks in Lebanon continue despite Trump's claim that both Israel and Hezbollah promised to cease hostilities as Iran stops exchanging messages with Washington. Here are the latest developments. At least 4 people have been reportedly killed in Israeli Army's latest attacks in southern Lebanon. The president of US, Donald Trump, said that Israeli Prime Minister Benjamin Netanyahu agreed to pull back any troops preparing to attack Beirut. He added that Hezbollah, through intermediaries, had pledged not to attack Israel. Talks between Israel and Lebanon are scheduled for Tuesday and Wednesday in Washington, D.C. Meanwhile, Iranian media has said that Tehran has not yet responded to a proposed framework agreement from the U.S. Discussions on the final are underway. The text is underway. Iranian officials are reportedly reviewing the proposal cautiously because of what they see as a history of the U.S. of not honoring agreements. This comes up.
Panelists, over to you, Shireen.
Well, thank you very much, Prashant, and to Vinay, Avi and Sid for providing the feeder fund as we get started with this set of our conversations here this evening. You know, I was just quipping to Sanjay. I said, you've almost got a decade now behind you. And he said, no, not if you look at the notification or not actually when the Prime Minister inaugurated GIFT City, which was in 2015, but the act was notified in 2019. So edging closer to the 10-year mark, but not quite there yet. So Sanjay and PD Singh, thank you very much for joining us here. Let me start by asking the question that kind of was the glue that put the last panel together. when you meet investors, when you meet people who are looking at India and they ask you, there's Dubai, there's Singapore, then there's a whole bunch of other financial centers. Why GIFT City? How has the pitch changed since 2019 to 2026, Sanjay?
Yes, that's a question that comes up quite often. Now, we need to understand fundamentally what is it that we are trying to create here. Is it replicating a Dubai or a Singapore? Or is it something else, something larger? The pitch that we give is, we offer something which Dubai or Singapore cannot offer. We see that Dubai can be a bridge between the Middle East and Africa. Singapore is the gateway to the east of Asia. Now, where does GIFT City stand in this? We pitch that GIFT City gives global capital access to the Indian markets, one of the largest growing economies in the world, and it's expected to grow that way in the next decades to come. We tell them that why don't you should be a part of India's growth story with the same set of international standards for operation, the comfort of, the Indian sovereign regulatory ecosystem. That is what we sell. That's what we market. And entities are starting to believe that. They have been evaluating. Of course, as the previous panel mentioned, we are evolving, so naturally, regulations evolve, we tweak, we change, the regulator does it, so that to take it forward.
No, absolutely. And I appreciate the fact, as you said, that there is feedback that's coming in and the regulations are keeping pace with the changes that investors are asking for. But if I could draw on the lessons since 2019, what have been the biggest learnings in your experience that you're now putting to work as you envision GIFT City 2.0?
See, the first decade, I would say, you mentioned when was it inaugurated, was about telling people that this is something that, telling the whole world that India can create a global financial center. Being out there, getting in people to GIFT City, that this is a workable financial center. Now, when the development started, we have these challenges which comes in naturally. First is the regulation. Regulation evolves, number one. Number two, challenges of talent, the ecosystem, how it develops. And of course, institutions believing in the credibility of regulations, the consistency, the clarity. So these are the challenges which come in naturally. And convincing people, convincing institutions that at this point in time, if not as good as Dubai or Singapore in terms of the quality of life, we are aggressively positioning ourselves to at least give you something which is similar to those environments in terms of living there. So I would say these were the challenges. In fact, these are the challenges that we face repeatedly. Regulations, I'm again repeating, they evolve, they tweak, they change, and that's not that much of a challenge at this point in time, I would say.
Yeah, and I think the point is well taken. I think creating the social infrastructure is critical, and that's not that easy to actually get done. So how many people now who are part of the GIFT City ecosystem, what, about 30,000 people currently?
Yes, about 27,000.
27,000 people, and you hope that number goes to about 1 lakh by 2030?
Yes, a minimum of 1,100,000.
And you've managed to convince people like PD Singh to set up shop in GIFT City. So let me put that question to you. Why? What made you want to set up shop in GIFT City, and what's that experience been like for you?
So I can say an ecosystem that was envisaged and is currently in a stage where we are no longer thinking about why GIFT City, but we are actually looking at expanding and doing more in GIFT City. So that's the current phase we are in. We were the first foreign bank there, and as one moves in, others follow. There are currently about 1,000 entities that are already registered in and doing business in GIFT City. We have hundreds more that are being registered, as I learned today as well. So for Standard Chartered, GIFT City was an early bet that we took, which has paid off really well. We now provide the rails for foreign currency, that is the US dollar settlement that happens there. We have 11 banks which are already live on that. these rails are being opened up for cross-border payments as well. Yeah. So payments that earlier took a day, day and a half to clear are now almost real time and can happen instantly. We have $100 billion of assets already in GIFT City. So if you look at India's banking system, it is $2.2 trillion of assets. And if you look at GIFT City as 5% of that, it is no mean feat that we have achieved already in a short period of time, under 10 years. Again, if you see what DIFC did, it took DIFC 25 years to get to $250 billion. And we are, I think, now growing geometrically. For our own bank, like you were asking, for Standard Chartered, in just the last 3 years, we have grown 7x. We've run out of space repeatedly. We've grown our offices. We've hired more people. And transactions are just growing at a phenomenal pace as far as we are concerned.
Well, that's good to hear. So that 100 billion milestone, at least as far as banking transactions are concerned, that's a big one as far as GIFT City is concerned, Sanjay, wouldn't you say?
I would add on to the 100 billion is currently about $140 billion.
140, yeah.
Because see that this re-emphasizes the fact that it's again not 10 years. Yes, there are about 40 banks that are currently in GIFT City. Around 20 of them are foreign banks. This shows the growing confidence, and again I would lay to the regulation, the regulatory clarity which is there. Consistency, stability. I think that is what a global investor would look in to go to any financial center. This is which is of utmost importance. This is what drives them, is what I would think.
No, absolutely. I mean, not just banks, but we've got a lot of global capability centers that have set up in GIFT City as well. And I'm wondering whether, respond to not criticism, but concern that may emerge that is this now sort of ending up as being the hub of the back office, so to speak, or is it truly a financial center? How do you respond to that? And is this a question that comes your way?
No, this question doesn't come our way.
Okay, that's good to hear.
At this point in time, we have about 1,300 odd entities which are registered in GIFT City, and on an average, 100 are getting registered every month. Now, who are these entities? Banks, fund managers, leasing entities. We have about 40 odd aircraft lessors there. Then you have insurance, reinsurance. We have 2 stock exchanges. Of course, this is what is growing, not the stock exchanges, but other entities are growing. GCCs in the current context are not entirely back offices.
Correct.
What we are promoting as GCCs are entities that feed into the ecosystem that is growing. This is a whole chain that is actually being developed in GIFT City, and GCCs related to them are being encouraged, and we've seen a good response because we have 2 zones. One is the IFSC, the Financial Services Center, and also the DTA, the Domestic Tariff Area. So GCCs are coming in both the areas. It's not primarily back offices.
Are there certain areas that you intend to prioritize or focus on? So, for instance, we heard from Vinay, and of course, Indian aviation has long struggled with this business of leasing, and that clearly seems to be a focus area as far as GIFT City is concerned. But are there any other specific areas or pockets or sectors where you intend to put your might and your bandwidth on to sort of prioritize them?
Aviation, of course, yes, because currently, there are about 100,000 aircraft operating out of the country, leased aircraft, and what we understand, the order books of the airlines operating within India is close to 2,000, 2,500 odd. Yeah. And a majority, if not all, of the leasing financing of these aircraft happen outside the country. If India is one of the largest growing aviation markets, why should not the financing happen from within India? There's a clear mismatch between where aircrafts fly and where the financing takes place. So naturally, taking in, how are we expanding our business? You consider the strength of what India needs. That's where we push in and we aggressively market it. That is one. Second, global treasury operations is something we would be very keen to push, and we are doing it very aggressively. Increasingly, traditionally, India corporates were raising funds overseas, which is very natural because that is where the ecosystem was. So it makes business sense to be there. But now we have within our country an International Financial Service Center which offers, if not all, a majority of those services. So it makes sense to raise capital from within the country, gives them comfort that they are nearer home. So the first target what we are doing is at least the Indian multinationals that are operating from outside, raising funds from outside, we would want them to have the treasury operations from within the country. Treasury operations is not just lending and borrowing and lending money. It has a whole lot of other things. You know? So we are pushing it very aggressively. And as I mentioned, funds are very important because that's where the capital comes in. It's through funds primarily.
Yeah.
So that has found its traction. The regulations are quite mature, except for little friction here and there.
What is the specific point of friction?
The previous panel mentioned something. Procedural friction. It's not fundamental policy friction, except for there were talks about, you have agreements with other countries where,
mutual recognition. Yeah.
Yes. So that's, of course, a policy matter, but then certain procedural frictions. That's one. GCCs, yes. Like I mentioned, GCCs, we would look at GCCs at helping us build up the ecosystem, feeding into what we are creating. That's very important, and that's what we are doing.
Okay, so that's very clear in terms of what the focus areas will be and what you intend to prioritize in terms of the kinds of entities that you want to draw in, also the kind of capital that you want to draw in. You said you're running out of space already and you're looking at expanding operations there. What has been the most surprising aspect of what you've been able to do at GIFT City? And what's the ambition now as you look at expanding your presence and your footprint there?
I think the breadth and diversity of what we've been able to do has been very encouraging. I wouldn't say surprising because that's what we set out to do. I'll give you examples. So for example, the refinancing of education loan book, the refinancing of social bonds, the ability to do aircraft and shipping finance, which we've already done, the ability to bring in capital by the ODI route, the ability to do the first gold OTC hedge that we could do. So I think the breadth of things that we could do has actually shown us that this is something that is of size and scale, substantial, deserves to be grown and invested in. I think we are not the only one. And as you heard, there are a large number of others moving in at a very quick pace. And so like I said earlier, we are no longer in the discovery phase. It is now just making sure that we ramp up and others are following at great speed as well. The benefits of being at GIFT City, and of course there are some which are not, benefits compared to a Singapore or Dubai in terms of cost, the ability to get talent locally, and of course the connectivity that we have with India. Mr. Kaul mentioned about RTCs, regional treasury centers. There are also PSPs, the fintechs, that are establishing RTCs which have no connection with India whatsoever. So they are doing global settlement of their funds out of a center that is easy to operate and also from a cost perspective, very efficient.
Okay. I want to go back to the talent point because that was a point of concern and you've got a target of at least 1 lakh by 2030 in terms of the number of people that will be employed in the GIFT City ecosystem. How challenging was that aspect? How did you work your way around that?
So for us, we've been lucky because we've been in India for very long. It's just like an extension of what we do in India. And Indian talent is there all across the world. The next step, what I'd like to see, we talked about RTCs. If we are bringing in an RTC, why can't we bring the top talent from that RTC and the rest will follow? So I think sometimes it is just that tipping point of getting the top talent to GIFT City. And what do we have to do for that? Either you pay them more or why not give them...
Are you willing to pay them more?
Well, maybe at some stage, some of the more, very specialized skill sets will get paid more. But why not give them the same incentives as we're giving the entities to establish there, pick the top talent that we really need to bring there and give them the same kind of incentives, whether tax or otherwise. And, I guess they can work anywhere in the world with the same incentives.
Sanjay, is this something that you're looking at and is this feedback that has come your way as well in order for you to be able to continue to draw in top talent?
Yes, see, now when we talk about talent, it's not entirely, you're not creating jobs. I would want to have that much of talent which is globally deployable. That's more important. When entities come into GIFT City, see who are their banks, their leasing companies, their fund managers, exchanges. So a whole hog of talent is available. Who they bring in. As Mr. Singh mentioned, they brought in some talent, right? So the entities also bring in talent, and that increases, multiplies. Having said that, what are we doing? How do we ensure that there is availability of talent? Yes, we need a specialized skill set here. So how do we do it? We from GIFT City proactively, both GIFT City, we have entered into MOUs, associations with the industry, with academic institutions in the catchment area of GIFT City.
And with universities as well.
Universities, yes. So that we have some specific courses which are coming into, which are being made available. We have our own FinTech Institute, which is being developed. So that's a conscious effort which we are doing, trying to match the talent with the industry demand. Now, what is actually very important is talent follows the quality of life. When you talked about increased salaries, I would say it is if someone feels that this place is where I would want to live, my family would want to relocate, that's where half of my problem is solved. And this is where our entire focus is in terms of infrastructure. My physical infrastructure is there. In fact, a lot of construction, a lot of spaces coming up. Now, we are focusing very aggressively on the social infrastructure. In fact, we are spending a lot of money on social infrastructure, and we will be seeing in the next 1 year, starting, it will come out in phases, sports facilities, we have restaurants, which across generations, people would want to patronize them. Social event, concerts happening, we have cultural activities happening, all this is in the pipeline. We have one school which is functional. We also are in the process of opening an IB curriculum school. So essentially what I'm trying to say is, right from education, entertainment, healthcare, we have one of the prominent hospitals from Mumbai who will be opening up somewhere in September, a 350-bedded multi-speciality hospital. So, the life, making it the quality of life is what we are actually very conscious, and we would, that's where we are striving for, to make it livable. That's one. And more importantly, what other things that we focus on the talent, it is not about, what you say, within Gujarat, if you see the numbers, statistics, within Gujarat, that is the immediate catchment area, we have more than 500,000 technically qualified students. Across technology, finance, they would just need some little bit of upskilling in terms of short-term courses. And that is what we're striving for. Talent is available. It is just that we need to make them deployable on an international standards like a GIFT City. That is what we're providing.
So, you've laid out very clearly for us what you're intending to do on social infrastructure. And of course, amongst the many licenses that you've also had to garner has been one that I would imagine has brought a lot of cheer, no pun intended, to people who are working in the GIFT City. How much of a challenge was that, by the way, to just, because as you mentioned, it's the quality of life, it's the entertainment factor, it's the ability to go to restaurants, to eat out, the fact that you were in a dry state. How much of a challenge was that for you?
Yes, we have liberalized the norms for alcohol, how it can be served and where it can be served. It's been liberalized. It obviously adds to, for something that is attractive. So, say, prospective people who want to come in. So, essentially, it's industry demand. That's how we have gone and done it.
Yes. So you're reacting to whatever industry is asking of you, and the changes that industry would like for you to bring forward.
Whatever is, reasonable. Whatever does to make it a city of global standards, we would do it. Yes.
Since we're talking about global benchmarks, and you gave us an example of the many areas in which we see GIFT City setting those global standards in place, or in many cases actually doing things differently and setting an Indian standard that perhaps we could see others take forward as well. As we look at the road ahead, the next steps, what is it that you would recommend that can truly unleash the power of GIFT City with this vision of Viksit Bharat?
I spoke about geometric progression, especially in the financial ecosystem. We have now all the key players who are already there, many others being attracted to this. I think India has for far too long been a price taker. When we have the scale and size that we desire in GIFT City, which we are quickly, I can see the desire to get there, I think that's the time when we will be able to also benefit from the scale and size on the pricing bit, which, like I said, is something that we will all benefit from, and the entire ecosystem can pass on that benefit. Then I think the GIFT City will take a life of its own and will establish itself truly in the global map.
When you talk about the price benefit, quantify that for us. What do you hope to be able to accrue over the next few years as the ecosystem builds itself out to truly make it competitive?
Yeah, so currently we have a differential in the withholding tax. We have a 20-year tax holiday. We have various incentives for making investments in GIFT City. With all of that and this developing as a global financial center, and that's when we will be able to raise capital in large quantum, which then results in making sure that the price comes down, or making sure that at least we are not price takers and we can actually set benchmarks of our own.
What is the thinking on that front, you know, in setting price benchmarks, as PD Singh was just pointing out, outside of course, all the efforts that you're doing on the social infrastructure side, on the physical infrastructure side, etc., to also make the proposition much more compelling and much more attractive?
One, of course, is the regulations which come in, you know, how attractive are they? But then again, is it just tax incentives that make it attractive? It is just one of the factors which would make it attractive. What is more important is, you know, the credibility of the regulations, the consistency, the stability. I think that is something which is our strength. And the sovereign comfort, you know.
Yes.
I think that's very important. I think that's our strength. And when you talk about price, how do you bring it down is what you said, and how does it become competitive? Taxes on the one front, and generally if you compare, see the comparison always with Singapore. If you see the cost of operations in India is much less than what is there, what it's in Singapore. So that's how I put it, you know.
and welcome to Startup Street. I'm Ritu Singh. With me is Arundhati Ramanan, and here are the key headlines from the startup world. Well, sources tell CNBC TV18 that Prism, the parent company of Oyo, has received SEBI approval for its proposed IPO. The company, which filed its confidential DRHP in December last year, is expected to seek a valuation of around $7 to $8 billion.
Anthropic files papers confidentially to go public in what promises to be a blockbuster year for IPOs on Wall Street. The company was recently valued at $965 billion. Elon Musk's SpaceX has already filed for an IPO, and Sam Altman's OpenAI is expected to follow suit.
Aquapulse, an aquaculture technology and seafood export startup, has raised 45 crore rupees in a funding round led by NAP Ventures through its AgriShow fund. With participation from IN Alpha Fund, the fresh capital will help strengthen farm-level tech and disease management systems.
Plum, an employee health benefits platform, announced its maiden ESOP buyback program worth 15 crore rupees. Participants can liquidate up to 25% of their vested ESOPs, with 17 employees expected to receive payouts exceeding 20 lakh rupees.
And Amazon-owned smart doorbell maker Ring is facing a new lawsuit over its facial recognition feature, adding to a series of privacy concerns surrounding the company. According to reports, the lawsuit alleges that Ring's technology collected and used users' facial data without proper consent, potentially violating privacy laws.
Those were the headlines that we're tracking for you this evening. But on what's brewing today, Oyo's parent company Prism gets the market regulator SEBI's nod for its 6,650 crore rupee initial public offering. We learned from sources that the proposed public offering is expected to value the company at $7 to $8 billion. Aishwarya Anand is here with all of those details. Aishwarya, take us through what you're picking up.
That's right. Sources tell CNBC TV18 that Prism, the parent company of Oyo, has secured SEBI approval for its proposed IPO. The company had filed its confidential DRHP with the market regulator in December 2025 after shareholders approved a fresh equity raise of up to 6,650 crore. Sources indicate that the IPO could value the hospitality technology company at around $7 to $8 billion. Now, as the next step, Prism is expected to file its updated DRHP by July 1st week. The document will then be open for public comments for 21 days. Sources say that the company is evaluating market conditions and listing timelines as it prepares for the next phase of the IPO process. Now, the planned listing comes as Prism deepens its presence across India, the US, and Europe while expanding its premium hotel portfolio and vacation rental offerings. The company recently appointed former SEBI chairman Ajay Tyagi as an independent director and also received a reaffirmation of its B2 corporate family rating from Moody's, which expects EBITDA to be more than double in FY26.
Aishwarya, thanks very much for bringing us that report. Now, moving on, Anthropic has confidentially filed its papers to go public in what promises to be a blockbuster year for IPOs on Wall Street. Meanwhile, Google is also eyeing an $80 billion fundraise. Let's get you a wrap of all things AI with Rashna Dhanrajani.
Well, first up is Anthropic that has confidentially submitted a draft S1 to the SEC, kicking off the process for an initial public offering. Now, this filing comes just days after Anthropic closed a $65 billion Series H round, pushing its valuation to $965 billion. Now, the company is targeting a listing as early as October 2026. With this, it has also surpassed OpenAI and beat the company to file its draft to the SEC. Then Anthropic is also offering the European Union access to its most powerful model yet, Mythos. The model can autonomously identify zero-day vulnerabilities and generate working exploits, which is why access has been restricted to 40 vetted US firms, and that is known as Project Glasswing, as we've told you before. But now the EU cybersecurity agency, ENISA, will now be onboarded. Terms are still being finalized, though. Onto the capital markets then. Alphabet is raising $80 billion through stock sales to fund its AI infrastructure build out. This includes a $10 billion private placement with Berkshire Hathaway. Full year capex for the company is guided up to $190 billion now. And speaking of that Berkshire Hathaway investment, it is a part of a broader deployment blitz by new CEO Greg Abel. Berkshire Hathaway spent $16.8 billion across 2 days. Acquiring home builder Tyler Morrison for $8.5 billion and backing Alphabet's stock offering with $10 billion. Now, Buffett said that Abel did it faster and smoother than he ever could have. Then there's Florida, that has become the first US state to sue OpenAI and CEO Sam Altman, alleging ChatGPT-aided mass shooters drove users to suicide and addicted minors. Altman is being sought personally liable this time. NVIDIA's Vera Rubin is now in full production, delivering 5 times the throughput of Blackwell at 10 times the lower the cost per token. Now, this is available across major clouds in H2 2026. This was announced at Computex, which is happening currently in Taiwan, Taipei. Then there's SoftBank CEO Masayoshi Son, who told CNBC the AI revolution is 50 times bigger than the dot-com boom. After SoftBank announced an $87 billion AI infrastructure investment in France, SoftBank has now overtaken Toyota as Japan's most valuable company. That's all from today's AI Pulse.
All right, Rachna there with all the action from the AI world. But Blackstone has raised $13.1 billion for its largest ever Asia-focused private equity fund, more than double the size of its previous fund for the region. The firm has deployed over $7 billion across 12 deals in Asia over the past 24 months and continues to strengthen its presence in key markets, which include India. Blackstone has also benefited from improving public market conditions, completing 15 exits across the region as capital markets activity has picked up. But Ritu, it's over to you for what's brewing.
That's right. We have clean label food brand Anveshan, which has raised 150 crore rupees in its Series B round that was led by Vertex Venture, Southeast Asia and India, as well as IFC and Swiggy co-founder Sriharsha Majetti, among other existing investors. The company says it is already operating at a 280 to 300 crore rupee in annual revenue run rate, and now it's targeting 1,000 crore rupees in revenues within the next 24 to 30 months. The big question: whether Anveshan can evolve from a successful D2C brand into a scaled national food company. So let's bring in Akhil Kansal, the co-founder of the company, for more on this. Akhil, thanks very much for your time here and welcome to Startup Street. Start by telling us about this fundraise. I mean, what is the capital allocation roadmap? How would you divide this 150 crore rupees between expansion, brand building, technology, offline retail, etc.?
Yeah, right. Thanks for having me cover this. And again, it's a big milestone in the journey of the company. We started nearly 6 years ago, and this is a validation of all the hard work that has been done over these 6 years by the team. And a big thanks to all our customers as well as the investors who put their faith in us. And this capital will primarily be used to further strengthen our processes. At Anveshan, quality is our foremost focus, and with this capital, we further want to enhance the systems, the quality checks, the manufacturing processes, as well as expand into newer categories. Currently, Anveshan is majorly focused on oils and ghee, but we want to expand into all the staples. So our belief is whatever staples are coming into a household, we try and provide the best quality version of that. So we'll be using this money and expanding into other categories like atta and sweets like honey.
All right. Let me just get to one of those many things you mentioned. For instance, 300 crore revenue run rate today, and you're talking about crossing 1,000 crores in the next, 2.5 odd years. That's a 3 times jump that you're talking about. What gives you the confidence you'll be able to meet this, and what will drive that kind of revenue growth to begin with?
Right. So, like post-COVID, we have seen like there's a big change in how India consumes and what it consumes. So post-COVID, like we saw this opportunity early, like in our journey, like in 2020 itself. But there's a trend towards healthy eating and clean eating. So people are now aware. There has been a tremendous like large and large scale work done by big influencers where they are advising you should read the label, you should know what is going on in the food, and people are getting more and more aware. And like many new age brands like ourselves are passing on this message to the customers that you should at your home be aware of what you are eating, and this wave is not going to stop anytime soon. So what we believe is as more and more people get aware, so there would be drastic change in like what they consume, and focus on food would keep on increasing, and that is the primary reason why we believe the demand will be there. And in terms of why another factor like why we believe like this such a growth is possible, and this is a testimonial that in the past like 5 years also we have been growing to extent to year on year, and we believe like it have cost disrupt amazingly. So the logistics and the infrastructure, warehousing, everything is like
All right. Okay, we'll try and reconnect to see if we have Akhil back with us in just a bit. That was Anveshan, which has raised 150 crore rupees in its Series B funding round, and they are targeting 1,000 crores in revenue from about 280 to 300 crores is what they're doing currently. Let's check with our producers if Akhil is back with us yet. Okay, Akhil, if you can hear us, we lost you there for a bit. Quickly, your plans on offline expansion. When you look at the next 100 million consumers, since you're going to spend some of this capital raise on that, will it come from modern trade, general trade, quick commerce, your own channel? What's the plan there?
Sure. I think like when the signal got lost, I was touch basing upon this distribution network only. So I think like platforms like Blinkit, Zepto, and now Amazon and Flipkart also entering the quick com play have created a huge opportunity for new age brands to expand into. And as they enter into these tier 2, tier 3 cities, we have like on a website like still 25% of the consumers are from tier 3 cities. So again, like as these platforms scale into those cities, that is definitely one of the places where the growth would come from. And in the meanwhile, we'll also start expanding in the offline channel. And we've seen with data like there are still offline is still the biggest market, though quick commerce has taken share. 80% of the market is still offline, and we would like want to collaborate with good modern trade stores as well as standalone modern trade stores and expand it in the offline sector as well.
Okay, so you think most of the demand will come in from the offline space, but let's get back to your flagship products, which you were talking about earlier: ghee, oil, honey. But what next? What do you think is the next 100 crore category for Anveshan from here?
So we are like working on it, and speaking with our power customers and loyal customers on like what their biggest problems are. But like we've found that atta as a category like is used in every household, and it is again something which like customers want a better version for it. And so we are working on atta like which has like more fiber, more protein, and we'll be launching those versions soon. And the future categories are still under research.
All right, Akhil, and we wish you the best with that endeavor. Thanks very much for your time here today on Startup Street. Pleasure having you.
Thank you so much.
On the hot seat today, India's drone ambitions are moving beyond surveillance and into heavy lifting logistics. Noida-based Endure Air Systems has secured 30 crore rupees in funding under the government's Research and Development Initiative to develop the Sabal 200, a made-in-India heavy-lift drone capable of carrying payloads of up to 200 kilograms over long distances. Now, the company says the platform could have applications across both defense and civilian sectors as India pushes to build self-reliance in critical aerospace and drone technologies. To discuss this further, we are joined by Chirag Jain, the co-founder and CTO of Endure Air. Chirag, thank you so much for taking time out and joining us on Startup Street. You know, you have become the first drone company to receive support under the government's RDI initiative, right? What does this validation sort of mean for the company, and how critical is this 30 crore rupees funding in accelerating the development of the Subal 200 platform?
Right. So first of all, Arundhati, thank you so much for having me here. Before moving on to the RDI and Subal 200, I'll just mention a bit about Endure Air, what we do. So we are an uncrewed aerial robotics solution provider based in Noida, providing solutions majorly for logistics, high altitude logistics, and mid-mile logistics segment across both defense and civilian customers. We are around a 150 member strong team and a 50,000 square feet manufacturing facility over here. And this is a journey which has been an 8-year-long journey. So now at this juncture, getting validation from the government, and that through this RDI scheme, which is a very prominent scheme, which is a 1 lakh crore corpus, earmarked for deploying in heavy technology, indigenous technology, sunrise sectors. And this is meant to actually provide that patient capital bridge in these high-risk sectors and capitalize on private sector participation. So at this juncture, having received such an capital support is very important for us for continuing this journey, because hardware is, as we know, I mean, it's capital intensive, and in defense, I mean, the lead times and cycles are very long. So this is very important for us. And talking about a little bit about how this fund will be utilized. So we expect to utilize this funding for enhancing our production capability to accelerate the R&D and the certification of our platforms so that we are able to utilize these in civilian operations.
Absolutely. And, you know, if you could sort of in layman's terms take us through the Subal 200 platform, what it does, its use cases, and how is it different from what's already available in India?
Right. So maybe I'll just highlight, I mean, what the problem statement is which we are focusing on.
Right.
So the problem is that how do you enable access in treacherous terrains without jeopardizing human lives? So that is the core area along which the Subal 200 has been built. This is to address this clear national requirement for this high altitude logistics. How does Endure Air, play a role, and what is our USP? So we have been primarily doing R&D and development on this variable pitch rotor technology, which is the key driver across all our platforms. Now, how this helps in general is that you get much better speeds, you get much better endurance, and much better weather resistance and wind resistance capabilities, which finally translates to better operational capabilities or better operational flexibility for the end user. Now, how we see this platform, it's a multi-role platform, which has applications across both defense and logistics. It is just to talk about the capabilities, it's a 200 kg lifting platform with a turbocharged IC engine powered propulsion system, and with an endurance of more than 3 hours, with a range of around 200 kilometers plus. Now, this particular capability is not existing in the country, and that is the gap which we intend to fulfill. And with this capability, we expect to enter into defense logistics, plus adding more capabilities and enhancing the autonomy and perception suite on these platforms. Giving them the capability to carry synthetic aperture radars for foliage penetration. And for the civilian use cases as well, we intend to utilize this platform for grid mechanization and deploy these platforms for conductor stringing and TNP operations as of now.
Absolutely. And, you know, if you could, dialing back to the business, if you could walk us through Endure Air's current revenues, your order book, and what your customer base is at, and what stage do you expect the company to meet? I'm assuming you already have commercial scale, right? But from your drone platforms, reach meaningful commercial scale.
So it has been a journey for around 8 years. I mean, and right now we are in a revenue phase. The intention, actually, the focus right now is on achieving profitability by the end of this year. And with the Subtle 200 platform, we expect to crack into the capital procurement market of the defense forces, which is going to be the main revenue driver as we go along in the future and give us that bulk volume through which we can expand our production and supply these solutions out in the market. Apart from that, we are focusing on the civilian sector in association with Power Grid, and that is where we expect that the continuous revenue, which would be driven from services by deploying these solution for drone as a service model as well. So overall, I mean, we feel that this year is going to be year with almost, I mean, 3x or 4x the revenue of the current scale which we are doing right now.
And the hope that you're going to turn profitable by the end of this year. All right, Chirag, we're completely out of time, but thank you so much for taking time out and being here with us on Startup Street.
Thank you so much for having me. Thank you.
And on that note, we're going to slip into a short break. But up next, grab-and-go coffee startup Up Coffee is brewing something bold. The startup has turned profitable in record time, and it is rewriting India's cafe playbook. We'll interact with the founder, Abhijit Anand, to decode its scaling and flipping the cafe economics on its head. Stay tuned.
Welcome back. You're still with us on Startup Street. Grab-and-go coffee chain Up Coffee has raised 61 crore rupees in a pre-Series B round. The 4-year-old chain operates 97 stores and claims 96 of them are already profitable, breaking even in under 2 months. This is in a market where the likes of Starbucks India and Blue Tokai are losing money. Aishwarya Anand caught up with the founder, Abhijit Anand, to find out how.
Okay, real talk. I need my morning cup of coffee, but I don't want to spend $300 on one cup. And I also don't have 20 minutes to stand in a queue. So what did I do? I downloaded this app last night and I've pre-ordered an Americano. Single origin beans, 97 rupees only. And it says it'll be ready in 90 seconds. So I'm going to go and check out if my order is ready or not.
Can I come in and become the barista? Oh. Aishwarya, Americano regular. साकेत मैं बनाता हूँ ये.
Oh, the coffee is already ready. It's actually quite nice. And I wonder who actually made this.
HCLTech.
This is Abhijit Anand. 4 years ago, he started Up Coffee with a simple idea. Great coffee shouldn't cost you a fortune or your entire morning.
And just last week, he has raised 61 crore rupees from investors to scale this model across India. Was this always the plan? A kiosk, 97 rupees per coffee?
India is moving away from a occasion-led cafe culture, experience-led cafe culture to a habit-based daily consumption culture. Up Coffee was built for that shift. So when we started, we were very clear we are going to build smart format, small spaces, intelligently designed, tech-based, and high-grade coffee at prices that you can drink daily.
Today, Up Coffee operates 97 stores across Mumbai, Delhi NCR, and Bengaluru. Most are compact, grab-and-go formats designed for speed rather than long cafe sittings. And according to the company, the model is already delivering results.
96 out of 97 are profitable. We break even in less than 2 months.
Starbucks India has lost 81 crore rupees in FY24. Blue Tokai has lost 54 crore rupees. Everyone is bleeding in, this market, trying to acquire customers. Your cappuccino starts at 97 rupees. How does that math work in your favor?
Our rent to revenue ratio, just by pure maths, right, is 10.5%.
Okay.
Find me a coffee chain in the country whose rent to revenue ratio is less than 15%.
Zero.
This has been built in a fast-paced, smart format, where our direct cost that goes into the store, we try to cut it down such that it's beautiful, it's meant to serve the purpose that it does for quick pick-me-up, but it's not call it center heavy.
Walk me through a day in the kiosk. What does a good day look like in terms of how many cups, what does the revenue look like, what does your margin look like?
I'll take one location in Mumbai, it's in BKC, right? The morning starts at 7:30 a.m. in the morning, does around 450 coffees a day. It's a 5-day business. We do roughly on a monthly basis a revenue of around 10 to 14 lakhs, right? And an EBITDA of around 25%.
You've just raised 61 crore rupees from investors. Help me understand, where will the money get deployed? What's in the pipeline? By the end of this year, what all would we see coming up from Up Coffee's end?
Everything that has worked, we are going to do that 1,000 times more. 54% of our offline orders happen through Up Coffee app. 25% of the offline orders are subscription-led, which means people hold a card before they even enter the store, right, to order. We are going to further double down on that.
Up Coffee currently clocks around 5.5 crore rupees in monthly GMV and is targeting 100 crore rupees in revenue this financial year. While 96 of its 97 stores are already profitable, the company says overall profitability is still a few dozen stores away, a milestone founder Abhijit Anand believes it can achieve within the year.
The average Indian drinks 30 cups of coffee a year. The global average is 200. Now that gap, 170 cups, is the single biggest opportunity in India's consumer market right now. And every brand that you can think of, from Starbucks to dozen homegrown startups, is fighting to fill it. Now the real question isn't whether India will drink more coffee. It will. The question is who makes money doing it first. Because so far, nobody really has. With camera person Balbir Singh, this is Aishwarya Anand for CNBC TV 18.
Okay, and on that note, we're going to wrap up this edition of Startup Straight from Arundhati and me. It's a goodbye. Stay with CNBC TV 18. More news and updates will continue right after this break.
The Reserve Bank and its MPC will be announcing its policy when there is much to worry about the fall of the rupee and possible rise in inflation. However, growth looks resilient. As always, the CNBC TV 18 Citizens Monetary Policy Committee is here with me to discuss what the RBI may and should do in its June 5th policy. Let me welcome Chairman of our committee, Pranab Sen, and members Sajid Chinoy, Samiran Chakraborty, Shaumika Dikhosh, and Sonal Verma. Sonal and gentlemen, thank you very much indeed for your time. Sajid, may I start with you? Well, inflation is the mandate of the Reserve Bank, and chances are it is going to be pushed up. If you go by their MPR announced in April, they said if there is an average of $95 crude for the current year, then the current year inflation gets bumped up to 5%. For a 5% inflation, a 5-quarter repo looks less. Is there a fair chance, therefore, for a rate hike?
Lata, I don't believe so, because I think what's important is this is a flexible inflation targeting, and we're looking at supply shocks here. If this is a demand shock and you expect inflation to be upwards of 5% for the foreseeable future, there's a compelling case for the central bank to act. But when you've got a supply shock, and possibly two supply shocks here, right? Two adverse supply shocks, an energy shock that we're living through and a potential El Nino shock, both of these could be adverse and could push up headline inflation. But, you know, raising rates is not going to bring crude prices down. It's not going to make El Nino into La Nina. What the central bank needs to look at is, A, how sustained will the supply shock be? And more importantly, is it spilling over into a more generalized, entrenched inflation? And the best way to assess that is to look at how core inflation evolves, right? So I think what the central bank is going to look carefully is, if A, do these shocks pan out for months to come? B, do they translate into core inflation? C, do they unanchor inflation expectations? And then there is a case for central banks to act. Remember, back in 2015, we had a pretty severe El Nino. But for a variety of reasons, we had strong buffer stocks, initial conditions were favorable. That did not translate into the kind of broad-based inflation we had feared. And I think similarly, starting points here allow the central bank to be patient. Buffer stocks are high, reservoir levels are normal. And more importantly, we come into the shock with very benign inflation. Core inflation has been running, correctly measured. If you take out precious metals, take out petrol and diesel, is running at 2.2%. That suggests that producers in this environment don't have much pricing power. So even though input prices will surge, it remains to be seen if this gets translated to a broader output price inflation. Therefore, I think the RBI will and should be patient.
Okay, fair enough. Sonal, now let me ask the other question that the markets are asking. Indonesia has raised rates because of the attack on the currency. It's been similarly impacted like India. So is Philippines. They raised rates in April. Whether or not the flexible targeting allows it, theoretically, practically there is a market expectation. Shouldn't the RBI oblige with a rate hike for the sake of the exchange rate as well?
Yeah, Lata, I think, MPC needs to conduct policy based on what is effective. In Indonesia's case, FX stability is part of the BIS mandate, but, the surprise 50 basis point hike actually did not help stabilize the IDR. And in Philippines, inflation is running above 7%. So compared to the upper bound of 4%. So the inflation picture in Philippines is very different to India. So we need to look at our own scenario. I think using the interest rate to defend the currency is inadvised for actually a number of reasons. First, we've spent more than a decade trying to anchor expectations in terms of the inflation targeting regime and what the monetary policy framework is about. The moment we start targeting FX to manage using rates, I think that essentially undoes a lot of the hard work that has been done to anchor expectations. Second, interest rate hikes to defend the currency are not effective, as seen in the case of Indonesia and also as seen in India's case back in 2013. And third, we need to do a cost-benefit analysis. The cost of doing a very aggressive rate hike in order to curb demand vis-a-vis, the benefit, we will end up in a situation where the growth damage is so substantial that we'll start worrying about the fiscal side and other consequences of weaker growth rather than on the balance of payment situation. And, as we've discussed in the past, India does get a lot more of growth capital. And finally, I think we have, a number of non-monetary measures on the current account, on the capital account, on the macroprudential toolkit that can be used to manage the currency. So I think, the market argument of using the interest rate to defend the currency, I think both from the currency side as well as, from the inflation side, it is not essential and not needed in my view.
Okay, I'm going to bounce